this session. This session will be moderated by Ms. Meesha Sharma, Lead Household Finance Practice, Dwara Research. Ma'am, you could come on stage. The panelists include Dr. Susan Thomas, Senior Research Fellow and Co-founder of XKDR Forum, Mr. Abhishek Agarwal, Managing Partner Axion, Ms. Seema Prem, CEO of FIA Global, Mr. Jaspreet Singh, Global Lead, Financial Health and Innovations, UNCDF, and Mr. Krishnadas Nair, Head Product Solutions and WP Retail, Axis Bank. If they could all come on stage, we can begin. So we all look forward actually for a thought-provoking and insightful discussion. We have an hour and 15 minutes in this session. And saying that, I'd like to hand over the session to Ms. Meesha Sharma. There will be a presentation preceding this panel discussion, which Ms. Thomas would be doing. Thank you.
Hello, am I audible? So Divya, it's already 9:50. So how much time do we have? When should we wrap up? Sorry. Okay. Okay. So that's about 11:05, 11:10. Okay, okay. So hello everyone, thank you so much for joining us for this session today morning. What I'll do is I'll just give a brief opening remarks about what the panel discussion is going to be about and what this session is about. And we'll then start by a stage-setting presentation by Susan Thomas, Dr. Susan Thomas, and then we'll open up the discussion among other panelists. Right, so like I think Divya has already introduced all of us, so I'll not get into those specifics. The panel discussion is really titled Financial Inclusion Leading to Financial Wellbeing, Expectation Setting and Measurement. What we'd like to do in this panel discussion is really to discuss the role of inclusive finance in improving the financial well-being of households and whether the expectation from financial inclusion in bringing about a transformative impact in the lives of households is realistic. So we will be discussing this session in two parts. The first part will focus about whether the expectation of inclusive finance in terms of, financial well-being, in terms of a positive impact on the lives and livelihoods of low-income households is realistic. And the second part of the discussion will be centered around what is financial well-being really, because different institutions, multilateral agencies, bodies have different kinds of definitions. They've articulated in different forms. So how can we arrive at a common consensus when it comes to defining financial well-being? How can financial well-being be measured? Because measurement is important because once we think about the definition and the components, then we will be better placed to think about how can financial well-being be measured. And more importantly, how can we operationalize this measurement framework? Because it's one thing to come up with a measurement system and just have it published, but it's another thing to actually speak with different financial inclusion providers, financial service providers, foundations and NGOs working in this space, take this measurement framework to them and ask them to kind of use it, collect the data on it, and track the financial well-being of their customers over time. So that will be a very interesting discussion about how we can operationalize this measurement framework among the sector stakeholders. So that's the two part of the discussion. Now, in terms of, opening remarks, I just want to make two quick points. One is that first, at the outset, I think we should define financial well-being. And so what the definition that we at Dwara Research resonate with is that financial well-being is broadly defined as the extent to which a person or family can smoothly manage their current financial obligations and have confidence in their financial future. So that is the definition we resonate with, and it's put together by UNSGSA. But different institutions like the Center for Financial Health at UNCDF also have a very similar definition. So now we'd like to discuss in the first part of whether this expectation from formal finance in really improving the financial well-being of low-income households is realistic, or are we setting too much of an expectation and burden on formal financial services and the role that formal financial service providers can play? Now, we think this is an important question to dwell on, because the premise of financial inclusion as being beneficial to customers of finance still waits to be, widely established. Now, it is a controversial statement, but it is true to a great extent that there are not many rigorous, holistic, nationally representative surveys, data sets, and studies that can really tell us very confidently that yes, formal finance has indeed increased the income, reduced poverty, increased consumption, increased asset ownership. So this question is still important to be dwelled on even after 20 years of us working in this space. Evidence, like I said, on the consequence of financial participation is sparse and limited to small sample studies in various contexts, right? So that is the first part. The second part of the discussion will be centered around how financial well-being can be measured, what are the components of financial well-being, and is there merit in FSPs operationalizing this measurement framework? And what will be the usefulness for FSPs in doing so? Now, we've also kind of articulated in the chapter that Susan and Indradeep have written for the IFI report this year that measurement helps to validate or invalidate the premise that drives the policy. But more importantly, it also functions as a feedback mechanism using which the implementation of the initiative can be tweaked. Right? So therefore, it's very important to get the measurement right. For a long time, the impact of formal finance was measured in terms of increase in income, consumption, and the very popular improvement in women's economic empowerment, right? But there is some sort of a growing consensus emerging that there is a need for an alternative way or approach to think about and measure financial inclusion, right? So what we will be doing now is that Susan will be making a presentation. She will be talking about the financial well-being and financial inclusion measurement framework that XKDR and Dwara research have put together. She will talk about what the logic and thinking behind that measurement framework is. And then we will kind of get everybody's reaction in the audience as well as from the panel on what is the usefulness of that measurement framework, does that make sense, and is there a need to sort of tweak it. So with that brief remarks, I'll hand it over to Susan. I'll invite Susan to give us the stage setting presentation. So Susan, 10 minutes you'll have.
Setting it so well. I think I should take less than 10 minutes. I'd like to thank the organizers for having invited me to speak today. I know that originally it was Indradeep, but he's unwell, and so he was not able to make it. And so I will present the bare bones of what it is that Indradeep and I co-authored as a chapter in this year's IFI Summit IFI report. And this is a proposed financial inclusion measurement framework. I say India here, but we are all very cognizant that this is a live problem all across the world. It's not solved. And when we look at it, we see that this is a common problem. It can technically apply all across the world. So let me start. I know that we talked about it all day yesterday, and it's going to be something that we worry about all the time. But I would like to just take one 30-second pitch off to say why should we worry about financial inclusion measurement. And I think the pitch of this slide is that when you have poor measurement, then you will have a paralysis, right? And we were just talking off the line that there are supposed to be these patient social impact investors that look to making investments in financial sector firms that address the problem of improving financial access and participation by low-income households. And while my panelists do not seem to agree, I think that perhaps one of the reasons that we are not seeing that kind of social impact investors in India is because we are not able to present them some metric which can be trusted and reliable, by which they say, okay, it is actually happening, right? And this has been a problem for social impact all across the world. How do we know that when funds are being put into a social program or a socially beneficial program, that it's actually having the impact that it goes through? So we see that there's a big difference between how social capital goes into Indian renewable energy, but not similar kinds of focus is not coming up in Indian financial sector. And one of the pathways that at Dwara Research and XKDR Forum, we think we may want to solve this problem is to see how we can improve financial inclusion measurement. Now, what is the strategy in measurement? And there are many measures out there, because this is not a new question or it's not a new objective, right? People have been thinking about financial inclusion for the longest time. And the number of measures that we can see, we once again discussed it yesterday, all of them are typically from the suppliers or the service providers end. They are aggregate, and for many reasons, this is unsatisfactory. What we really need to know is the impact, that when there is finance that is opened up into the life of an individual or a household, as Misha just said, does it have a benefit that is visible? If not today, but perhaps in the medium term and in the longer term. So what we need to know is what is really going on in the life of the household that chooses to participate in the formal financial system, and whatever are the measures that we are putting together to track the financial inclusion for the household or the individual, are they generating meaningful, are they showing that this participation is generating meaningful impact? So for example, we all get very excited by seeing that so many UPI transactions a day is happening. But really, if 300 times more cash transactions are happening, what's the big deal, right? So we need to know what is the impact of those UPI transactions. We need to know more about how they are being taken on board, whether it's persistent, and at the end of the day, are people really benefiting from using these transactions as compared with just handing out cash? So we need to think more about what finance is, what financial inclusion seeks to achieve. And so I'm going to spend just about 2 or 3 minutes to talk about what the purpose of finance is and a framework that we think all policy initiatives must consider before they put the intervention in place. So number one, what's the purpose of finance? At the first principle level, finance is supposed to allow people, whether it's an individual or a household, and typically it's a household because these decisions are made together. You don't make these decisions about financial participation in isolation. You're supposed to be able to manage consumption better. So most of the times people think, oh, you know, we need, the old theorists tell us that we need to smooth consumption, and therefore I need to make sure that I'm consuming exactly the same amount every month, every year, 100 years. But we know this doesn't happen. We need to be able to say that whatever consumption requirement is being made, without breaking into a sweat, I should be able to make it as a household. The second is, as Misha pointed out, how can finance help sustain gains to income, right? Or build up the wealth of a household, or build up savings of a household. Whatever measurement system that we think about for financial inclusion, we should be able to use them to help answer these questions. Is this the way that the household or the individual is being benefited? So traditionally, this is the second problem I think that we should worry about a lot more when we think about financial inclusion, is that typically when we think about financial inclusion, we think about debt. It's all about credit. Every single story we heard yesterday was about credit, but that's not true. I mean, and I think that my panel is a lot more nuanced on it. This Seema's firm talks about a lot more about finance as compared with just debt, but we should think about more about other kinds of instruments which are in finance. Increasingly, people think about insurance, but there are other kinds of things as well. And the question is, if we just restrict ourselves to formal financial system products and services, how is it that those can help the household a lot better? So we think that it is useful to think about measurement from a framework that we have seen deployed in policy initiatives in other areas, right? Which we call the inputs, outputs, outcomes framework for measurement. This is the standard idea. And the canonical example that will obviously come to your mind is education. So all of us will remember 10 or 15 years ago, there was an ASER report that said, okay, so we as the government of India, or the people of India, are building a lot of public sector schools. Children are getting educated, apparently they're passing exams. But when they went out and asked how many of those children can actually read very simple text or do very simple mathematics, what is the fraction that comes out as being numerate and literate? And the answer was very little. And that was a feedback loop to the people who are doing education policy, saying it's not about building a kacha structure or a pakka structure. It's not about hiring teachers. It's not about getting the kid to pass an exam. It's about building literate and numerate children and people. Similarly for health policy is you go out and build a hospital, hire doctors. But what we really need to do is to get healthy people, because healthy people are a critical input for economic growth. If you do not have healthy people, if your staff are sick half the time, you're not going to have the kind of growth that you should be seeing. So this has been extremely influential in various other places, and our question was, what can we do by way of applying a similar framework into measuring financial inclusion? And so we thought, what are the inputs, what are the outputs, and what are the outcomes? The inputs we can think of as the presence of the financial service provider, which is allowing access of these formal financial products to everybody. What are the outputs in this case? That once there is a bank account that's opened, or once there is an insurance product that has been sold, an insurance account that has been opened, we need to see a continuing usage of that, right? And that's been talked about for banks, but there is insurance. Insurance is one of the largest, most widely spread product, formal financial sector product in India. Do we ask how many people go back and pay the premium once again? I mean, we know about scams like ULIP because you were tied in to do such things, but out of their heart, because they thought it was a useful product, do people go back and renew their renew their insurance premiums? So there is inputs, which is, do I participate? That is, do I take access? There is the second part, which is outputs, which is, do I continue using it? But the last one is what I think Misha also emphasized in her opening remarks, which is outcomes, right? Once I get included or participate and start using finance, am I better off compared to a similar person like me in terms of how I'm able to make my consumption choices more easily and how I'm able to grow my wealth and stature? Now, we ask the questions, how do we measure inputs? The standard thing would be to go out, take a random sample of households and ask, what kind of financial products do you hold? Right? And we have a limited number of those products. In one of the big surveys that happens every year in India, there are about 15 products that every household is asked in terms of what they hold. The measurement about the producer side, as I said, all of us see it. The RBI will tell you how many accounts are opened, how many UPI transactions are happening, but really counting these things is not the useful measure. Think about an analogy from how well justice is served in the country, right? When you think about crime measurement or whether we are doing well in terms of managing justice related to crime, you don't go out and count the FIRs. What we would like to do is to go to the household and say, how safe do you feel walking in the streets every day? How do you measure outputs? Once they've participated, so this is in a certain sense linked, right? If the household does not have a product, then you can't ask anything about their usage, but once they are actually participating, you can ask what are they doing with their financial accounts. For example, payments. We'd like to think that one of the ways to do it is to go up to every one of you, all of you are participants in the financial system, and ask, out of the last 5 transactions that you did, how many of them were based on cash? And if it is the case that a large fraction of your transactions, your last 5 transactions that you can remember is cash, then you're clearly not using the financial system too well. And finally, how do you measure outcomes? I think the panel will spend a very long amount of time talking about this stuff, but we try to say, in addition to what Misha and the rest of the summit session was about yesterday, which is thinking about well-being of the household, which is how well do I perceive that I can manage my life going forward? How comfortable and confident am I that when there is an accident or a problem that happens, I'll be able to manage it financially? We also think it's important to measure the ability to manage consumption. So who are the people in the country where the consumption management is very poor? By which I mean, if there is a shock, someone falls ill in the family, then the kid doesn't go to school because the school fees can't be paid. Right? These are the people who actually need finance the most. And linking it back to where we start, like who are the people who care about financial inclusion the most? There are the policymakers, and hopefully one day the financial service providers, because they want healthy population of customers. But when the policymaker thinks about why financial inclusion should be done, when a policy intervention is created so as to introduce something into the life of a household, did their ability to sustain their consumption go up or go down? So we have several schemes that have started in the last couple of years where we need to, I think that I'm at 11, so I'm going to take some more time. And so the question is, does more finance in the life of a household induce sustained gains in income or savings, actually? Because income can be orthogonal, but savings and wealth is what we need to focus on for the life of the household. So what we did at the Dwara Research Foundation and XKDR Forum is put together some of these thoughts into the financial inclusion measurement framework, where I'd like you to walk away with at least an understanding of what we think are the key features of the framework, which is number one, this has to be done through a survey instrument, because this kind of information about households and their well-being or their consumption is often private to that household or the individual, and we need to figure out how we can get a sense of that. So build a financial inclusion survey instrument, focus on the household. Rather than think about a single financial inclusion index, perhaps think about an index for inputs, outputs, and outcomes, because the interaction of these three will help us understand better how financial inclusion works for the household or not. Create a minimalist survey, because we do think that at the end of the day, the people who are best able to observe their household in its entirety is probably going to be their financial service provider. Regulators, policymakers sit at a much higher level, whereas the people who deal with the customers and their pain and their questions are the financial service providers. But they have to incur cost to collect this information, so it has to be a minimalist survey. And finally, it is important that we observe how households grow once they are participating in the financial survey. The last tricky thing that I'll place on the forum is that it is important, we believe, to take a survey of both the low-income households, which is often the objective of financial inclusion policy, but also look at the high-income household, because if we are doing things right, then the gap between the high and the low-income households using finance should be coming closer. So there are some things that you will read in the report, and perhaps I should not spend too much time on it, but I wanted to say that when we thought about the survey questionnaire in terms of what should be inputs, outputs, and outcomes, we thought that we could break up the inputs into broad sectors as compared with every single kind of financial product out there. So transactional, which is like your bank account, risk-free assets, which is like your fixed deposit, old age income support like a pension, life and health insurance, general insurance, and risky assets like stocks and mutual funds. And outcomes, this is very well understood, and they'll spend a lot of time doing it, but the standard 5 things that you track about a household is what we wanted to put into the survey on outcomes. I want to present very briefly some learnings from a pilot survey. This is something that XKDR and Dwara Research Foundation did in collaboration with a financial service provider in 2021. The lockdown was on, and so it was administered over the phone. But what is interesting is that we got a 60% response rate when we surveyed 310 households. No. 60%, thank you so much. So a 60% response rate when we surveyed 310 households over 2 geographies. And what the survey had was 78 questions. And the 78 questions were broken up across these 6. Ideally, if there's an FSP which has a long-term relationship with some of their households or their customers, some of these need not be repeated, right? Because you're already covering it when you reach out to these with with your products. But these are some of the aspects of the households in the pilot, which is that their monthly income on average was about 17,000 rupees. Monthly expenditure was about 15,000 rupees. There was between 4 to 5 people in the family. They had technical exposure, which is, did you have access to the internet or to network? And the number 0.42 captures the amount of physical assets that the household has. What you will see in the financial inclusion score, which is the average financial inclusion score across the households, is that the input is 22%. So if you had 10 instruments, then the families on average were holding 2 or less than 2. The output score is how much they were used, and that was a little less than the input score. And finally, the outcome score seems to be much larger than either, right? So something is going on. How do these scores correlate with each other? So the first one should not be a bit of a shock, right? Because if you have input, that is, you've got the products, you're likely to be using it. So that's a very high score. But the outcome score when you have input is higher as compared with the outcome score with respect to output, which suggests that there are some products that you don't have to keep touching, but that's how it works. There is some interesting features that show up when you look at the household factors. What we found is that digital infrastructure matters a great deal. So if you have access to the internet, is that right? Is that what you are capturing through digital infrastructure? Digital infrastructure usage is how many times are you doing your transactions using a digital payment system, right? So those are the big things when we look at the well-being. So learnings from the pilot is that the scores are useful. They are correlated with the household well-being. Of course, richer families will score better on outcome, that is well-being, as compared with a poorer household. But when you have finance, it does add. What is missing is that we do not have, it was a one-time survey, so you're not able to track these households through time. Takeaways: to strengthen the credibility of financial inclusion, let's measure better. And I think that the work that we did demonstrates one possible choice. The survey instruments and the scoring methodology is available in the public domain, and it's very easy to apply, we think. I know it's 78 questions, but it's supposed to be much less than what we had come up with. The FSP deployment is what we think is more tangible and real-time in terms of creating such information. Lastly, it is scalable to other countries. These problems are not specific to India. India happens to be a natural lab where we started it, but these questions are something that can go across the world. Thank you very much.
Thank you, Susan. So without further ado, I'd like to open the floor to all my panelists sitting here. So first, I hope you got a good sense of what the Dwara XKDR framework is about, and would love your reactions on that maybe later in the discussion. First, I'd just like to start by asking one question which all the panelists can sort of respond to, which is, can financial inclusion lead to financial well-being? And the reason I'm asking this is that globally we are seeing that while the levels of financial inclusion have increased in the last decade or so, financial well-being has not necessarily improved. So in the Indian context, I'd like to give a couple of statistics. Household incomes have been affected due to the COVID-19 pandemic, and there's a large increase in informal employment, which has implications on how households save, spend, and borrow. There is a decrease in the uptake or renewal of financial assets, such as fixed deposit accounts, health and insurance, and pensions account. There is nutritional, health, and educational deficit occurring due to stressed household finances. According to the World Bank's Findex report, 9 in 10 Indian adults are worried about facing severe financial hardship as a result of disruption caused by the pandemic. But these are statistics during the pandemic, but even before the pandemic, according to India's NSSO, All India Debt and Investment Survey, which is a nationally representative household survey, the survey highlights alarming levels of debt to asset ratio, particularly for low-income households. The debt to asset ratio for rural low-income households is 40%, and the debt to asset ratio for urban low-income households is 550%, right? So my question is, can financial inclusion lead to well-being, or are we burdening the goal of financial inclusion with more than what its potential is? We'll start by you, Jaspreet, and we can go in line.
Sure. Thanks for the report. I think it was nicely done. To your question, Misha, UNCTF's take is few on this. One, financial health or financial well-being, as we are calling it, is not a next panacea, right? Or it's nothing, that we are saying that, oh, financial inclusion is an old subject and we are moving to something very new altogether. Not at all. It's just a additional way of defining, creating, and measuring impact of financial inclusion. The goal of financial inclusion, when it was defined some 10 years back during the South Korean presidency of G20, right, it was done with the objective that the world at that time was far behind in terms of how formal system was serving a large majority of the population across the world. And the need of the hour of that time was to focus on the product and the infrastructure to be able to get people in the system first. But now, as we have got people in the system, the question is, how is the system serving them to, better their lives from where they are? Now, the statistics that you pointed out obviously are well beyond the domain of a financial service provider, okay, in terms of how people interact in their day-to-day life, because it's not only about the financial products, but a lot of other factors which plays into it, be it inflation, be it, availability of resources, and so on and so forth. But the question is, to a greater extent, the formal financial system, through these services, in a better way, can, if not address all the challenges, fill in for some of those gaps which exist, at a household or individual level. And that's a journey towards, improving financial health and well-being. It need to be noted that, it's not only a responsibility of the FSP to do all of this, because then, we're also talking of things like social protection mechanisms in the country, which also have to kind of play their own role in terms of how people are able to manage these shocks or be able to secure around their finances, right? So all of that cumulatively plays a role, but the absence of formal system itself would have not allowed other things to happen, which is now already there. The question is, now, are the products that we are delivering or providing to the end consumer addressing the right needs for those consumers or not, especially the LMI segment? Because most of the time, we do not create services separately for LMI segment. It is created for people at large, but their needs are very, very distinct in terms of, how they interact on a day-to-day basis with their finances and with smaller income set and other constraints around them. So it's important to think of, are the products really serving the LMI segment in the right approach or not?
Yeah, thanks, Jaspreet. Krishnadas, you'd like to take that?
Sure. Thanks, Susan, for that report. Quite insightful. And from our perspective, from a banking side of it, we've been working on financial literacy programs, financial inclusion for many, many years. And the way I see is that financial well-being is a journey and financial inclusion is the first step towards it. Unless we don't take that first step, I think it's difficult to even get into the next level of measurements, right? So has financial inclusion had its impact? My answer would be yes. How much have we measured it? I would say that it's the way the product and services have been consumed by these households, right? That's one of the best way to measure the outcome, right? If today I'm giving him a loan of, let's say 5 years back I gave him a loan of 25,000, today's ability to take 1 lakh loan is there, which means that it's a proxy for me to say that the outcomes are there for us to feel that it's working, right? So from financial inclusion perspective, it's a very important step, and unless we don't further create a more systematic way of tracking the outcomes, we'll not be able to improve the inputs, right? So from financial well-being perspective, it's a journey, and there is no a state where we can say that the household has reached the ultimate state of saying that he is financially well-being. So we have milestones, and we track against the milestones where the customer is able to reach that milestone or no, right? So when we do our financial inclusion for especially the low-income household segments, we look at the bottommost segment where even access to credit, forget about savings, forget about insurances, very simple things like even for their economic activities. It's like I was listening to, one of the speakers in yesterday's session where she made the statement, "Aaj kamaya, aaj khaya." Right? That's how their life is, right? So if you're able to bring credit to them to start with, and then graduate them to the other aspects, which is whether we call it from savings, simple savings products, to health insurance, because that's again something which is very important, and we've been driving it through various government schemes. So it's important that we create the awareness, and financial inclusion is the only way to create that awareness. That draws them, the fact that they can have access to credit, draws them to be part of that financial inclusion camps, and from there on the journey begins. So financial well-being it's a milestone-driven thing, and financial inclusion is critical for us to achieve that milestones. And it will be different as I move from within the LIG. If I move to a different segment, a evolved household, you will see the difference. Yes. How do we measure it? It's a question that we would like to really deliberate on. But the fact that financial inclusion has created impact and will continue to create the impact, I mean, that's what I would like to add.
Fair point. Seema, your thoughts?
So when we started off in, I run an impact fintech, and so when we started off in 2013, around 800 million people in India did not have a bank account or were unbanked. So I think the first step for us as a social enterprise, we looked at upliftment from poverty as a goal, was to just provide bank accounts. So basic right of any individual, I believe, is a bank account, and we started off with that. So people would come, deposit money, immediately withdraw the money once a bank account was opened, because they were scared. They were handling the bank account for the first time. Over a period of time, we saw transactions growing and then savings getting built, confidence in savings and fixed deposits, recurring deposits, and over a period of time, financial well-being, financial assets getting built, financial well-being getting built. So Bankura is a Maoist infiltrated area in West Bengal, and there I had a customer called Tanuara. In 2013, she was about 22 years old, married. She had 2 kids. And 3 years later, when I met her, she was unbanked. We had provided a bank account. And the question that she asked me is, yes, now I'm comfortable. I have a bank account. I am saving money. I have recurring deposit. But I would like more. So what was she looking at? She wanted credit. She had a tailoring sewing machine, and she wanted to set up a tailoring unit and employ 2 girls. She wanted to increase her income. She wanted higher return products. So beyond fixed deposits and recurring deposits, are there other products that I can avail, which will give me a higher interest rate so that I can grow my wealth? So then we realized that she also, so one thing which she told me, which really shook me at that time, was that because I'm saving money in my bank account, it has made a difference to my nutritional well-being, because I'm able to stretch the money across the month. And so I'm able to eat at the end of the month, and there is no skipping of meals at the end of the month. And we know that towards the end of the month, typically it's the women in the household, if you have shortage of money, that ends up skipping meals. So here was this really good example of how a financial, just a bank account makes a difference on the nutritional health of women. And so yes, that does comes from financial well-being. So I do believe that financial inclusion is a significant contributor towards financial well-being. But when we looked at Tanuara's journey, what we realized was that, yes, I have started off basic accounts, provided basic transactions. Now I need to graduate. She needs loans, so which is income generating, increase her income. She wants wealth protection. I want to save for emergencies. I have frequent floods in my villages, so how do I protect against that? How do I protect against health emergencies? And I would like higher return products, which means I want to grow my wealth. And that's when we realized that financial well-being, financial inclusion, right now in India we talk about is only access, adoption, and then usage of financial transactions. UPF transactions have quadrupled, doubled. These are the statistics that we hear about, but we need to actually graduate into the financial well-being aspect, which is increase your income, generate more wealth through higher return financial products, and provide for emergencies, especially in the light of the pandemic, health emergencies. and even natural floods, calamities, natural calamities which are causing financial shocks to individuals. So now if we address that, then yes, you're taken care of financial security through basic transactions, move over to financial resilience through health insurance, livestock insurance, property insurance, and then financial freedom through higher return financial products and even credit. So it is a journey, like Krishna was saying, and financial inclusion as a significant contributor to financial well-being. It is not that people who do not have a bank account or are not financially included or not financially well off. Yeah. Thank you.
No, thank you very much, and thank you for having me here. I think the story which you narrated for the customer, I think it's not very different, and I think rest of us on this panel will agree, because this is something which we keep on hearing from our customers as we go to the field. But coming to the financial inclusion to financial well-being, and I think I have witnessed it myself, and which has brought me to this sector. Just quickly, that is story. When I was in Afghanistan working for a World Bank project, I met a microfinance customer who was living on a $2 a day, and or actually 50-70 cents a day back in that time, and he was given a $70 loan which changed his life. And from it 50-70 cents a day, this family of 5 became a man of $1,200 net worth over 10 months period itself. And seeing that impact on the life of the customer, I felt what I'm doing at this side, let me see how this financial inclusion or microfinance or development side can help me. So that brought me to this sector. But that's 20 years ago, and today here I am in front of you. Now let me ask a question to this audience, given we are talking about from financial inclusion to financial well-being. How many of you think that you have done appropriate savings for your retirement? Do a quick hands up. How many of you think how you have done appropriate savings for your retirement? I can see few 5 or 6 hands. Thank you very much. That itself tells how financial well-being we are sitting in this room. We are all educated, working in financial inclusion. And that's lies the problem. And what I'm trying to go there is, I think financial well-being or financial inclusion has a little bit become a misnomer here. We say that we are looking at this at the LIG, at the bottom of the pyramid, but we are not looking at the financial well-being very holistically. We tend to ignore ourselves as well in this. We are not doing enough on it. And let me say, I think, Misha, you talked about the point in terms of looking at the access to debt has changed, and how the poverty or how the exposure has been very high into the urban areas versus the rural areas. Part of it is related to the access to the products. Now, the customer segment in which we are looking at the financial inclusion stroke financial well-being is, if these easy products are going to be available to them, then money is attractive. Everybody wants to have the access to money. They end up taking it. So who's responsible into it? Part of it is the FSPs. Now, as a FSP, I need to ensure when I'm giving that product and that service, and here I'm not differentiating while I'm a big lobbyist towards the credit product, because credit is a product through which you can make the consumption smoothening, and you can have an easy outreach, and can also make it economical to deliver the product out there. But when we are delivering that product out there, what is very, very important, that have we understood the customer dynamics, customer need there very well. If that women or if that family, and family becomes very important, because in financial well-being, it's very important that you understand the household. It's not about just the customer to whom you are offering the product. And particularly in our segment, when we are approaching this through the lens of the women customer, and it's the women who is going to look at the entire household, it becomes our responsibility as a responsible lender, as a responsible FSP, that we understand what is really the requirement of the customer rather than pushing the product out there. Insurance, why insurance has not been successful into the Indian market is, one, there's a failure in the product design, and second, it continues to remain as a push product. We are being sold or being taught that you have to sell these X number of policies. Why can't we change the approach there a little bit? Let me educate the customer why the insurance is important for them. And we at Axion, we have witnessed it ourselves in a pilot which we were running in the state of Odisha, which is one of the poorest state. When we were running this pilot project on 50,000 women, only 10% of the women had subscribed to the PMJDY sponsored insurance products, which is available at 12 rupees and at 300 rupees. I don't expect every woman which is earning 5,000 rupees a month to subscribe to a 300 rupees insurance product. I do not expect that, because for them, what is important is having the meal both the times in the family. But when we educated, and I'm using the word very consciously, the idea was not to sell anything, it was to empower them with the knowledge. And education is the wrong word, I used it, so apologies on that. When we empowered them with the knowledge that these are the products available to you, and this is what these products can do for you, there was a sea change we saw. 13% numbers going up to 84% number from an insurance subscription. These are the women who went on their own to the banks from where they had the account and subscribed to the products. So I think I could not have agreed more from the perspective, Ivisha, you asked me the question that how the financial inclusion leads to the financial well-being. That is why I am here into this sector, and I have seen it happening myself. But just to sum it up, I think the responsibility lies in us that how we are approaching the household, how we are approaching the customer in looking at what's the solution we are offering to them.
Yeah. So thank you, everyone. I think overall I'm hearing a very positive narrative. So that's really promising. I'd like to, a couple of thoughts, and I'd like to get Jaspreet your reaction to this, right? So Seema mentioned that financial inclusion is a significant contributor for financial well-being, right? At the same time, in India, what we're seeing is beyond bank accounts, the access problem itself has not been solved, whether it's insurance, health or life or pensions, right? So a couple of thoughts that are running in my mind is this conversation relevant in this context, in the context of this conference, etc.? Because like you said, financial well-being is not a panacea, it's not a new goalpost. Yet, if I may be very candid, there is this obsession in the sector, me included, of changing the narratives and changing terminologies. It started with microcredit, went to microfinance, went to financial inclusion, and now it's all about financial well-being and health. In fact, the title of this year's conference, IFI conference, is Financial Resilience and Financial Health. So are we as a sector, me included, obsessed with terminologies when in India financial inclusion itself has not been solved, right? Are we thinking about it in the wrong way? And second question to you, Jaspreet, is, about the financial empowerment angle, which Abhishek mentioned. And in fact, even yesterday, the Chief Economic Advisor, Dr. Anant, mentioned that, for financial inclusion service providers, it's important to go over and beyond financial services and really financially empower their customers. But are we burdening the financial sector too much with, saying, okay, ab de diya, like credit de diya, ab usko educate bhi karo, is that too unrealistic, right? So the reason I'm asking that question is, as all of you rightly said, financial inclusion is just one piece of the puzzle in financial well-being, right? And financial well-being will come with the right kind of education, occupation, social protection, and there are 10 other things, health, sanitation, 10 other things, right? So how can we work with other players in the ecosystem beyond the financial sector to make all of this happen? So I've asked you 2-3 questions, if you can condense and share your thoughts.
Okay, I'll start with the defining aspect of the terminology over here being used, right? Financial well-being is a terminology that we have been throwing around for some time now. There was a reason, why even at UNCDF or UNSGSA, we didn't adopt financial well-being, okay? And we stuck to the financial health of the terminology. Okay, I'll give a case in point. Think of, me going to a doctor, and, I tell the doctor that, oh, I'm having pain in my stomach today, right? The doctor asked me to take some vitals, get a blood test done and everything else, right? And then basically prescribe me a medicine. It should work in a similar fashion, right? Because the idea should be that the service provider or the FSPs over here, are those doctors who, based on certain vitals, should be making a decision in terms of what medicine to serve to the customer who has come, rather than based on the fact that I am telling, oh, I am having pain in my chest or somewhere, right? Which is a very well-being concept, which takes you into a little more of an emotional dimension of how I feel about few things, right? rather, kind of looking at the exact numbers in terms of what my vitals are telling me about. And hence, on purpose, we stuck to financial health as a terminology to define, what are we really trying to get and achieve over here. The second thing we defined was, in this entire approach was, and everyone, at least the participant of the working group on financial health agreed that the concept of financial health is like a bucket, okay, where you have 3 or 4 aspects into it: resilience, security, control, and freedom, or we can, keep on calling it in different ways: day-to-day expenses management, feeling better in life, and all in all different ways. The application of all the concepts will not apply to an individual at the same time. It will be one or the combination of the other which will be applicable or will be relevant. So that means we are also, trying to create too much of a theoretical concept over here, and, overburdening ourselves in terms of how we want to approach this entire subject. Okay, this has to be made a little more practical in terms of how can industry adopt it and serve with better services the end consumer. We have seen with examples with, what CBA has done in Australia, or what Discovery Bank is, testing in South Africa, in terms of the approaches that they have taken to basically use the aspect of measuring to create better service or products for the consumers. Understand what are the consumer needs at a certain point of time, because there's a time dimension as well, which comes into play here, because the customer's need and requirement also keep on changing based on the environment they are, interacting in. So I think we need to kind of, distinctively put out that we are not doing a theoretical exercise here of, calling it a financial health or well-being concept, but how can industry actually be the owner of this entire thing? When financial inclusion and why access and usage became such easily acceptable indicators was because it was easy to measure it to begin, right? I, as an industry or a bank, I don't have a cost to put in to, basically measure it, because I know it from a top line number. But now when we keep on talking of the other indicators, the thing is that, we need to shift the conversation from top line to bottom line. Okay, that when you basically do this, then, is it kind of contributing to your bottom line? And the moment you basically build that narrative, the industry will be a better participant in terms of, how they start looking at this concept and why they should be participating in it. To the point of the empowerment, financial empowerment, and, is that role of a bank or financial institution? There's no point of taking side in terms of, is it good or bad? Because we are all equal participant in, helping the consumer make the right choices. Okay. The question is the bank or the financial institution making enough effort to provide that choice in the right way? Or is it just a marketing of a product or a service? Okay. So how you are basically placing your offering is, where this question of empowerment really comes into play. But it's a collective effort where, everyone has to kind of continue building onto it, because it's not a job of one institution, be it a government or civil society. It's everyone's collective effort which will kind of, either make or break it.
Yeah, thank you, Jaspreet. I think that's a great segue to the second part of the discussion, which is about the measurement framework and how we can operationalize it. Before that, I just wanted to ask you, Krishnadas, right, like about Axis Bank's unique approach to, serving the low-income customers, and how do you see financial well-being playing out among your customers? We also saw that Axis Bank got an award yesterday. So certainly there's something, like you guys are an outlier and doing something outstanding. So could you elaborate a little bit on that?
Sure, Misha, and thanks for that acknowledgement on the award. It was, if I have to get a little bit more details, let me explain with the model. So the way currently we function, we have 3 models, which is driven by Axis Bank, and we also supported in through the Axis Bank Foundation, which does a job outside of what Axis Bank is doing. So if you look at Axis Bank today has 3 structures. The first is we drive the FLP program, which is called Sanchetna. And through Sanchetna, we try and reach out to customers who are largely underbanked or unbanked. And in that piece, we try and reach out and focus on 3 areas, right? One, we look at how do we inculcate the financial discipline of how to manage your income, whatever cash flow comes in, how to manage your day-to-day finances. Second most important thing that we focus on is about the health. COVID has taught everybody, and today customers also acknowledge that if I was informed, perhaps I could have managed it better. So we're getting these feedbacks during our sessions, and they're very keen to understand, what kind of insurance, what kind of, whether it's for asset, whether it is for their own earning members, right? There is a heightened need for them to understand the insurance aspect. So that is the second area that we look at. And third important part in our FLP program is about making them aware of the various government schemes, which if they subscribe to, they get a lot of benefits. There are subsidized programs, there are programs which today they don't know where to go for. So we look at this three-tier structure in FLP, which we call it Sanchitana, and that's how we deliver these programs. And we cover more than, about 20 to 24 lakh customers. Annually, we try and cover them only through Axis Bank effort. So that has helped us to understand that segment, and we also looked at not just from a credit standpoint, we're also looking at from, having a savings account, having a FD, RD. There are customers who are saying, can I get a RD of 25 rupees, 50 rupees? So that's the kind of denomination we're talking about, right? There are questions saying that, my husband works in a different place. For him to remit the money, how can it happen? So remittance is catching up. So if you look at products are going beyond just credit today. So while there are customers who don't have access to credit, but there are customers who are also asking about these kind of sophisticated products from a low-income households perspective. So it's evolving, and we're seeing the needs also changing as we see them. Like we have we did a small survey, and we've got about 40%, 35 to 40% of customers are more than 5 years. And when we studied them, we realized that their needs have evolved over a period of time. So it's an interesting program that we're running, and it is helping us to bring in new product and solutions.
Great. No, thanks. Seema, actually, you've touched upon that a little bit already about, how you see the links playing out through the story you spoke about. So, please feel free if you'd like to add more on that. But then I also wanted to ask you, how do you think about the measurement framework that we have put together today, Dwara and XKDR has put together today. We spoke about the input, output, and outcome approach, where input is about participation in all different kinds of accounts, not just bank account, but different products. Output is about usage, and outcome is about the impact, financial well-being, which is defined, just to recap for the audience, in terms of ability to manage day-to-day finances, coping and recovering from shocks, managing medium-term, long-term goals, and confidence in financial future, right? So what is your feedback on this framework that we've put together? Do you think this framework can be operationalized by FSPs? What is the usefulness of this? Is there a way we should streamline it to make it more practical?
Yeah. So we have a very similar, measurement system in place. So we look at input. So we look at input from access, adoption, and usage. So from an access standpoint, we look at the number of partners that we are working with, banking partners and financial inclusion partners, so that it covers the entire gamut of financial services that a customer needs, starting with basic banking account to credit to investments. Investments include mutual funds, FDs, RDs, and digital gold, and also protection, wealth protection through insurance schemes, pension schemes, and protecting your families from emergencies. So that's how we take care of financial security, resilience, and ultimately financial freedom. So those measurements for us are put in place, and we have so we look at number of banks that we work with. So if you go to a state like Jammu and Kashmir, it's very important that you work with not just the top public sector bank or the private bank there, you also need to work with the Grameen banks, because Grameen banks have deep outreach and branches into the interiors of Jammu and Kashmir, which the public sector and the private sector banks do not have. And only if you work with them would you get access to the customers and the unbanked customers around them. So the first input measure for us was the number of banking partners that we're working with. And we now work with almost close to 40 banks in the country. Then it came to looking at setting up banking outlets so that people get the basic right, which is a bank account. So we started off by ensuring that we are present in all states, all union territories, all districts, right to the lowest common denominator, which is a village or in a ward in urban India. So all zip codes as well. So we're working in about 740 districts in the country, all states, all union territories. So that kind of took care of the access part. So 30,000 banking agents, and if you look at the entire movement, you have about 30 lakh all over. Once that is taken care of, then we looked at the measurement of output for us was number of bank accounts, number of transactions, gross value of transactions, and also number of social security schemes, credit enablement, etc., which leads to the outcome of, for us, the outcome that we measured, which is within our control, is financial increase in your savings, average savings per customer. So over a period of time, pre-pandemic, we have seen a gradual increase in savings by 30% year on year, and also increase in the percentage of financial assets, which is largely FDs and RDs. We also looked at a proxy, which was loans, to see an increase in the income of customers. So that's the measurement system that we have in place. So we carried out this massive dairy digitization project in West Bengal. What we did is we set up banking agents right in the dairy cooperatives. Started off by providing banking accounts, and then we said we would digitize their income flow. Because if we digitize an income flow, then it will lead to digital transactions and also creation of digital assets henceforth. And what we've seen at the end of that is it actually resulted in doubling a farmer's income. Because now the branch manager is sure that yes, the money is coming into the bank account, a credit history, a financial history has been built, lending money to the customer. So from 1 cow, he goes to 2 cows, people with 5 to 10 farmers, and over a period of time, actually doubling a farmer's income and building financial assets. So yes, if you look at the measurement criteria, we need to get into a lot more details. And one point which Abhishek was mentioning about an empowered, individual, right? Empowered individual with the knowledge of finance, now knowledge of banking. So now their requirement is we want more. We want loans, we want mutual funds, we want to invest in stocks, tell us, and that's where we believe that the government should now focus on. Because we talk about financial inclusion in India or even world over, but let's be very clear, it's just a bank account we have provided till date. We have not really looked at meaningful or holistic financial inclusion. And that means that if you're looking at credit, change the way you're giving loans to the credit invisible. You have 2 more regulators for mutual funds and for stocks and for insurance, getting them all together so that truly that will result in financial well-being.
Right. Thanks, Seema. So, Abhishek, if I can come to you now, right? Axion is obviously very uniquely positioned because you're working with different financial service providers who are catering to the low-income segment, right? So, a couple of questions to you, if you can share your summarized thoughts. How do you see the links between inclusion and well-being playing out between, the customers that the companies you invest in, playing out? Second question would be, how does Axion measure, the impact of all the work that's happening in this space, in terms of participation, usage of products, and the eventual outcome? It may not be in terms of financial well-being, but is there another way to look at it? I think we would benefit from hearing your thoughts on that. And and then also if you have any thoughts on what are the challenges you see in operationalizing a financial well-being framework at a large scale, because right now there is no common data set on this. Like Jaspreet rightly mentioned, we have data sets on number of bank accounts or number of insurance accounts, but nothing on financial well-being. So what are the challenges?
No, thank you very much, Misha. So just quickly on Axion, we work with a 3-pillar approach. While we have Center for Financial Inclusion, which looks at the policy, advocacy, consumer protection, data privacy. The second pillar we have is really working with the portfolio as well as non-portfolio companies in helping the companies on new product design in a holistic way, customer engagement. And through that pillar, we also engage on the financial empowerment, financial capability buildings and others. And then the last pillar is the investment, which you talked about, Misha, from where we invest into the early stage startups to the growth stage companies to make the equity investments. And I'm not here to make the pitch about Axion, but just coming back to the items which you asked me about it, when we look at the companies in terms of how they are working from financial inclusion to the financial well-being, I think it's an overall approach which we look at it. What is the problem you are trying to solve, and how are you addressing the customer segment in which you are looking to solve the problem? We at Axion have been very uniquely positioned in that way. And when we came to India, even back in 2006, 2007, while the market was growing towards the group lending models, here we were seeing that how the approach can be taken to an individual lending, where you start assessing the customer at the individual level. And why we come with that approach? Because when you are looking at the customer at an individual level, then you are trying to establish their cash flows, their household requirements, their household cash flows, and what are their obligations and what they need to take care of in terms of the asset creation. A number of companies where we have invested or where we work with is likes of Dwara KGFS, which has a wealth management inclusive approach, looking at how the customer at the deep rural level needs to be assessed their wealth overall, and then being offered the products appropriately. We also work with Axis Bank very closely, and I'm very impressed with the Axis Bank approach, where they target their customer at the bottom of pyramid in terms of looking at that customer. How do you really empower them? And Krishna already talked about it, but I just wanted to call it out. And I think what is the key differentiator here is that you need to see this as a business case. And Seema just mentioned, as you are empowering the customer, by empowering the customer, which we do not realize, in fact, you have already created a demand. Seema just mentioned that now her customers are demanding or asking for mutual funds, equities, and other. And what has resulted is your upfront investment by doing an empowerment. And usually in the business cases, what happens is we are not very keen in doing that upfront business investment, because we match our P&Ls on a quarter to quarter or a year to year. If we can start to take a little bit holistic approach there, that okay, and that's what we do at Axion in our investment approach or analyzing the company, we look at that, it's not necessary for you to look at your P&L quarter to quarter or year to year. If you are making that investment into that customer, your P&L will start to show very significant trajectory as you have empowered that customer and in generating the demand from those customers. And I think a lot of it from an India perspective, if I really look at it, the game changers have been, while we have so many accounts which has been opened, and why it always have to be the regulator and government forcing these accounts. Now, given these accounts are open and so much as inclusion has happened, how can we create the traction on those accounts? And part of it, I think, Susan, you asked that today the UPI is happening, but is the cash transactions have increased, or is it as comparable towards the cash? I think I slightly disagree with that. I find it a significant mover today when I go to a coconut shop and I'm able to buy my coconut and making the UPI transaction. In fact, in a recent incident where I had to pay 3 rupees payment and I did not have 3 rupees with me, the shopkeeper was ready to take a Google Pay from, or a UPI transaction from me. Now, what does this mean? That the behavior is changing. And that behavior change is very, very important. Back in the days, 5 years ago, when I wanted to make even a 2,000 rupees payment from my credit card or from some of these digital channels, the merchant was not ready to make that payment, and they were discouraging that you have to top it up with another 2% fees and others. Today, the behaviors have changed. And what has changed? Part of this is the pandemic, part of this the infrastructural availability, and part of it is where we are empowering and educating the customer segments by making those investment in them, that this will help you. The more and more these transactions getting into the digital systems, it helps all of us as investor, as the FSPs to understand the customer behavior. We do not understand the customer by talking to them. We as a bank, and I'm not saying it on behalf of a bank, but we understand based on their financial transactions, what visibility we have it. So I think the more and more we are able to empower, and this is what when we, Micha, to your question, when we look at the FSPs or when we invest or from other pillars, our approach is to look at how more and more footprints you can create by empowering those customers. I hope I have been able to
Yeah.
touch
Are
upon.
there a set of impact metrics you have at Axion saying that these are the things you should be collecting? Do you tell your FSPs that these are the 4-5 things you should be collecting and this is how we will measure the impact you've created? Anything on that?
No, absolutely. So we have the metrics, and I think usually there are those standard set of metrics where you keep on looking at it, what has been your outreach or what has been your product enablement or how many of your customers have been able to touch upon on this product. So these have been the standard industry practices. But over the years, and particularly in last 5 years, we have been even more nuanced. And I think there is largely we like to go with the objectivity in those so that you can measure them. But there is some subjectivity also has started to come and play the role. And a lot of it I was already seeing in the framework which you have outlined there, that how some of this is really helping the customer in making that decision. So it's not about just touching or subscribing to the product, how I have started to think about it, whether I have enough money to save or not save. And it's okay to have a little bit of, again, not everything can be subjective, because from a framework perspective, you need to have certain numbers to be communicated so that to the FSPs and others or the impact investor, you can show this is my business case. But even at Axion, we are looking at it, how this delta is moving from X to Y. So we have that. And from an impact perspective, I think given how the industry dynamics are changing, how the customers are changing the behavior, we are also evolving. So right now at Axion, we are doing a strategy refresh where, given the landscape changing, we are relooking at it, that how these impact indicators at the portfolio companies, at the customer levels, need to be relooked at so that we have the better understanding of resilience, we have the better understanding of their financial well-being and how the delta is moving.
Thanks, Abhishek. That sounds great. So I think we're at 11 o'clock. Are there any questions from the audience? Yeah, please. Would you have a mic, or would you like to come up front and ask your question and also introduce yourself, please?
I think I'm audible. I don't
Yes,
need a
you
mic.
are.
So my name is Taral. I'm a faculty with B School in Ahmedabad. MICA is the name of the B School. And I work in the area of sustainability, CSR and impact measurement. And so this discussion has been beautiful, and I don't know, a lot of us, if we are aware that there is a new model that just came up through the discussion right now, and I'm referring to a model given by Deacon in 1988, which is very similar to what Susan was talking about in terms of an input and an output model. So here is what this model is, and maybe I'd request you all to reflect upon it, although it's come through your discussion only, that financial well-being is a product of financial behavior. And that's a term that Abhishek just mentioned, which is financial behavior, a moment ago. And again, he mentioned a term which is demand side a moment ago, that financial behavior is dependent upon demand side factors and supply side. And supply side is the FSPs and the Axis banks of the world, where so like when Abhishek said that a show of hands in terms of who feels that his or her financial, retirement is secured, and you just saw 4 or 5 hands go up, I'm sure nobody sitting over here would go on to say that, oh, I wanted to invest in a mutual fund, but the product wasn't available. So the supply side was sorted. What isn't sorted is the demand side, which governs the financial behavior. And that's where I think, the industry in terms of an ecosystem where Misha was saying that, are we expecting too much from the industry, wherein a little bit in terms of financial literacy, a little bit in terms of I think, Seema, you use the term empowered customer. So empowering a customer is going through that journey of, financial literacy. If that is being done by the industry, then I think the demand side, so the 2 stories that you spoke about, that woman in Northeast wanted a change, and hence, getting the product to that customer, and she latching on to the customer was very easy. So I think maybe the industry and the academia, at the school level, maybe things need to be done where there are basic courses on financial literacy, and maybe there is one aspect which is totally missing, which is ethics in finance. There is so little that people talk about in terms of ethical finance, that children in school and even in B schools where MBAs are produced like hell, people don't talk about it. And once this comes in, I think the demand side factor kicks in, which propels a change in, financial behavior. Right. So maybe your thoughts on that.
Please, please.
No, thank you very much for that great insight. I think could not have agreed more. And you touched upon two very important points, and I think which we should maybe have covered here is one is the basic financial education at the school level. And I think, and second part, you touched upon the ethical financing. And I will go actually first to the basic financial education, basic financial understanding to our kids, our children. An unfortunate reality is, while we go through with these great programs on the financial management of that, but nobody teaches us how to really save the money and why saving is important. And even at my home, I'm seeing there is a piggy bank there. That piggy bank is lying, but that piggy bank doesn't mean when we come to the sophisticated world as we go and graduate, how we will really use these concepts towards. So I think it is utterly important and we should start working towards it, and there is very little. In fact, we at industry level, we at Axion keep on lobbying about it, that this financial planning, financial education, I do not like to use the word financial education now anymore, but I think I fully agree with you that this needs to be taken towards the really at the basic level of teaching our kids in the school while they are at primary levels, that this is how this needs to be done. Second, then coming to your point in terms of the ethical financing, I think if we have taken to that level, then we can always graduate to the next level, which is in terms of that why this whole ethical financing and why this becomes important. Could not have agreed more. And in terms of, I think, looking at it from the angle of is it the, and which I touched upon a little bit from a push product and others, I still feel that there is a lot of responsibility which lies within the institution. And my panelist commented here, he brought a beautiful analogy of the financial well-being from a health sector. While today we are not having enough trust on the doctors, how can we go back? And there is a lot of trust currently in the financial services industry, particularly in the financial inclusion segment. I will not call that trust out there at our level, which is why we are not able to subscribe to the products. The reason we don't have enough retirement planning, one, we are not being told about it. Second, I myself had the experience of not being able to subscribe to a pension product for close to 2 years. IRDA has a fantastic product which is pension schemes under the NPS, but nobody talks about it. None of the banks, none of the financial institutions are talking about it. And a lot of landscape has changed in last 2, 3, 4, 5 years, only because this has been enough rewarding and making money for the FSP and others. So some of that need to change. Some of this needs to be more trust being. And just going back to the point, I think given that in the financial inclusion segment, our microfinance customers continue to trust us a lot because there is a physical touch and connect, we need to leverage that. And by leveraging that, I think we can empower them more and more and just can redeem it for everybody's benefit. I don't know if anybody else wants to comment on it.
So, I'll just adding on to what, Abhishek was alluding to. So if you look at the LIG customer today, and when we go and meet them and we have our group meetings, we meet these women borrowers, the first thing that the industry believes in that this is a segment where the intent to pay is extremely high. This is the last segment that we would have a measurement to say whether they would intend to pay or no. We have seen even during COVID days, with floods around, when we have approached them, they have come out and given the money. So from an ethics standpoint, the trust factor that this segment has and the credibility that the FSPs have derived over a period of time it's immense, and that is there to see as the market grows and market is expanding. There is clearly a need for credit and the other savings and pension and remittance products. And more, the financial literacy program is broadened to address these services. We believe that this is only going to help the segment in terms of awareness. So when you go to a little bit evolved segment, the issue is not about awareness, issues about choice. You're spoiled for choice. Your ability to take a decision which one to go for is somewhere overplayed with your ability to comprehend and analyze, right? So, but if you go down to the low-income household segments, with the limited information coming is the trust and the relationship which overshadows everything else. And they believe you as a financial advisor, they believe you as a, as somebody who's walking the path with you, and they see you in and out every month. Right, and that's a trust which drives this business. So financial literacy program has evolved over a period of time, and what you say is there to, see and believe that it's happening in this industry. That's a little from my hand.
I would like to just add one point here that in 2017, the Financial Reforms Committee, so the first recommendation which went to the Prime Minister by the committee, which was Arthik Shiksha Abhiyan, which is let's start providing Finance 101 to starting from middle school onwards. So I urge everyone here to actually, we've written to Niti Aayog also about it. It's very important to catch them young and teach them on the foundations of finance so that, we can have financially empowered individuals. Yeah, thank you.
Great. Any other final questions? Yeah, please.
I am Gurpreet Singh, District Development Manager, NABARD, Patiala. So I would like to say that as Sir asked about how many people are comfortable about future. So as it is said that middle class is only one sickness away from poverty. So that fear is always there. And regarding financial well-being, I think the metrics that you have prepared, as you yourself mentioned that you will be needing time studies also after time. So maybe it is a mammoth task. So what we can do is we can have a concerted unified efforts to study correlation between form of finance. For instance, we can say that farmer suicide. So whether it is due to formal finance or informal finance, similarly socioeconomic indicators. So we can just use the data of NSSO and we can have unified correlations. And even RBI and NABARD is working, they have some efforts towards public infrastructure investment and credit outstanding in a particular district. And they are trying to study correlations with the socioeconomic indicators. Having said that, my question is that at a macro level, that when we see that credit is increasing, but at the same time we have a data that the CMIE reports that unemployment is also increasing. So for Haryana, it is 36%. So as we are formalizing our economy, and if we have unemployment of 36%, so the credit increase will apparently go to non-productive purposes or consumptive purposes only. So how do we see that? How do we see financial well-being while our financial inclusion is increasing and unemployment is also increasing? Thank you.
Super question. Who would like to take that? Think.
So, no, absolutely, you are right on the point that when you see the credit going up and, unemployment going south broadly, it really, is on a different dimension. So, let me take an example of Kenya actually. So Kenya has been a poster child for financial inclusion for everyone. We see that they're already at 92% financial inclusion level. But in the last survey, which was done in 2022 by FSD Kenya, the financial health actually fell from 2017 to 2022 between by almost like 12 basis point. Okay, from 54% to 41%. And the prime reason for that was credit. That we saw Kenyan market has a big shift towards with M-Shwari and those kind of on-the-fly products. And people were consuming a lot of credit, as you said rightly, for unproductive purposes. The question then now the policymakers are posing in front of them is, is it great to make all the products so frictionless, that it suddenly spikes up how you start interacting with those products? Okay. And that is, what we are all trying to question over here, that if we beyond the access and usage metrics, if we bring in the financial health or well-being metrics into it, is there are ways to, create better choices for customers, help them make better decisions in terms of how they need to, interact with the services, and, be better off for that matter. I'll give a case in point and pick from Abhishek's earlier point on UPI transaction going up and how it's easy to just do a transaction. And this was again speaking to a fellow banker just 4 days back. And they were saying that they have seen because of UPI, the consumption pattern has suddenly increased, but the disposable income hasn't increased. Okay, so that means people are consuming more because we have made system so frictionless, okay, that if the income is not increasing the same rate, then you are basically getting in a situation where you will again be stressed out on the financial health side in few months or years to come. Okay, so the question we need to all be asking ourselves is that you are right with all of the indicators, but while digital is a good tool, there doesn't need to be all frictionless in the same way. Okay, and can it be done a little different and better?
And maybe just to add there, I think, just to supplement what has been said by Jaspreet, I think we also have to be a little bit aware of the reality that last 2 years of COVID has taken out a lot of work which has been done by all of us over last 20 years, 30 years. We at Axion have been in this space for last 62 years, and there are numerous studies, Misha already talked about it. I think we feel the pain, the work with the progress which we have seen over 20, 30 years, all has been taken out. But at the same time, on the flip side or the positive side of it is, the digital side has enabled now us, it's the same consumer which we felt will not be taking any digital products is ready to do the things digitally. I keep on hearing from my microfinance partners that in the past, that the disbursements cannot happen digitally, collections cannot happen digitally. Now the same set of practitioners are telling us they are seeing digital collections in the range of 10% to 50% in a period of 2 years. And these are dramatic changes. So I could not have agreed more with Jaspreet that are there going to be some inherent challenges by making some of these frictionless, or is it going to shift the dimension because of the credit being higher than the economy or the income levels? Part of it, that income data has not been really realistically available. If I look at my microfinance partners, there was a ticking the box approach to find what is your income really. I do not know how many practitioners were literally really looking at, and Misha probably would vouch for it from the research approach side, that really looking at the household income level. So we do not know today that is it the 4 members, 5 members, 1 member working at the household level. What is happening now today with the digital footprints being created, we are starting to learn, okay, we will have the income side of data, we are starting to see the expense side of data. So I think we are in that evolution phase. My point is that we are in that evolution phase where there might be some course correction also because of this difference into the income equality and the credit demand side of it. But I think we got to see with that is still being played out.
Yeah. No, actually, one quick point, very eager to highlight to the audience as well as the panelists here. We, in the framework we propose, we're treating credit very differently. We're not including credit into the inputs part, because credit, we're treating it as a contextual factor. And we're asking how different is your financial well-being if you have a loan outstanding versus how different is your well-being if you do not have a loan outstanding. So we are quite keen to look at credit separately and treat it separately. So I'll wrap it up here. Thank you so much for your engagement, and thank you so much to all the panelists for your insights. I think we have a lot more questions, but we couldn't get through it. Really look forward to working with each and every one of you to operationalize the framework, not just us, but to build a consensus on what a best framework would look like. I think what I heard is a best framework would have both subjective and objective measures, and we need to make it cost effective. We need to build a business case for FSPs in bringing that up, and would really love to work with all of you on that. Thank you so much.
Misha, if you can allow me just to make one statement. I think it was the last slide, on the last slide, what Susan has wrote it out. India is a natural lab, and I think we all will agree with that, how we are evolving. And I think let's look at it, what the framework has been developed with the financial inclusion angle, and really given how the JAM Trinity, how the financial inclusion is happening, how we can take the approach of financial well-being together out there. Thank you very much for that.
Thank you very much, the esteemed panel. This was such an insightful conversation that we've gone a little ahead of our time. But as a token of appreciation from IFI Summit, once the panelists are stepping down, kindly take the pictures and the souvenirs that we are offering. We will now break for 5 minutes, and we can reconvene in this hall itself for the next session on affordable housing and finance. But I'd really like to thank all of you to be here. Thank you.
To thank each one of you for joining us this morning for this technical session 12, Affordable House Financing, Contours of the Growing Market. It is my pleasure to invite on the stage esteemed panel for this session. This session shall be moderated by Mr. Madhusudan Manan, Social Impact Entrepreneur. Hello, welcome. Have a seat, sir. Here. This one. Our second panelist, Vineet Chhetre, is not here, unfortunately, so we are unable to. He was unable to attend this meeting. However, Jay Shah will be the part of the same. He is the Chief Operating Officer of Swatantrata Microfinancing Corporation. Hello, sir. Now, our next panelist is Henrietta Isaac, Independent Consultant Housing. Henrietta. Mona Kachwa, Partner UC Empower. Anjali Tarapur, General Manager, HDFC Limited. Sandeep Menon, Founder and Managing Director, Vastu Housing Finance Corporation. Thank you all. Now I would like to hand over this session to Mr. Madhusudan Manan. Thank you.
Thank you, Anju. So good morning to all of you. It's my privilege and pleasure to be on this dais with two winners of the awards yesterday, Sandeep Menon and Anjali, both are award winners. So I'm sure they have a lot of... HDFC, that's what I said. Sorry. And Jayesh, who's on my left, has been a colleague and also a very keen participant in the affordable housing space for more than 3 decades now. And Henrietta, most of you know, was also part of the jury that we were all part of in selecting some of these housing finance companies for their performance. And Mona has also been a friend and an investor and a guide for many years in our own journey as a housing finance company. So I feel personally engaged in this conversation with all 5 of you. Thank you for being here. So I thought to make it a little bit different from a normal panel discussion where we go back and forth, I thought I'll start with maybe Sandeep, since you're sitting at the end. Let's start in order. So the format that we're going to try to follow is that Sandeep is going to introduce himself, his company, and his journey so far, and then maybe a couple of themes that we want to explore as a panel in terms of how to enable or, accelerate the pace of change in the affordable housing space. So I'll hand it over to Sandeep now. Please go ahead.
Thank you, Madhu. I think thank you for having me here. And I think just to give you my background, I have been a career banker for the last 6-7 years, actually 8+ years since we started working on this project. But since 2016, 15 end to 16, we started Vastu Housing Finance. I started this company along with my colleague Sujay Patil, who's sitting here. So between the two of us, when we set this up on this journey, I think we born in difficult macros, 50 crores a book, we had demonetization and then a series of events. But I guess we've been fortunate that we've had a lot of good opportunity in terms of having had access to capital, which this sector has benefited from significantly in the last 10 to 12 years. along with that, I guess the sheer under-penetration in the segment and the opportunity to actually build large retail lending businesses was really there. So when we set this out, I think it was just me and Sujay. Today we have 3,000 people. We have a loan book of 5,000 plus crores. We are present in 190 markets. We have an NBFC subsidiary. And one of the things that we've done is we've built all our technology, data science and analytics on our own. And that's something that's really worked for us. And along with that, one of the other things that we've done is we've pretty much so far stayed away from the apartment-led business and focused on self-construction and resale properties and the secondary market and focused on completed properties, so to say. So those are things that we really focused on. But in summary, what I would like to say is that, well, I think we've made a reasonably decent beginning. There is a massive opportunity for people like us and for many, many others to actually build large, long-term institutional businesses in affordable housing, and you can make significant, genuine impact. And this impact may not be in the top 10 markets in India or the top 20 markets. If you look at the market outstanding in mortgages today, the skew towards the top 10, 12 markets is significant. And that is where the real opportunity lies. So if you go beyond the 40 in the next 300 markets, and if you look at India and break up the top 125 districts which have grown by GDP, and look at, they would have grown at 20+%. There are another 200 districts which are growing significantly well at 10 to 12%. And there is genuine opportunity in each one of them, with land records the way they have got digitized, with the amount of government focus on whether it was the PMAY scheme or the PMI urban scheme, the state government schemes, and a lot of other activity that is happening. I truly believe that it's an immense opportunity for a lot of people to play their part in making sure that the market outstanding on, say, affordable housing goes up from, say, 1.5 lakh crore to maybe it could be as big as the mortgage outstanding, which could be 23, 24,000 lakh crores. So that's the kind of opportunity that we are talking about. And opportunity which is now in a largely credit-tested space for, say, 60 percentile of that population, with the bureaus being in India, and with all the stuff that's been done with UPI and digital payments and Aadhaar and everything else that the government is doing and all the new initiatives that are there. I think the bane of retail mortgages in the smaller ticket segments is high operational risk, highly intrusive lending, and very high on OPEX. And then you go to small towns and small markets, create small portfolios, you have a risk event, you have a market event, or you have people challenges, and then you're not able to execute. I think today the time has come for us to find delivery models and partnerships in different models to execute this and deliver this product in a far simpler and a more inclusive way. One of the things that's actually worked for us is that when we insisted that we need a woman co-borrower on each one of our loans. So earlier, by insistence, we got. And when we moved to the northern states, there was significant amount of resistance. But as I see in the last couple of years, actually women coming in as borrowers, and the government schemes have again helped there, has actually significantly increased. So I wouldn't say it will be like microfinance, but women ownership in a lot of states, in a lot of segments, is increasing significantly. And that gives you a lot of control and a lot more predictability of servicing the loans. And also we need to look at the fact that when you're betting on a self-employed Indian, 80% of our book is self-employed. These are customers, if they're basically putting up half the money, because our LTVs today and for most others in our areas will be 45-50%. You're betting on a self-employed Indian who's been in the same business, same city for 8 to 10 years or more. First generation, first house, 90% customers living in their houses. So the downside risk is very low. It's about scale, it's about execution, availability of liabilities, and to be consistent through the cycle and understand that this is a business that will take 10, 15 years to build. It's not something that you can do in 3 years or 4 years or 5 years. That's what I would say.
Thank you, Sandeep. Would you like to expand a little bit on what you talked about in terms of delivery models changing? Sorry. delivery models changing? Because, you know, I remember in my times in the affordable housing space, we used to go meet customers, decide, and there was only one standard way of delivery model. But we were already talking in those days about things like co-lending and, you know, also working with directly with micro finance companies or with banks directly as co-lenders. And is that taken off? Is it working? Is it not working? Or if it's not working, what can make it work?
So, Madhu, I'll answer this question in two parts. By delivery models changing, the way I would say this is that you have to understand that the delivery models for a lot of the market in the smaller towns is a people-first approach. So it's not about process, it's not about institutionalizing scale. For every problem, everything you put people. So you end up having 5,000 people, 6,000 people, 8,000 people. Looks good saying that it's a great franchise. We own all of it. But the operational risks and the market risk and the intrusiveness of the nature of the business where you have customer data available and information available for all of this, we still go and meet our customers physically. That's the way we still work. But I fear how long customer demands are changing. It's like a Nokia phone going out of fashion. So you'll never know how quickly some of these things can actually change. So do you really want to continue to be as intrusive as you are? Do you want to go and take a photograph of the customer in his residence, in his business premise, and take all those informal references and a variety of other things that have got this industry to this stage? So if I were to come in and build Vastu again, I think today, because of the data that's available, all the government data, all the alternate data, and if there is an interface that can be built between microfinance companies, affordable housing finance companies, and the MSME lenders, and I think a lot of stuff that government's already doing on some of these areas, and you can actually create the right dedupes, you can actually lend this pretty much on the phone for at least 50-60% of this population. And people who do this first will have significant scalable competitive advantage. Because otherwise in our current landscape, getting these businesses beyond 10-12,000 crores, 20,000 crores, without reinventing the model will be significantly different, challenging. That's what I would say. And in terms of co-lending, to answer the other part of your question, co-lending is taking off, but co-lending is again taking off in the prime segments. Because what's happening is the banks are still not interested in the small 10-12 lakh ticket sizes. While they will take it for PSL, they might rather buy a portfolio. And with the new norms on co-lending, it's pretty much like a portfolio buyout in the new model. So that will definitely take off. But whether the banks take interest in actually partnering and say, when I originate a customer, I put 20%, they put 80%, I think many banks still have a long way to go. And there are issues like multiple amort schedules, the taxation of it, the excess income spread passed through. A lot of these things still need clarity. So I think from our perspective, we have one co-lending partnership with ICICI Bank, which we have quietly tested. We have a full digital pipe into it. And I do believe that there is genuine opportunity to expand, because with the liability market still being very, very shallow, and I guess if there are another large number of companies to come in, the viability, the taxation, the scalability of co-lending is going to be very important, because you will get to a stage where, like the developed markets, people, the mid-sized NBFCs or the smaller NBFCs or HFCs will typically be the best-in-class originators, risk managers, and portfolio managers for these companies. And the banks and the larger financial institutions will need to warehouse. So if I see Vastu at, say, 50,000 crores, I might have a reasonably sized own book, but I will also have a managed AUM, which is the right way to go to balance your risk. Because you won't see companies going down on credit risk in this business, because effective credit cost could be 35 to 50, 60 basis points. It's the liability challenge that actually makes these entities go down or not scale and then lose investors' money. So the opportunity for the right partnerships in this ecosystem is significant. And I guess we're still maybe 3-4 years away for things to settle down, because the banks still have enough business. And there is no inherent need. They're still getting enough direct business. And there is also an ecosystem in the urban markets of the large DSAs, the corporate DSAs. You'll see people who originate large volumes of loans in the big markets. So that's easier for the banks to do. and own the customer directly. So I guess things are settling down. Things are much better on co-lending and partnerships than they were. And partnering with microfinance companies, I think, is a genuine opportunity, because now, as per the new regulations, microfinance NBFCs are allowed to do 25% of other products. And that's a genuine opportunity. So you could partner. I could never do the eastern markets potentially on our own, but with the right partner, it's a great opportunity to do. Similarly, there are many companies in the microfinance space where they have successfully delivered other products. I think HDFC, if I'm not wrong, Anjali can add, did a pilot many years back with SKS Microfinance, but I guess maybe it was earlier than time. But today, I think there are genuine opportunities to do many of this.
Yeah, I'm sure Jayesh can add to this conversation, because I know some time ago you did some partnerships with microfinance in terms of not exactly co-lending, but co-sourcing, let's say. Yeah. So would you like to add to what Sandeep was saying?
Sure. So we'd tried working with a microfinance company, we still do, in West Bengal. And these were deep rural houses and customers that we tried to doing. Now, the purpose of that experiment was twofold. One was try and see how this entire thing unfolds in the rural market. And the second thing was how would a partnership with a microfinance company work? I think we had a lot of learnings, though the numbers weren't significant to really talk about, but I think the learnings were significant. The number one learning was that these are customers who've been credit tested. They have already gone through 2 or 3 cycles of a microfinance loan. So they have that discipline of repayment. Second, sourcing ourselves in those markets would have been very difficult and very, very expensive. And these are customers who have a relationship with that microfinance company, which also, I think, plays a very significant role in the entire credit assessment. The problem is that the microfinance companies have a different approach, and for them, this is an additional 1+ thing. So unless they see this as a big opportunity for their, in their revenue model, and they see significant this thing coming from it, they're not very keen on looking at it very aggressively. And the microfinance business itself has been growing at a rapid pace. So for them to focus on this actually becomes difficult. But if we can have some similar partnerships going, I think it's a great opportunity.
Yeah, thank you. Henrietta, would you like to add to this, because you have also wealth of experience working with MFIs?
Check. Yeah, thank you, Madhu. Okay, so I'm an independent consultant at the moment, and my experience really comes from working with Habitat for Humanity. Habitat won a USAID grant in 2009 to promote housing microfinance in the country, and with their experience from across the world, we were able to bring in a lot of best practice into the country. And in I think 2011, we were also contracted by IFC to develop a toolkit for housing microfinance and micro mortgage to help institutions get into, to be able to develop products. And Ujivan was there. Swatantra at the time as a microfinance company, they were the first institution we worked with offering technical assistance. So I really got a ringside view of how sort of affordable housing took off from there. So the kind of ticket sizes we're talking about in housing microfinance is really low, 50,000 to 1,50,000 for small home improvements. And these are clients with a limited repayment capacity, with some experience in borrowing from the microfinance institution. And like you rightly mentioned, the relationship is a big part of what makes that repayment happen. And what we saw as challenges with that the microfinance institutions were facing was, one, in terms of funding, because these loans, because they are not collateralized, they cannot be refinanced. NHB does not refinance them. And this mindset change has to happen among the MFI staff. They are so used to this group guarantee, lending in groups. So there's no proper cash flow analysis that takes place, while these housing home improvement loans are really individual loans. So there has to be a different team that might need to be brought in, and that paradigm shift has to take place in the heads of the staff, really. And that is where the technical assistance was helping. And also some level of awareness among the clients to help them utilize a loan properly. For instance, Habitat does what is called housing support services, where they come up with the estimation, a plan. So the client is able to utilize the loan well, in the sense that they do not overshoot what they're borrowing. Sometimes they end up borrowing in multiple sources. So that is one thing, but a lot of these can be solved if there is co-lending that can take place. And I was at a session yesterday where they're talking about how trust is very important in a co-lending model. While banks seem comfortable doing BC models, co-lending is slightly more sort of a closer engagement, and that might need more trust that has to come in. But we will, it'll be wonderful to see people reach deeper down into the market, and it's lovely to see HFCs really making that effort. Thank you.
Thank you, Henrietta. Anjali, would you like to add something? Because I know HDFC has worked very closely with a lot of HFCs. And how come HDFC never viewed those HFCs as, I know their scales are different, but didn't view it as competition, but as an enabler of financing for affordable homes?
Thanks, Madhu, and it's a great pleasure to be here at the Inclusive Finance Summit, especially to represent HDFC, because very often we're viewed as this huge looming financial conglomerate, but the truth is affordable housing is something that is very much part of our journey. And I'm just going to take a few minutes just to trace out what HDFC, everybody knows that we are the pioneers of housing finance. But when we started out in 1977, there was a lot of skepticism, and it was started out really as a startup. The only difference is today startups you see are younger people. It was started by a person, Mr. H.T. Parekh, but it was as a post-retirement venture. It was in 1977, this venture was looked at with a lot of skepticism. People said, nobody has ever lent to individuals for their housing, will they pay you back? Then they said housing finance requires long-term money. There's no, at that time in India, there was absolutely no access to long-term funding. And the third thing was there were no foreclosure laws. So they said, how are you going to ever recover? We spent almost about 25 years of our journey without any foreclosure laws. But be that as it may, we recognized the need for housing was dire. It continues to remain dire. We recognize that at that point in time, we had no model to emulate, so we adopted a learning by doing model. But over time, we realized that we can't do it ourselves. And that's when sometime towards the 1980s, we actually promoted competition. So we set up 3 housing finance companies, which was GIC, Canfin Homes, and SBI Homes, which was a subsidiary of SBI in those days, and the first rural housing finance company. We've even helped set up the regulator. The whole point is you can't work in isolation in this field of housing, given the fact that, the housing there's such an extreme shortage of housing. But let's cut to 45 years later. Where are we? We have about a 7 lakh crore balance sheet size, about 10 million cumulative housing units financed, and you still see that we've barely scratched the surface. I mean, when you look at a mortgage to GDP ratio in India at just about 11%, you look at comparable countries that all have it in the range of 20%, we know there's so much work left ahead to be done. I'm just going to spend just 2 more minutes just talking about the importance today. Everybody's talking about ESG, environmental, social, and governance. And one of the things that we all need to recognize is that in the affordable housing finance space, there's such a close, natural fit with the whole philosophy of ESG. We all know that housing finance fulfills a huge social obligation. The factors that one needs to look at is, are you able to provide housing finance solutions across all income segments? When Sandeep mentioned about, having women as home borrowers, why is it important? It's important because we need to recognize women's property rights, and that's, as owners of those properties, we are recognizing those rights. are we able to, we need to be looking at just not urban housing, but rural housing finance demands are also very large in the country. The other aspect when you look at ESG is, are you aligning with the government's vision as well? And a lot of us over here have been able to work with the government on their flagship housing program, which was the PMAY, which is the CLSS. The last bit is on the E side, which is a new and emerging area. Climate action is going to become increasingly important, irrespective of what kind of level of lending we are doing. In India right now, less than 5% of residential homes are categorized as green. We're off a very, very small base, but going forward, this is the way forward. We will have to incorporate a lot more of sustainability into construction and into financing. And one may think that, you know, your role of climate in a lending business doesn't happen, but the world is moving forward to say that every lender will now also need to measure their financed emissions, which means for every loan you give, what is the kind of carbon footprint that you're entering. So it's a huge space available, but suffice to say that I think we are all on a good platform. There's enough scope for more and more lenders to come in, as long as we have rational lenders and as long as lenders are willing to share, as you know, Sandeep had also mentioned, learn from each other. When HDFC partnered and gave funding lines to some of the smaller affordable housing finance companies, it wasn't because we had the liquidity available. It was because we realized that, you know, there are new ways of assessing incomes, there are new ways of looking at affordable housing finance, and it was a learning journey for us as well. So that journey will continue even in our new avatar as we move towards a much larger bank. But the journey through affordable housing in India is very exciting at this moment. But, you know, we have to take the challenges as they come along, all knowing that ultimately for a country like India, there can be nothing better than working towards building a property owning democracy. And I think all of us in this room have and share that common objective. Thank you.
Thank you, Anjali. I want to move on to you, Mona, because, you know, you come with an array of skills and experiences in the sense that you run a mortgage department for a large multinational bank. You have been an impact investor in some of these affordable housing finance companies. And you also run one of them, if I remember right, for a brief period of time. So, you know, in your experience, I mean, are you seeing change, first of all, and are you seeing change in the right direction? Are there any thoughts that you have on how we can accelerate this change to make it more productive and more active?
Thanks, Madhu, and it's a pleasure to be here. Really inspiring to hear all my fellow panelists talk about their work and perspective on this. Madhu, I'll address 2 points, if I may. One is the opportunity itself and the change that people like us would like to see happen. The opportunity, as I think Sandeep also mentioned, is huge. You know, I think some of us who have stayed in this space, very close to the space over the last 15 years or so, that affordable housing has come into focus, we feel that a lot has happened, which it has. And, you know, there are a lot of companies already, but if you look at any measure of how much work has happened, while it is motivating and very positive, we are only just scratching the surface. And dipping into my experience of how scaling up of inclusive financial services across, you know, other adjacent areas have happened, I would tend to think we need many more institutions than we do today that are specialized and focused on affordable housing. Although every company that there is today has an equal opportunity also to scale up to, like, you know, 10, 20 times the size they are today. So the journey from, in my view, and based on what I've read, about 2 lakh crore of AUM of affordable housing finance as of a recent date will entail, and to get to a decent size, I think we are just around 10% or 12% of the total AUM of all housing finance at that level. So to get to 10% or whatever the increased denominator is to at least 50% of affordable housing will take both in current institutions, big and small, and many more new institutions to be set up. So that's as far as the opportunity is concerned. But as far as the future and the change, etc. Again, I'll just point out one slightly troubling aspect, because I think we've talked a lot about the positives of which I agree on everything. Every time we have a little bit of a headwind affecting the operations of financial institutions, affordable housing finance in this case, the market segment that tends to get defocused or tends to get less capital flows to is the weakest one, or the perceived weakest one. So even the same thing happened in the pandemic, the same thing happened, I would say, during the liquidity crunch of 2018, 2019, where there were ALM issues, led liquidity issues. So the lowest ticket size gets lesser flow. And even though post-pandemic numbers, when you see on credit performance, across income segments, across loan segments, loan amount segments, housing finance has performed the best in terms of overdues, NPAs, recoveries, etc., etc. All credit parameters. But when you look through the data within housing finance, the low-ticket customers have got less loans than they did pre-pandemic. And it will take us some time to get back to the normal levels. Probably already has happened. So we need to keep this in mind when we are looking at policies, when we're looking at from a government perspective. And so the continuance of policies and incentives to the industry to continue to focus on the most challenged part of the income pyramid in our customer set is very, very important. Market responds for a reason in a certain way. And so the task with the government, with the regulators, is to come and sort of bolster the risks and take some of the risk away from the market operators. As far as the change, wearing my investor hat, when I compare with the conversations we have with startups today in housing finance, companies versus, the previous generation of companies who have done so fantastically well, I'm very motivated and very happy to see the differences that are coming in today and the change that we are seeing today, which is about, so if we look at very clinically the two sides of the balance sheet, on the supply side, I think as Sandeep also mentioned, the whole long-term funding, etc. I think that part needs to be deepened and bolstered some more. But on the delivery side, on the credit fulfillment side, it's the removal of friction, which is what a lot of the new age housing finance company entrepreneurs are very, very focused on. And as I'm sure the existing companies are as well. So it's very normal for an Indian going out to get a housing loan, especially if you are doing it for the first time, for the first house, typically from an informal income background or semi-formal income background, to wait for 25 days for anything to really happen. So removing the friction there is super important for us to really power through the next phase of growth, because there is, I think all data now tells us that, and to Anjali's point, when HDFC started, I think just borrowing itself was a novelty, and borrowing for such an asset class was an even bigger novelty among the Indian population. 15 years back, when MHFC and other pioneers in the housing finance space started, for the low-income customer segment, borrowing for 15 years was the novelty, right? And against a asset like housing, etc. So there were many barriers that have been broken over time. Today, none of that is a novelty. What we need to understand, based on the data that we've got from the work that everyone has done, the 2 lakh crore of AUM is showing us, is that the customer pays. Now, whether you have a completely to the T kind of a property title, approved plans and blah, 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 that the regulation requires, or not. So we have to understand, we have to take the learnings on board and be creative about how we get from 25 days turnaround to, something reasonable, 4-5 days turnaround in the digitized world. We have to get to, okay, it's easy to work in a Jaipur, but is it equally easy to work in Jhunjhunu? That mindset. So, yeah, I think, so as an investor in the space, that's the progression I would like to make in my journey, which is to look for this change, look for this dramatic change that the digital work environment affords us today, which it didn't 15 years ago.
Yeah, I just want to add to what you were saying, Mona. I think, in my own experience, again, I generally always felt that in a housing finance company, the risks are on the liability side more than on the asset side. And on the liability side, I want to understand from people who are actually in the field whether anything has changed on that side in terms of more liquidity being available, more long-term resources being made available, whether from the NHB or from commercial banks or from government sources, whatever. I know some things have happened, but is it enough or is it too little, too late?
Would you like to go first? Sure. Thanks, Madhu. So let me step back and give a brief introduction on MHFC. Swatantra's journey started in 2009, and we've been completely focused on affordable, but we define affordable a little differently. I would say EWS and LIG is a better word than an affordable housing finance company. We are purely an EWS LIG housing finance company. And for many years initially, on the liability side, the refinance from NHB used to be a significant portion of our total money that was raised. That is changing now. We now have a lot of banks, private sector and public sector banks, who are now willing to look at this asset class, look at these customers and lend to us. Though NHB still remains a significant lender. And there's distinct advantages of NHB because they also have very specialized funds like the Affordable Housing Fund and AHF and all that, which actually really makes the loan affordable to absolutely the bottom of the pyramid customers where the incomes are less than 3 lakhs per annum. But yes, to answer your question, there has been a significant change. I agree with a lot of things that Mona said, and it was really music to my ears when she said that. The focus, we've scratched in terms of the market size and all that. We just scratched the surface, and the biggest opportunity which why there's not been much of penetration is that this segment of EWS and LIG actually falls in a no man's land. It's beyond the reach of a microfinance company because typically a housing loan would require at least about 2.5 to 3 lakhs to construct a house. And thus beyond the reach of a microfinance companies at the tenors and the rate of interest that they give to give these kind of loans. It also falls short of a typical housing finance companies because to service and source loans of 2 and 2.5 lakhs becomes very expensive. And especially means, since most of the housing finance companies are very growth oriented and they have the sales, sales force which are incentivized on the disbursements, it becomes very difficult for them, or there's very little incentive for them to go and source a 2 lakh rupee loan, where with the same efforts they can probably go and source a 20 lakh rupee loan and therefore earn a lot more incentive on that 20 lakh rupee loan. So companies like us who are focused on this EWS LIG segment will have to develop a different kind of a model, will have to see what really excites not only of course the business model, but also our entire team in terms of how do they really motivated to go and serve this customer. as far as the asset quality and the repayment is concerned, I think probably they're one of the best segments. I mean, we've done loans, and when we look at our, analytics and see that the loans of less than 5 lakhs, which is typically the EWS LIG customers, have been performing the best. And that's where the maximum scope is. That's where the biggest market is. Of course, there are enough scopes in 10 lakhs and 20 lakhs and 25 lakhs loans also. But there are a lot of players and there are a lot of banks who are already servicing that client. It is this particular segment, which is less than 10 lakhs or sub 10 lakhs, which has the maximum demands and very few really, institutions looking at that segment aggressively. Banks and lenders also, unfortunately, look at the entire housing finance stack as in the same lens as in terms of the regulation, in terms of their refinance, risks that they look at, which also needs to change a little. Like Mona mentioned, that we need to look at this segment a little differently. They have a different characteristics. They have a different risk profile. In our experience at Swatantra, one of the biggest challenges in housing finance today is frauds and, imperfect, basically frauds at different levels. We haven't seen a single case of a fraud. These are customers who are first to credit. They're genuine customers who, are very aspirational, need that house. So that risk part is very different in these customers. They probably might have cash flow variations, but they're not consistent. I mean, they probably might miss two or three installments, but they bounce back. We've seen that happen post the pandemic as well. We restructured loans today. More than 70-80% of our restructured loans are, non-delinquent. They come back and, started paying us regularly, which itself shows the resilience that is there. So how do we address this? How do we reach out to these segments? I think that's the biggest challenge. How do we reach out to these customers? They don't even know there's an opportunity for them to actually build a house. And for institutions, the reach is difficult. And that's how I think what Sandeep mentioned, collaboration, I think, is the way forward. I think we need to collaborate. Housing finance companies need to collaborate with different microfinance companies, NGOs, to see how we can actually reach out to these customers and make our sourcing model easier, because they already companies or organizations working with them. If they can actually source, bringing down the sourcing cost for housing finance companies, because the OPEX is really the challenge, reaching out and servicing these small ticket size loans. So maybe a combination of all these factors is, I think, probably the way forward.
Thanks, Jayesh. Again, coming back to you, Anjali, I know that HDFC has been one of the pioneers, not just in lending for housing, but also in terms of how they manage the left side of the balance sheet or the liability side of the balance sheet. A very diversified kind of borrowing base, starting from retail to very institutional to foreign currency. I think everything that moves is on your balance sheet on the left side. So, I want to understand how you manage those risks, and do you see that helping in any way for the affordable housing space? I know when you have such a large balance sheet, it's much easier to do, but some of those skills and some of those benefits that you get from having that wide portfolio would translate into great benefits for the affordable housing sector also. How do we make that happen?
Sure. Madhu, the way I would put it is that irrespective of what size your balance sheet is, the real challenge is not, as you also rightly pointed out, it's not on the asset side. The asset side, there's so much demand. The real challenge of scale comes on the liability side. Now, what sometimes I think the regulators don't always get is that the NBFC lending is different compared to the bank lending. But what happens is, if you have a couple of bad apples in the cart, the regulators have no choice but to come and tighten regulation. And I think that has definitely played out in the NBFC market. The regulators has come in quite strongly. You are needing to maintain a larger amount of liquidity on your balance sheet. And we are not like banks. We don't have the access to the low-cost funding from the current and savings accounts that banks have. That puts us on an uneven platform. But the real solution for affordable housing finance companies over a longer time is to have created that deep secondary trading market. So what we have today are still bilateral transactions happening. A bank runs short of priority sector loans and does a loan assignment or takes on the loans. The NBFCs have strength of loan origination. That should really be the focus. And if we have a really deeper and active securitization market that is constantly trading, then on the NBFCs needing to constantly raise resources, constantly raise capital, that comes down a lot more. But for that, we've been talking 20 years about deepening the securitization market. You would know better. We've been talking about 40 years of deepening the debt market. Some of it is a little slow on the uptake. Thanks.
It doesn't happen as often and as deeply and as frequently as it should. But Sandeep, you've done some securitization, right? Or bond issues against your portfolio.
So Madhu, the way I would say this is that, see, there is enough opportunity to broaden the debt market. But acceptance of a new entrant is very, very difficult. And as I think Anjali rightly said, if there are a couple of bad examples, which will always be there in a ecosystem like India, the challenges that you understand that this lending is different is very hard for people to get. So while on the one side, the regulators are doing what they're doing absolutely rightly so, and it's only the survival of the fittest on that end. But on the other side, from the lending community, the differentiation between, so PSL is a very broad term, but to say that, as I think Jayesh rightly said, you can have an affordable house in Delhi and Bombay, which could be 70 lakhs or 1 crore. But the real EWS or the lower, the real people where this 2 lakh crore is going to go to 20 lakh crore is absolutely the bottom or a couple of levels above the bottom of the pyramid. And for that, you need sustainable long-term financing. Because for people who do 8 lakh ticket sizes, 10 lakh ticket sizes, even if you get borrowing, which is 6 to 7 years, if I were to say match it with the actuarial life, that's already happening. But the smaller ticket customers will stay longer on your balance sheet. You need longer term financing. And this is not a business where you say, because this customer is small ticket, he's subprime. Small ticket and subprime are two very distinct things. If, for example, you do not have a credit history, doesn't make that first-time borrower a subprime borrower. A informal segment income customer could in India be far more predictable than a service industry customer who can lose his job tomorrow. You look at what's happening to all the startup employees in so many startups. I read about a company laying off 70% of its people, and you've seen so many of them. But somebody who's running a small, say, welding shop in a small place in Ongole in Andhra Pradesh, or someone who's doing something in, say, Brahmpur in Orissa. These are people who've been there doing it for first and second generations. So, as I think Jayesh said, maybe they might delay once in a while, but nothing much is going to happen to that segment. So, for the banks to actually give you long-term financing at sensible terms for you to pass it on will actually genuinely deepen the entire ecosystem. And these segments need to be lent to differently, also priced differently, because these are not the emerging affluent also. These are people for whom that house is very important, but their incomes are not going to double or triple. So you get to a stage in the economy where after a certain stage, that journey between emerging affluent and affluent becomes easier. And their appetite for borrowing is also very high. So if you look at velocity of borrowing and recency of borrowing as two benchmarks from the Bureau, you'll actually find a set of customers who have 20 trade lines, 25 trade lines, 30 trade lines. And I'm not talking about microfinance customers or loan against gold customers. These are customers who live on retail borrowings. And they are all in the large urban agglomerations and the emerging next 20, 30 cities. But the customers that say Swatantra has or many others have are not in any debt trap. They are customers who are safe, stable. And if you dissect most of this 2 lakh crore book into segments below 5 to 7 lakh and 7 to 20 lakh, and then you say the above 20 lakh, the behavior post-COVID will be drastically different. Because post-COVID, the bigger ticket customers who had access to more velocity of borrowing have done well. And people who are staying in their houses would have done well. But the people who have suffered are the people who have paid you back. It's actually, except for migrants who would have lost their jobs in a couple of markets and gone back to their villages, a large part of the smaller ticket customers have come back and paid you all. So if you ask me about our restructured loans, we would have build our restructured loans now for 9 to 10 months. And I think we have similar numbers in terms of 80+% of our customers pretty much back on track. And we did 3-month and 6-month restructuring for around 450, 500 accounts. And the integrity of the smaller customers is far, far higher. So the ecosystem has actually made them suffer post-COVID. So post-COVID, the number of the smaller ticket borrowers is honestly far lower. So to address this, so I'll tell you, and the other point, I think Jayesh again made that point, I'm repeating it, is that you can't have the same salespeople or the same distribution sourcing a 10 lakh rupee loan or a 20 lakh rupee loan and a 5 lakh rupee loan. So I was always believing that the same people could do everything, because I, for a long time, believed that I could do what I did in a bank outside, and maybe that's not the right thing to do. So over the last 3 years, we've looked at this space very carefully. Last 1 year, we have actually put together 300 people to actually build a micro housing business. And when you look at ROA or ROE or break-evens or branch profitability, many other things, this business will take a lot more time. But it's absolutely the right thing to do. And if you have cost of fund access, and if you are able to actually drop 150 basis points or 200 basis points, you will get a lot of these customers who today have no choice but to wait for 20-25 days and borrow as MSME or anything else, or from the informal market. So that opportunity is very significant. And if long-term debt is available, it really helps. So I'll tell you, for example, Anjali's here, and when we started, we had HDFC Limited as our day one lender. We had HDFC Limited, HDFC Bank, Sundaram Finance, and DCB Bank giving us money day one. We were fortunate, we got these 4 great institutions to give us money, so everybody else gave us money. But for a lot of people who really want to do this, they don't get this support. And then those businesses don't take off. And then there is so much grief and so much anxiety. And for every failed business or about to fail business, there is so much anxiety from the capital providers, rightly so, that they are very, very skeptical whether the opportunity is come and gone, whether more capital, whether it's going to sustain, whether banks are going to come and take over or not. So I think patient capital businesses with support is very, very important. So I think we have been fortunate that we've gone back to people like HDFC and many others, and they have guided us on what not to do and shared learnings. Jayesh, again, I think whenever I meet him, we pick up something. So it's important for that ecosystem to come together, because if you get the next 10 companies to really do well and have a long-term patient view that this will take 10, 15 years and the opportunity could be 30, 40 years. And if the market outstanding grows from 20 lakh crores or 22 lakh crores to wherever it goes to, affordable housing has a genuine opportunity to be 30, 40% or 50% of the market outstanding. That's the opportunity.
Yeah, I mean, I can see that in the sense that, we are all agreeing that, the asset quality in this segment is pretty good. I've seen tremendous innovation happening in the terms of delivery mechanisms, in terms of customer acquisition, customer retention, customer servicing. However, I don't see the same pace of innovation happening on the liability side, which is my question. That, why is it that, we can't figure out a better way of making cheaper resources available on the liability side? Where I know NHB is doing a fantastic job in terms of, but it's one small portion, and most smaller affordable companies run the risk of being too dependent on a single source. So it's important to diversify the sources of financing. It's also important to keep the prices low, access to maybe even FCB markets, access to domestic bond markets. I mean, these are things that we've been talking about for last 15 years, 20 years, but we just don't seem to be able to make that happen, the same pace of innovation that you see on the asset side,
So, Madhu,
which troubles me.
One point that I would make is that essentially it is a question of there is no initiative for the lender to do this. There's absolutely, so whether if it is ESG mandated or something else, then there is an initiative. So if there is an opportunity for lenders to go and give money to potentially safer segments, then they don't want to actually take that incremental risk. And if they want to take that risk, they want to price it and structure it in such a way that it is unviable to execute and benefit the bottom borrower. And the amounts are small. And when the amounts are small, rightly so in the early days, everybody follows the same thing. So unless you are mentally ready that, and have the capability to take in deep slugs of capital early, and don't worry about, say, how much money we will make or what valuation we will get, because institutional makeups are important. If you are willing to be institutional in your makeup and see through the first couple of years and have patient capital providers, then I think the debt play will sort itself out. And the multilaterals and the others are now sincerely taking an active interest, but their time to market is very slow. The challenge is you have to engage with them for a year and a half for you to get something meaningful. And unless you are at a certain credit rating, even they want to price for all the risks, and the margins and the terms are tough. So I guess it is a bit important that some large institutional lenders and the banks, and not just the public sector, the private sector, plays its part, because they all have their PSL targets, and the government can also do something to make sure that it's not just a broad brush mandate, but a specific segment-led mandate.
Yeah, Anjali, do you want to add to that? Because, you've done that journey already. Please go ahead,
I totally agree with what Sandeep's saying. I think from my vantage point, I see a lot of the focus in the recent few years going a lot more towards the MSME lending segment. I'm talking about the sort of government support programs and of also the development financial institutions of the country and overseas. A lot of support seems to be from the liability side, seems to be focused on that, which is good. But perhaps there is a perception that NHB is there and NHB has done the good work and the market is moving in for the rest of it. So a refocus on that question, whether we need another pool of capital which supplements what NHB does and initiates, is possibly the need here.
As far as I know, even NHB themselves do not do more than a certain proportion of your liabilities.
Yeah.
So you have no choice. You have to diversify on your liabilities side, and you're kind of restricted because there are a few commercial banks who are doing it purely for priority sector needs. And there's not, I'm not aware of a single foreign bank which is lending to any affordable housing finance company, though I cannot understand why, because they also need priority sector. And there is hardly anybody who's actually done a bond issue. Based on the quality of the portfolio, rated quality of portfolio, but it's just not there.
And if you juxtapose this, what we are seeing in our respective, work, with the intent of the government to take the PMAY target from 10 million to 30 million homes by 2024, that's going to require a lot of this capital, extra capital to come in.
Anjali, tell us how you got there.
The way we got there, the reality was in 1991, we actually printed out ads to say we've got so many customers, and this was at the time of the economic crisis, the first time, just before liberalization. We actually printed out ads which says that, thank you for your interest, we've got lots of customers, but we're going to actually close. We almost thought we couldn't incrementally take on any more borrowers because we didn't have fund. And Jayesh, you would be there at that point in time. But fortunately, we recognized that what we did is we went on to the retail deposits, and at that point in time, the regulations allowed you to take retail money. Now, every time we've had a financial crisis, which comes to us almost every decade and a half at least, retail money is sticky money. It stays with you. It's a little higher cost funding initially, but it stays. But the problem again is that the public has been so badly shortchanged earlier in the 1980s, 1990s with, you know, all those NBFCs mushrooming, taking public deposits, that the regulators have just clamped down totally. So today, not a single NBFC over the past, I think, 10, 12, must be more than 15 years now, has been allowed to raise public deposits. But the savior was public deposits, which is coming back to the point of irrespective of the balance sheet size, we all have common problems. But one thing we have to appreciate that the PMAY scheme is a success. It was a success. We understand that fiscal resources are limited, but the model that came through, for instance, the credit-linked subsidy scheme, I think that really worked well. And maybe, Henrietta, you might want to also talk about the other scheme of the PMAY also, you know, because it is something that has worked well.
Maybe Jayesh can talk more about it, but what I can say is that Habitat has been looking for financial institutions who will do the gap funding, because the subsidy itself, the BLC piece of it, is not sufficient to build a house. So Habitat has partnered with Swatantra in Odisha particularly, and they've been able to do a good number of loans, and these clients have been able to repay. That brings down the EMI that the clients have to repay, the subsidy coming in. And with the housing support services that Habitat provides in terms of coming up with the estimate, the plan, linkages with the government, and with all of that support, the clients have been able to access the PMAY scheme and build houses using that. And maybe Jayesh can talk more about that.
Yeah, on the PMAY, I mean, there have been three verticals which have been mostly talked about, and the one which has been most talked about is the CLSS, which in the EWS LIG segment has made a huge impact. So there were certain houses which the government constructed under the AHP vertical, but that supply was limited. So because of the CLSS, there were a lot of private sector builders who actually got into construction of houses which were, you know, costing less than 20 lakhs, 15 lakhs. And they were with a, you know, some houses, the normal average cost of a EWR house in the private sector was about 8 lakhs or 9 lakhs. Now, with that kind of costing, the average loans were about 6.5, 7 lakhs. And at a 6.5, 7 lakh rupee loan with a 2,60,000 subsidy coming in, it was very, very affordable for these customers. And a lot of these customers would have probably never been able to afford a house had it not been for the CLSS subsidy. Having said that, the other vertical which Henrietta mentioned is the BLC vertical, where where also the PMAY subsidy has been very, very effective. For example, the Orissa pilot that we have been doing with the Habitat for Humanities is where typically house construction cost is about 4.5 lakhs. There's a 2 lakh rupee subsidy from the center and the state. So the remaining 2.5 lakhs, out of the remaining 2.5 lakhs, 50,000 is what the customer contributes. And the average loan ticket size is 2 lakhs. Now the biggest risk and the challenge for a housing finance company in a self-construction is to get the right estimate and then monitor the construction so that it doesn't deviate from the initial estimate. And that's where Habitat's technical assistant comes in, where they monitor the construction, ensures that the construction is, you know, as per plan, there are no cost escalations, and we do the gap funding of 2 lakhs. And it's worked really well. These are customers who are fishermen, you know, selling shells on the, you know, beaches. So really, really the bottom of the pyramid kind of customers. And the repayments have been good. The house conditions have changed, you know, drastically. These were all people staying in thatched houses which get blown away every time there's a cyclone, and now they have proper, you know, houses to live in. So definitely PMAY has made a huge impact. And even the AHP vertical, which is not very often talked about, they have some, you know, how many lakh houses, we keep hearing those huge numbers across all the states. And there are very few EWS houses where allotments have been made, they have been completely funded, and they have actually been occupied. And the only reason why that's not happened is there's not enough finance available for these customers to actually go and make the payments for the allotments of the allotted houses. So both these AHP and the BLC verticals have been extended till 24 for them to get completed, and hopefully enable people to do that. But the impact has been definitely significant.
That's good to hear. I thought, we've got a few more minutes, unless any of you have any closing comments to make. Otherwise, we are open to take any questions. If anybody has any questions to any of the panelists, we can try and, to the extent possible, answer them. Otherwise, lunch awaits.
Sorry, can I just say one thing?
Yeah, please.
I'll be remiss if I did not talk about the kind of impact this can have in the life of a family that does not own a proper home. And I've spoken to these women, particularly women, the security that comes with a house, the dignity it gives them. And women, I've heard them talk about how in their kacha houses, if they saw strangers wandering in the area, they would not be able to sleep the whole night. They'd be awake, wondering, who it might be, and especially if they had girl children. And they talked about how their life, the quality of their life changed entirely with a Paka house. And they say now I can sleep at night. Now I have peace. So that is really why we're all here, I think. And yeah, that's something I wanted to bring to your mind. Thank you.
Thank you.
Am I audible? Yeah, I have a question for Anjali ma'am. Basically, I wanted to check, post the merger, how are you envisaging your journey forward, and what is in the store for smaller affordable housing companies in terms of partnerships going forward?
Gosh, I feel now I'm back again in an investor conference than anywhere else. No, the idea is really to benefit on the larger distribution that there is within the bank and the access to lower cost funding. So the commitment to affordable housing, the commitment to the housing finance space remains absolutely resolute.
Hi, Devdut from Axion. I had a question on informal titles. Just wanted to understand that, do you see any movement towards institutions funding properties with less formal or informal titles? Do you see any development on that?
Sandeep, you want to go? Okay, sure. Well, what is an informal title and what is a formal title? I think that there's no clarity there. For a person, whatever we call it as an informal title, say a patta, for him, that's the document he has. And that's as valuable for him that as much as probably for me my, a proper registered sale deed is. So the informal title, as far as the customer is concerned, there's no differentiation really. The challenge is in the refinance. I mean, as far as the credit, as a housing finance company, as a credit, the credit of the customer, whether he's going to repay the loan on time or not, is not going to be dependent on what kind of, document he has. It's basically going to be on his cash flows, the need for the house, his own equity in the house, and various other lot of factors. So the question about informal and formal title comes in and becomes important when we actually try to raise money and get a refinance against these kind of loans. And that's what we've been trying to talk to the banks, regulators and all that we need to define that and look at it a little more realistically. If we were to do EWS LIG housing, there will be, like Mona said, not going to be a perfect title possible every time. And we have to define what is acceptable and what is not acceptable, and how is that going to really, get covered into, increase or decrease the risk of the portfolio or the loans that we are doing. And now we have sufficient history and track records of these loans, and probably it's time to look at it again without the initial biases that we have on informal and formal titles.
Anybody has thoughts on that? Because this is something that we constantly debate, right? Informal, formal. I think Henrietta,
So there have been institutions that have lent using a document from the Gram Panchayat, which states who owns the house, and based on that, and then hypothecating that. There have also been instances where you can apparently create a document an occupancy document, again with the local government authority, stating the borders and that this person has occupied it for so many years, and so now it belongs to them, and then hypothecate that. So those things are possible to do. And in case of, I think, Swatantra, they have used an LRC, which is the ownership document that the Odisha government gives. This is not transferable, but it still proves ownership, and that is what they are happy to look at. So these are different methods that affordable housing companies do.
Yeah, just to add to that, a lot depends on the state government and the state government policies. At one level, and secondly, how are these policies actually, downloaded to the local bodies? Like the Orissa example, under the Jaga mission, they have probably issued more 6 lakh land rights certificates. Now, these are not title documents, but the land rights certificates where they can, the plots have been very clearly earmarked. There are rights to use them, which are not transferable. Transferable can go to the next generation, but they can't sell that based on the land rights certificate. But these documents are mortgageable, so they can raise money for them, for construction of a house. So these kind of innovative initiatives by state governments and all that, I think, can help.
Even simple things like reducing the cost of registration of property. And I think Jharkhand for a few years had a registration fee of only 2 rupees if it was in the name of the woman. That has changed now, but if you can reduce the cost of registration, then that encourages people to register their document, and then everything becomes more transparent. Sorry, somebody had a question.
My name is Raghavan. I used to work for a microfinance company. The regulations in terms of every state governments have regulations in terms of town planning authorities and all those kind of stuff, and there's a lot of difficulty in getting a plan even before I apply. If household has some 200 square feet or 300 square feet, and getting a town planning and house plan becomes extremely important, which is very important to apply or get a loan. And how does the housing finance company, especially this segment, navigate this issue, or do you find any issues in that?
I think very valid question, and truthfully, there is no perfect way to navigate it. What a lot of housing finance companies do is to tell the customer that if you need a loan, you please go get this plan done, get it certified. That is the only way we can give you a loan.
Something that I have seen in some cases is that where either if the title is not perfect, in the classical sense of the word, and requirements such as approved plan is not there, what the customer ends up doing is financing the construction or the purchase through other means, and then comes back and takes a loan, like a home equity loan of some kind or a home loan, to replace that interim bridge financing. And the interesting thing is that at least where I've had the opportunity to see the performance of these portfolios, there's really almost no difference between a pure home loan done in the right order, or this sort of a refinancing kind of options that the customers take post facto. So that is also a reason for us to rethink this whole approach towards title and approved building plans, especially for small ticket loans.
The issue, I'll just take a few seconds because I just wanted to kind of look at these challenges that the segment takes. Now, if you look at last 6 to 7 years, the loan against property between a ticket size of 2 to 5 lakhs is growing at a very breakneck speed. And on in-depth analysis of these clients, we find close to 30% of it goes to housing because of the complicated, plan and all those kind of things. But what they lose out is on the interest rates. That's as good as 22 to 24%. If it is housing one, it becomes eligible for a pretty far more discounts and a cheaper rate of interest. So I'm just trying to see, is there any advocacy where, of a particular plot size, can you exempt it? I'm just trying to
It's
put forward a thought
very
process.
good point, something that the Association of Housing Finance Companies should take up.
That's one. And there are quite a few local bodies and governments that have taken cognizance of this, that there are a lot of small plot sizes and the kind of delays that happen in the and the process of the town getting the plans and all that approved is becoming difficult. So a lot of states have defined a minimum plot size below which permissions are not required, as long as they follow the bylaws in terms of the setbacks and the other specifications in terms of the heights and everything.
So we're good to go, lunch, and so I want to thank you all for a good discussion, and I hope that some of the suggestions and some of the thoughts that were expressed, that like they say, from your lips to God's ears, and hopefully somebody will hear and the urban planners' ears, yeah. Thank you very much, all of you, for being here, and yeah.
Hello, can you hear me? Yes. Thank you all the panelists for this great session. As a token of appreciation, I request all the panelists to please accept these souvenirs. Thank you.
All. I believe you must have had a hearty lunch. I really hope so in this winter sun. Let's begin with this technical session titled The Unshackled Regulation, Time to Reimagine the Microfinance Model. It is my pleasure to invite on stage the esteemed panel for this session. This session shall be moderated by Mr. N. Srinivasan, a sector expert. I invite Mr. N. Srinivasan onto the stage. The panelists include Mr. Prakash Kumar, the Chief General Manager of SIDBI, Mr. Sadaf Saeed, the Chief Executive Officer of Muthoot Microfinance, Mr. Gigi Mamin, the ex-director of the Executive Director of Sadhan, and Ms. Prasida Kunam, the promoter and CEO of Samhita Community Development Services. A warm welcome to all of them onto the stage. Can we have a round of applause for our panelists? Thank you. We are really sorry for this 10-minute delay that we've had. We look forward to an insightful and thought-provoking discussion. With this, I'll hand over the session to Mr. N. Srinivasan.
Can they douse the light a bit? Okay, let me thank Sadhan for organizing this. I do not know whether it is the lights that prevent me from seeing the audience, or the audience itself is not too interested in the future of microfinance. That's why many people, they are all slowly walking in, you mean. No, Prasida is already running to the rescue of the audience. Okay. So today we plan to have a conversational session on the future of microfinance institutions in a way. The session says, after the regulations, what's happening in the sector, whether MFIs can reimagine their future and become different. Different in the sense, better for themselves, better for the customers, and better for the investors, and how and why this will happen. I think we must have heard a lot of data over the last day and a half, how we have got more than 110 million customers, and the outstanding in the sector is about 2.7 trillion rupees and all that. These numbers are bound to go up, given that the cost of investments, cost of living, everything goes up. So loan is a function. With a small lag, it follows all the increases. So the size of the sector and the fact that it is set to grow further, it's entirely based on the kind of demand that is on the ground. And the unmet demand is still there. There are large pockets in the urban, peri-urban areas, it has been met. But there are several pockets in the rural and really remote areas where we still do not have effective intermediation. When the regulations came in, they did a few key things. One, they leveled the playing field between banks and the MFIs, NBFCs. Hopefully, a little bit of leveling between the large, medium and small MFIs, about which we might hear a little bit later in detail. Then trying to ensure that the customer is the core of what microfinance does. In the sense, we don't go by the number of people from which the customer borrows, more about the servicing capacity of the customers to borrow a given sum of money. Also putting certain definitions of who will be an eligible microfinance customer and what will be an appropriate sized loan for microfinance, and leaving the sector to work through identifying eligible borrowers, identifying appropriate repayment capacity, and thereafter fix the size of the loan, and ensure that the past codes of conduct relating to fair, transparent dealings with the customer, they continue to remain the focus. Some of the smaller aspects, like which were anti-competitive, anti-business, like say removal of interest rate caps and then competition-related issues, certain aspects, they have been liberalized. The question now, which is before the panel, is have the regulations gone enough to create space for MFIs to become better, bigger, larger, or different? And what kind of opportunities have come up? And we have a fairly diverse panel here. Two of them representing actual microfinance operations on the ground. One is a large microfinance institution, Sadaf is from Muthoot. The other, Prasida, all of you know, she knows, she does not require an introduction here. She represents the small marginalized people as well as small, medium-sized MFIs. Prakash is representing SIDBI, the big dada of microfinance for a long time, though in the recent past, last about 4 or 5 years, they have been trying to get back into the microfinance space with a lot more vigor. And we have GG Memon representing all those who are operating on the ground in terms of microfinance institutions, small, big, profits, non-profits. So now I would try and pick their brains on how they see the regulations playing in this space. Maybe I should start with Sadaf.
Thank you, Srinivasan sir. I think, first of all, I must say that the regulation really came in an appropriate time, and it has addressed several areas which were absolutely need of the hour. I think one, uniform regulation for all entities operating in that space was definitely one of the need of the hour, and it addresses a lot of risk elements like in terms of overzealous lending by any lender and other stuff. So I think that is established now, and it is turned out to be a great kind of a regulation. But to answer to your question, how it has created space, I think it's an evolving scenario. If you look at the regulation closely, I think RBI has done 2-3 things, which is one, they have not mentioned that microfinance by definition is restricted to JLG. So that is a big kind of a takeaway. Initially, we were like all wondering and going through the regulation up and down again, whether it's a mistake. They have not mentioned JLG, or it's it's an intention or something. But I think that's a hint from the regulator that you have to imagine beyond JLG. And JLG itself does not only constitute microfinance, and there could be a larger kind of a segment of players who can form as a microfinance customer. So I think that is first part of it. The second thing which has happened is, by and large, microfinance institutions or like ours were driven by the intention, and the loan is largely, I think you and all we know, is fungible in terms of cash. It can be used for economic purposes, it can be used for personal consumption, but by definition earlier it was only income generating loans. They have done away with that regulation in terms of it has to be 75% or 50% income generating. The end use of loan is no more the definition for microfinance. So again, there is a room for like whether you lend only for income generating or you lend for some other requirement, an emergency or education or any other purpose that you want to lend. So I think that opens the room. However, I think always there are suggestions and rooms for improvement. Though RBI did liberalize the regulation by increasing the qualifying asset, non-qualifying asset room from earlier 15% to 25%, but there is a kind of a, say a little bit kind of room which was closed for us because now the 75% qualifying asset is dependent on total asset. So because of the total asset criteria, that room for innovation basically technically reduces. So I think there is room for improvement, but then again, I think RBI has done enough for microfinance institutions like us to look beyond. And I think not only regulation, but also circumstances, I will say that. Earlier, the conception, or I think it is good for microfinance to stick to the group lending and collecting at the center, but the circumstances during COVID were such that the center meeting was not possible. But even then, we have seen that the borrowers have repaid on time, almost like all the institution reported back after a kind of a pullback from COVID, 98, 99% repayment came on time. So I think putting all of these into context, if you think, there are a lot of things that can be done with the microfinance customer. And I think the system and the business have been there for a very long time. And there is a requirement of innovation, and that is happening. I think SIDBI also playing a role in terms of a Prayas loan that they have started. We are one of the partners with SIDBI, which is a loan, which is an individual loan in the format from 50,000 to 3 lakh rupees, and that creates room. So there is enough room for improvement that has been opened up by the regulation. There are certain innovation that we are doing. We are giving loans to customer in the form of Matut Small and Growing Business, MSGB business we call it. These are all customers who have graduated from group loan. The thought process here is that the customer typical microfinance process was she comes in, takes a 10,000 rupee loan, then she services that, then she takes a 20, and then so on and so forth. But beyond a certain time, what do? You keep increasing the ticket size? That can't be done for all the group members because everybody is not having a homogeneous income profile. So you select a customer which has capability of doing larger business, and then you kind of give a loan. So that innovation is happening. We are looking at a micro MSME kind of a loan. So that room has been created by the regulation, definitely.
Thank you, Sadaf. I think what you are saying is in terms of category of customers, even the methodology of lending, whether it's individual or group, and in purpose of loans, there is quite some room that's created. And basically the reduction in the non-qualifying loans, originally defined non-qualifying, that gives you some more space where you are able to do MSME type of lending. Prasida, how does this look to you? Meaning that's a large MFI, they are seeing a lot of opportunities, being able to convert. From your point of view, how does it work?
Like I would like to address the regulation first, like, not as a small MFI, but as a not-for-profit MFI, like this regulation has brought in like more of activity based regulation. So it's like the caps on the loan sizes that Section 8 has been removed. But what I see is like, maybe slightly different way of looking at it. I think right now the system, or like, the way banks look at it, the way DFIs look at it, or the way anyone looks at it is like, it's only one way. Like you just get bigger. So there is no other option. If you don't get bigger, then you perish. Like, it's, so this approach of looking at like, how do we grow? The growth is only like, by the size of the portfolio. That kind of is, I feel, an issue for people who don't want to pursue that path, or who want to focus more on maybe like, I mean, it's not just me, that I've seen like many other people also who want to focus on a particular geography, maybe work on like, more product development, or like, grow, go deeper into like, understand your, but like, I don't think it is specific to this sector, but like, to any sector, to any kind of economic activity, it is like that. So, so if there is something we can do in that context, it is. And of course, like, there is a level playing field for banks and NBFCs, MFIs, but I don't think there ever is a level playing field with the smaller, because the problems of capital still remain. It is not just the regulation. So you give capital to only people who have capital. I think that's the universal way of doing things. So that is still not yet addressed. So the cost of capital is still higher. So all these problems which are fundamental to small and I won't even say medium. So I mean, even medium NBFCs or MFIs still remain.
So Prakash, I will now get to you. Is it possible now Prasida wants, like in the case of cricket, you have under 19 matches. For small MFIs, is there something that's possible to level the playing field, and also the general import of what Sadaf said about the space that's created? And Prasida says, yeah, space is created, but I have to become big, otherwise I don't get the space. How does it look to you? Because you have been looking at the sector from a very high perch.
Let me address the first part first, because small, big, these debates will keep on continuing. Small has a value, the big also has a value. There's a lot of experimentation which can be done by small MFIs, which are constrained at the level of very large MFIs. So that's a separate debate, but the more important question that we had asked is that with this regulation which has come in, is there a way to reimagine the microfinance? My entry into the microfinance sector happened post-Andhra crisis in 2012. Prior to that, I was handling the direct lending side of SIDBI's business, and then I took charge as PSIG project leader, and that's how I got introduced to microfinance. So I saw microfinance at that time was just reeling out of the crisis, and so many issues and concerns were there. So that time, perhaps if you would have kind of looked forward 10 years down the line, how the microfinance will look like. Has it changed significantly? A lot of things have changed on the ground. SFBs are now there. The banks, the BC arrangements is very, very active. But the microfinance institutions have a role to play. And I see that the experimentation which happens in this space will be mainly driven by the MFIs, because they are in the best position to experiment. The banks will look at it as one of the portfolio. The SFBs now also realize that microfinance cannot be their only bread and butter business, because the huge unsecured loan sitting in their balance sheet, which will impact their ratings, so they're diversifying. So I see that the experimentation that will happen in the microfinance space, despite the limitation that you're not able to offer a liability side product, will continue to happen in the microfinance space. Now, MFIs can grow to what size? Can there be a 50,000 crore MFI? I don't know the answer at this point of time. Is it too big a risk? Like SKS decided that post 10,000, 12,000, 15,000, you cannot operate in an MFI, NBFC kind of a model. You'll have to move to, it's completely unsecured, move to BC kind of arrangement. So that's one part. The second is that regulation, what it has brought in is a couple of things. One is that it gives you scope for lending bigger ticket sizes. You need not be constrained to 40,000, 50,000 loan. The point which Sadaf made that the requirements are increasing. How long? Microfinance has been there for 20 years. How long a microfinance client will remain a microfinance client? 8 cycle, 9 cycle, 10 cycle. Do you take pride in saying that this customer has been there with me for 10 cycle, 15 cycle? Then the question that is asked is, have you made any difference in her life if she continues to be there for 15 years and you're giving them 30,000, 40,000? These are the questions that microfinance sector needs to answer, because we have been interacting with both the sides. We are interacting with government, we have bureaucrats as our chairman, and we used to argue these things. So the criticism is still very high that microfinance sector is a lot of, talk about doing something on the ground, but it's actually you're making money from the poor. That criticism has to be addressed by looking at the impact side of the microfinance. Some of the entities are doing, we are working with Sadhan to document those practices. That's a separate project, but the impact now has to take focus. And in that context, we came out with this Prayas scheme that Sadaf also talked about. And the spirit was same, that if out of this microfinance customer base, if 10% are good to graduate to higher ticket size loan, are they getting an automatic entry into the banking segment? The answer was no. So should we not look at that segment? Because ultimately, unless the income generating thing has been removed, as Sadaf said, but this is the only area where if investment is made, the lives of the poor will improve. Others are hygiene factors. You get a good house to live in, you can take care of your education. Those are also important. But what adds to your income is a good income generating loan, and that improves your livelihood. So the Prayas initiative has been a initiative of SIDBI in this direction. We started a pilot in 2018-19 with Cashpore and SKDRDP. It's picking up very well. It's completely digitized now. There were some hiccups because of COVID. Now we are touching a portfolio of 1,000 crore with 50-60,000 clients. We are looking to take it to big heights. And this is a partnership model. We encourage all the microfinance institutions to identify those clients which have a higher ticket size requirements and do a partnership with SIDBI to give them higher loans, your 75% thing will not come in the way. You can do it internally also, but at least that 75 thing will not come in the way. So this is one area. The impact is what we should be conscious of, what impact we are creating in the lives of the people. That will address all the concerns, most of the concerns which are happening at different times. You're passing through crisis after crisis. Sometimes you have an Assam crisis. Sometimes Andhra is a long forgotten thing, but these things will be taken care of. Now the interest rate has been deregulated. So two more things I see happening because of these regulations. One is that another criticism of microfinance sector is that you're not geographically spread out. Still the concentration is very, very high in certain districts. Mr. Mimon will have those figures. So one argument was that if the spread is fixed, then obviously we'll go to those pockets, those areas where you are able to break even and make money. Going to a very difficult area where you need a higher spread to work with perhaps was not feasible. So that should now be possible. A differential interest rate, you should look at difficult areas. And SIDBI is willing to work with the MFIs who are willing to go to difficult areas, and spread has to increase. That's one criticism which we need to answer. The third thing, which I'm not sure how much it will happen, now you're capturing the income data of the customers in the credit bureau. So I'm not sure, but I see a futuristic thing that through that income capture itself year on year, it will be a very good indicator of tracking what improvements you are bringing in the lives of the people. So building the database. I'll talk about a few other initiatives of SIDBI, which is Udyam Assist platform, Vyapar credit card next time when we come. I think I should stop here and let others.
Thanks, Prakash. So what you are saying is there is space, and there are other things you can do, just not the microfinance loans. Your Prayas is a classic example of that. Gigi, looking to the fact that over the last about 15 years, there have been periods when MFIs have changed the way they operate. The product basically remained the same. So the regulation gives, like Sadaf earlier stated, look, you don't need to go through the group methodology. And given that people don't want to come and attend so many meetings just to get a small sum of money as a loan. So what is the vibe that you see in the network? What do institutions say now? And how do you see this panning out?
Thank you, sir. In fact, it's always a pleasure to be part of your panel and to have this kind of a eminent panelist along with me. You rightly said that the new regulation has given a lot of freedom and flexibility to the MFIs to innovate, to bring new product, new processes, and also even new channel of delivery. So this is a opportunity for the institutions to use their intelligence and see how best the beneficiaries can be, the borrowers can be serviced better. See, you rightly said that so long as, or even today, you have a kind of a vanilla product which the MFI serves. But diversification is very little. But this is an opportunity for the MFIs to diversify its products and processes. In fact, one thing which you see, the interest, the freedom to fix the interest or the pricing, that is going to be a differentiator. In the sense, I would say that, which Mr. Prakash also told about that, the concentration, if you see, it's quite skewed. Around 84% of the loan portfolio is confined to 10 states, or 56% is confined to 5 states. Or if I say in the district terms, around 25 states contribute for about 20% of the portfolio. So there is a skewedness as far as the coverage is concerned. So this is an opportunity for the institution, because if they have to grow, they have to grow by expanding, and by expanding means they need to go into the newer areas, and that newer areas can be possible now because there is a cost differentiation is possible. You can always have a higher cost for an area which you feel it is difficult to service. There is other kind of problems you have. You can always do that. So that kind of a differentiation is possible. So new process can be there. In fact, I was here itself. See, there is a repayment obligation. RBI has been very liberal, I would say, in this new regulation. They have only said three things. One is that what is a microfinance, and who should be the borrower, and what should be the kind of loan to be given. And in loan, they have not made any kind of a specific quantum. They only said that it should not exceed more than 50% of the monthly income. Suppose somebody has already reached to a level of near to the 50%, it can still be serviced by a longer tenure of loan. So that kind of flexibility is there, that kind of innovation is possible. Individual learning, that is going to be definitely going to be the way forward, especially when, as Prakash says, when somebody who has been with the microfinance sector for the last several years, some 10, 15 years, or who has gone through some 5, 10 cycles of loan, why you should be given a loan along with the group itself? You have got sufficient data to prove that he or she is doing well. So why can't you go on an individual basis? Technology is another area which can go to support this kind of innovation. So there is a huge opportunity for the MFIs to innovate, to be more flexible, and to have much more freedom in their approach to finance. Only thing is that this freedom and flexibility has to be done in a more responsible way, so that, because ultimately your clientele is the one who is at the bottom of the pyramid. So their interest has to be taken care of. It has got a lot of social and political connotations. If something goes wrong, things would be, we can boomerang on you. So a little bit more responsibility is required. And of course, I feel that is the place where the SROs have a role. SROs needs to have a constant check and see that how things are moving. And if things are moving well, I feel it's going to be a great opportunity for the MFIs to grow further and become bigger.
Thank you, Gigi, for that sharing of a useful perspective coming from the network members and yourself. I'm going to be asking a few more specific questions to the panelists, but if any of you have a question, you can raise it. I will prioritize your questions over what I am going to ask them. My only request is, don't make a statement. Ask only questions, make them as crisp and short as possible, so the panelists have a chance of reacting better. So getting back to this, we are saying that there is space created. MFIs will be able to reimagine and come up better in future. As they are right now placed, do they have adequate technology tools and the kind of skill sets that are needed for reimagining their future and become different? Yeah, Prakash, you would like to take it? Yeah, Gigi. Go on. Be taken by Sadaf first. Okay, sir. He is very keen.
Yes, sir. Yeah, I think a very pertinent question in this regards. I think different MFIs at their scales have different capabilities and kind of abilities, and also the financial resources to have that kind of a facility. But I think it's become necessary now because now you're dealing with a lot of information, and the way I think the overall infrastructure is developing, and the way you underwrite a loan, you integrate with a lot of players. You're talking about the ecosystem where you have account aggregator, you have credit bureaus, you have verification agencies, like where you want to verify Aadhaar or you want to verify any voter ID. So it requires a certain amount of sophistication in terms of IT infrastructure. So definitely that is the need of the hour. Whether all the institutions are well equipped or not, that remains to be seen. But definitely the larger institutes or institutions are definitely making that investment, and making that investment in software. In fact, RBI regulations these days are directing towards having that kind of a IT infrastructure and IT framework, that you have complete protection of data, you have cyber security measures all put in place. So investment would definitely be required. I think one thing that anybody who's starting new, a microfinance institution, they need to realize that apart from capital to grow business, there would be capital allocation which would be required for developing a sophisticated IT infrastructure. And that we have seen as you grow, that requirement increases. The institutions which have graduated from MFI to SFBs, they have allocated huge amount of cost for a core banking software. So the requirement now, for example, for systematically important NBFCs is to have a core banking kind of a software. So though the definition of RBI does not clearly defines what is core banking software, but it really requires, and if interpreted loosely at my own peril, I don't want to, so it requires seamless integration among all branches, and we are able to see the customer uniformly across everywhere. I think those kind of things have to be done, and the investment has to be made, be it small or big. But I feel for small MFIs because that's a huge investment, and the capital is there for them. And it becomes difficult to allocate too much cost there, and then returns will only come later. So I think allocation definitely is becoming difficult.
I would say that the MFIs has been very early technology adopter from whatever my experience has been. Prasida can add to it. I remember old times, 2013-14, I was talking to Cashpore. They said they do their entire origination on feature phones, not even smartphone. I said, I can't believe it unless I see. This is something, you're just telling me a story. And I went and I saw they were using feature phones, the officers in the field, to originate a loan, doing all the entries. There was not even a computer in their branches. They have moved beyond computer. So the cost of technology will certainly come down, but technology, the productivity, efficiency has to come through technology, and Prasida can add to it because they, being a small entity, right from day one, they are very advanced in terms of technology. That's what I know. My point is like this, that microfinance model, when it started in maybe what, 90s, late 90s and then 2000s. So it was basically an operational risk management model. There was no credit risk, although it was lending. And lending, we understand, with lending, we understand the credit risk, assessment of credit risk before giving the loan. This was not a credit risk model. This was an operational risk model. You form a group, you give small loans, you do some basic operational risk parameter check, and your loan recovery is, collections are guaranteed. Now, as we are moving to higher ticket sizes, slowly we'll have to move from an operational risk model to a credit risk model. Because ultimately, when you are giving a 1 lakh loan, and the new regulations, my sense is that it does not prohibit you from giving more than 50,000 loan, which is the general trend in the microfinance industry. You can go as high as 1 lakh also, depending upon the requirement. So one is moving away from JLG to individual requirements. Now JLG will slowly, you'll have to reduce your dependence upon the JLG. We have huge data built over years to take those decisions. Like Northern Arc has recently launched a new score based on this data. So these kinds of things will happen. These data will be analyzed, some more inputs will start coming in. Now credit bureaus are very, very strong. Earlier times, the credit bureau, when started from microfinance sector, it was all a fudgy logic. We're not sure that this client whom you are giving in the match, which is found, is the same client, not the same client. Lots of alternate, these things were used, pin code matching, etc. But now with the fair degree of certainty, you can say that he's the same client because the KYC piece has been fixed more or less. So one, it will move to credit risk kind of a model, then only you can give a large loan. Another thing which has happened is now the entire disbursements are happening now in the bank accounts. Bank accounts were not there. 5 years, 6 years back also bank account was not there. Then the Janadhan happened, then the Aadhaar happened, the KYC problem was resolved, and now everybody has a bank account. So all your disbursements are happening in the bank account. The collections is now picking up through those accounts. The problem is that the account does not have funds, so collections, you're finding it difficult, but still a decent, I was told that at least it has reached 7 to 8%. So the next 5 years, perhaps, there'll be a scenario when we are reaching still higher numbers in collections. So somebody made this point that if you're making a disbursement in his bank account, if you're making a collection from his bank account, It's individual lending. Where's the JLG? JLG is just, giving that kind of a comfort when you are choosing a particular customer. So these are the things which I see happening. And the most important thing is the product innovation has not happened. You just have one product. Whatever you call it, water and sanitation loan or housing or whatever it is, they are the end users of that particular loan. It is a product. You have a single product, term loans with a fortnightly or a monthly prepayment, 1 year, 2 year kind of a thing. I have not seen any changes happening. And obviously this was not possible. But now we should actually start experimenting with need-based products, because for, again, the same question that we want to devise different kinds of products catering to the individual needs, like a 3-month loan you want to give, or a higher ticket size loan you want to give, a 5-year loan you want to give, or 7-year loan you want to give, then you have to get into the credit risk game. And that getting into the credit risk game is now possible because of the huge amount of data which is now being made available.
Yeah. Gigi, I got another question later. Then you can add this also. Prasida, he had already punched your ticket, so you have to. I also want you to add a little bit more on. If this requires more funding, which Sadaf has also pointed out, has the post-regulation scenario changed when it comes to equity or funding availability, apart from what you have to add to what Prakash?
So on technology, like Prakash mentioned, like we've always believed, like, technology is so we use tablets even before banks did for onboarding the clients. Our software is all like open source, so we don't spend a penny on commercial licensing also. So we've been like, very innovative that way in using our technology to reach out to more people, and also to reach out to people in remote areas. Because so when we started out in, we had branches with only like 300, 400 and 500, because we used to set up our branches in blocks where there were no banking facilities also. So by using tablets, by taking photographs of bank deposits, so we had to balance technology with controls, and we did it in our own specific way. Right now, but I understand that this may not be possible for everyone to do that, because that was very specific, because we had in-house resources that could do this without any cost. But going forward, I think there is a very, it's an opportunity for the DFIs, especially the development banks like NABARD and SIDBI, to do this, because there are so many SaaS providers, and there is innovation everywhere. There is so much happening, and if you could establish some platform for just like plug and play for small MFIs to get these services, so that they don't have to spend money on CKYCs, and this is probably could not have been possible some years ago, but it can be done. If you have the intent, if you really want to do it, you have the resources and you should do it. Not just, I think so far the approach has always been telling people you can go to this, we can give you a grant, and they have been helping the MFIs build on their technology by telling them to go to a particular software provider of their choice, and they would subsidize it. But I feel, in my opinion, that would not work, because it would always require customization, continuous customization, because of changing regulations, changing markets. So, if something like autonomous can be set up to kind of fill this need, that would be amazing, and that would ease a lot of, and that would actually be one factor in level playing for smaller, regional, local, people call hyper local maybe, so you can do all that if that can be done.
Yeah, Gigi, I think you wanted to add to this, but I would also add the same question which I asked to Prasida. Do you see a post-regulation change in the funding scenario, whether it's for equity or for mainstream fund? She doesn't want any money for technology right now. She needs money, but not for technology. She's able to ride on what's available in the market. But whether this Ramarajya will also continue.
First, regarding the technology side, technology part of it, I'm sure that there is a difference as far as the technological capability of the institutions are concerned. The bigger ones definitely have a better technology capability than the smaller ones. And smaller ones If you have to upgrade to a higher level, of course, it involves the cost. So as Prasida was telling, probably it can be a common platform can be created. In fact, we had some discussion with SIDBI chairman also, SIDBI CMD also, and SIDBI CMD was showing some kind of a interest on that. In fact, SIDBI has already developed some technology stack for their Prayas scheme. Probably if that can be tweaked and if can be made use of by the MFIs, that could be the best way of doing it. If you have a kind of a common platform which can be accessed by the smaller ones, then their investment cost can be reduced, and also they can have the best capability as far as technology is concerned. So that is my take on the technology part of it. Secondly, as regards the funding part of it, yes, this COVID has really caused a kind of a disruption, and the kind of the lenders' confidence is getting a little down. So raising funds is becoming a challenging aspect. So we had been, as an association, we had been trying to do the best, and we are trying to bring especially the smaller ones and the medium ones. We are trying to bring the bankers and the funders and the MFIs together. We had a couple of online meetings with institutions like State Bank of India and Punjab National Bank. We are also planning a lenders meet in Bombay on 8th of February, where we are trying to bring all the lenders and trying to get most of the, bigger MFIs and medium MFIs, so that there can be some kind of a confidence building happens. So fundraising is an issue, and new regulation will definitely help the lenders to, or the investors to come forward, mainly because, and investors, if you say, I think there has been a slight slowdown as far as the current situation is concerned. Maybe they are also waiting and watching because of the overall inflation level going up and the recessions going to happen across. So there is some kind of a slowdown as far as investment is concerned, especially from the outside investors. That's what my take is. So if you have to, but this regulation will definitely help the investors as well as the lenders to hike their confidence in the system, because this is going to help the MFIs to get over from the COVID-related issues, as well as also build up their balance sheet better, because they can now go by a market-driven pricing. So when a market-driven pricing is there, they can always get a better financial strength, and that will, I'm sure, that will going to add the confidence level of the lenders as well as the investors. So right now, yes, there would be some kind of a lull as well as the investors and the lenders' confidence is concerned. Probably we can build upon that, and new regulation is definitely going to support that.
Thank you, Gigi. I think, Sadaf, I will now turn to you. This more comes from what Prakash said slightly earlier. At the beginning, MFIs built large operations on Excel sheets. The risk was more seen to be operational. But now, if we look at the way regulations and some of the advice that comes to MFIs, if that's taken seriously, there will be more of individual lending. And the assumed group's ability to step in when somebody does not pay you, that doesn't exist anymore. So, risk management capacities of a different kind, would that need to be set up? Also, technology-wise, do we need to do quite a bit of retooling when it comes to individual loans of maybe 1 lakh, 1.25 lakhs, things like that? Because where I connect is, long back, maybe in 2008 or so, I was talking to a very leading MFI those days, one of the number 2 man. What he said was, you see, I don't really need to do much. I have a reasonably well-working Excel sheet, and my staff need not know anything. They have to have 2 pairs of legs to walk, 2 pairs of hands to wave around, and my business is done. Does it hold true anymore?
No, absolutely not. It's not that easy. And I can tell you it was never that easy even in 2008. I think that was oversimplification. But I think to Prakash's point, his point is correct. The underwriting has to move from operational risk to really underwriting the credit risk now. And I think technology will play a big role in this. Like, for example, if you look at, I can quote you an example of our organization. We have automated the entire process from loan origination to underwriting to disbursal to even collection. So it's a seamless, paperless operation. But the biggest innovation that has happened is in the underwriting part of it. So we have developed a scorecard with the help of Equifax. We use that scorecard over and above the credit bureau report. So by the way, we access credit bureau report both on the microfinance credit bureau as well as the consumer credit bureau. And over and above, we have a scorecard. The scorecard takes into consideration the credit performance of that individual or of that household, but also the demographic in terms of that similar demographic, how many people have defaulted, same business, same income level, or same kind of a profile, how much probability of default is there. And I think over a period of time, more and more data is coming in. So within account aggregator platform getting more integrated, you will have more data points where you can underwrite a loan. So you will have customers, if they are paying some mobile phone bill regularly, you know that, okay, that capacity is there. They're contributing in some NPS scheme, you would know that, okay, that disposable income is there or that savings are there. Similarly, if there are like banking information that can be pulled in through account aggregators. So this area is evolving, and it's evolving quite rapidly. I think if we step away a little bit from the microfinance ecosystem, we have seen how GST has helped people to underwrite SME. So there are systems that are available where you can get the GST data of an company, and you can really underwrite that, okay, what is their income and what is their savings. So I think those things will happen in even microfinance ecosystem. Within account aggregator platform and other platform, I think there are quite a bit of innovation that is happening. There is something like a Chi score, which is developed by Clyde Diffin, and there is this scorecard that has been developed by Prakash mentioned. So a lot of these innovations are happening, and this will help us underwrite the loan. But I think I agree to your point. The more we move from direct bank disbursement and direct bank collection, it becomes an individual loan in nature. And I can tell you by practitioners' point of view in the field, the joint liability which was there, where you could actually expect the group to pay the installment if the person does not pay, that hold good only for 1 or 2 installment. Beyond that, people start refusing to pay. That is the practical reality of today. So I think eventually it has to move to an individual kind of an underwriting, and that has been the case for long now, because I think ours is a modified version of SHG lending. So it is not an SHG, it is an individual, like in the form of joint liability group. Only for the sake of joint liability it is there, though earlier people were really contributing together to pay the installment, but now that is becoming less and less. But that all depends upon how strongly the group is being made. But I think the future is towards an individual lending, and that will require use of technology and underwriting and understanding the cash flow of the individual household, and based on that you build your credit.
Thank you, sir, for coming out so clearly, meaning the movement is towards individual lending. The pace of it will be determined by in-house preparation as well as what's happening out. Yeah, Prasiddhi, you wanted to add a point on that?
I mean, I just thought about it. Of course, now the group liability doesn't hold that much, not only because, there is people are not part of just one group, they are part of 3 to 4 groups, and they can't be paying for a person in all these groups when they themselves are from different households. So, I mean, it's just I just want to understand, would it lead to, MFI is taking, I mean, he should be asking the questions, but I'm asking just on his behalf. Would you then, once it goes into credit decisioning and underwriting through individual households' income, would that move away from giving loans to women to men?
Not necessarily. I think what we have seen in our whatever impact assessment that we have done, we have found that in rural areas, especially the business driven by women and the women folks are more reliable in terms of lending. And the reality is that they don't shift houses so frequently or they don't hop jobs so frequently. So the credit flow to women folks would continue to be, and that like primary customer, if you ask me, will remain. But I think the thought process will move. It would move from women or men to a household. So it will ultimately be a loan to a household rather than a loan to a, because in most of our cases anyway, men are co-borrowers.
So any questions from the audience? Anyone is ready with some questions? Yeah. There is a mic there, can you use that? That mic. Yeah.
I think I can be louder. Yeah, it's working now. So, firstly, thank you so much, the panel. I think great insights. I'm actually, it's a great point which Prakash sir has mentioned. I think the shift from the operational risk model to the credit risk model now. So I think absolutely, sir. I've been in the industry for almost a decade, and I can completely relate to what you're saying. In fact, probably our journey has started together in the microfinance. I've also joined towards AP crisis and all. So my question is, and also one more valid point which you mentioned, we may call the products with different names. It could be wash loan or income generating loan or whatever loans, but it's a simple vanilla product across. It's a homogeneous product across the industry. So my question here is, now we're talking about 2 points here. One is move to individual lending and credit risk model, and diversifying the products, which means the tenor would go up, the loan ticket sizes would go up. So my question here is that, and also we are talking about small MFIs. So how can we triangulate this? In the sense, would this customer then will still be a MFI customer, or he would be a mainstream banking customer? He was probably coming to the MFIs because it's a plain vanilla, and then it's a simple cash. The credit risk is not much on, and the evaluation mechanisms are quite simple. Yes, the industry has evolved.
So this,
I just wanted to understand.
correct, got your point. So this customer will continue to remain the MFI customer. See, when we have a discussion at a different level, because I've seen both the sides. My department deals with NBFCs also, we deal with banks also. So the lending model which is developing by the fintechs and all, they rely on 3 pillars. Yeah? One is GST, as Sadaf said. The other is the IT returns, ITR, and the third is the bank statement. So once you can triangulate this information coming from ITR and GST and the bank statement, then you are able to take a decision on lending to that customer in a straight through kind of a way, putting in some scores and all. Now, this is one segment of customers. In this segment, GST, no. ITR, no. Bank statement, still no. I mean, banks are there, but transactions are not sufficient to establish at this point of time any kind of meaningful correlations from that transactions which is there. So this is a completely different segment, completely different segment. So this has to be these kinds of things that microfinance institutions are doing on the ground, backed by the history which has been built up over, like you have a CIBIL score, everybody, all of us here, we know that we have a CIBIL score. Some scoring is done just based on our repayment track record on the credit bureau. So those kinds of scores, then on top of it, you are adding those geographical indicators, some income indicators, etc., to collect on the ground. So those scoring models will get up. This scoring model will be completely different from the scoring model that we understand for the other segment. And this has to happen. And this challenge, I don't think the banks, they don't understand this segment so much. They'll not be able to do it. Once the bank transactions start increasing, and that will, once your collections start increasing, that means the transactions are happening in the bank. Currently, I'm told that you disburse in the bank. One transaction is the entry, other is the exit of that entire money, and there is some DBTs or something which is coming, some remittances which is coming in, but it's not being used for transactions. So 2 things I'd like to mention, because we should always look at the future. 5 years down the line, how will the microfinance sector be? And we are able to see those trends which is happening. So one important development that we need to understand, and it's a very far-reaching, it's going to have a very far-reaching consequence. 1 week back, if you have heard, our chairman mentioned in the inaugural address, the Udyam Assist platform, which has been launched by the Ministry of MSME. SIDBI is the nodal agency for that. So you know that for getting an MSME registration, you need to have ITR and Aadhaar and all these things, maybe GST also. So once you get a Udyam registration, then automatically so many benefits flow to it, and you have a unique ID. Like Aadhaar is an individual ID, that's a business ID. That thing will now start happening for the informal sector. So a lot of effort has gone into it, and it will be done through partners like the microfinance institutions, the banks, the NBFCs. All your informal segment enterprises will be brought on this platform. Each of them will have a unique identifier. Each business will have a unique identifier. The process will come out, we'll make a more understanding, but for the time being, you can understand that that's an assist kind of a model. So whatever information you have or any other MFI have, they will give on that platform. And then from there, currently you're not able to have an access to Aadhaar. MFIs, I'm told that you cannot take Aadhaar as a KYC. The Aadhaar linkage will then happen in the next stage. His Aadhaar will get linked, and once that linkage is complete, you will help them in doing that on the portal. He'll get a unique business registration number, which will open up plethora of opportunities. Data, the way we look at the data will completely change. The entire informal segment, we are hoping in the next 18 months to 2 years, the 6 crore, out of which 6 crore, many may not be enterprises, but whatever is the number of enterprises, everything should be there on board. The second important thing that we are working on at SIDBI, we talk about the product innovations. We don't have a revolving product for microfinance customers. So we are working with the Ministry of DFS and everybody, RBI. All those people who are getting registered on this Udyam Assist platform, they'll be given a revolving facility by way of a Vyapar credit card. So the vision is that you give a 50,000 loan or 60,000 loan to a customer. Out of that, maybe 10,000, 15,000, whatever is the comfort level, you earmark for a Vyapar credit kind of a facility, do a partnership with a bank. The card will come from there, and this revolving facility, it's a credit card facility. It's again a path-breaking change. It's not a like Kisan credit card, which is not a credit card. It is like a OD facility with a card. But this is a pure credit card where you get 50 days kind of, like we understand the credit card. And how this is being made possible? Again, the technology. Because you must have read that now the credit cards can also be linked to your UPI. So currently on Bheem, you can only link your bank account and you can make payment from the bank account. The credit card's linkage is not permitted, but now that has been made available. So this credit card will not require a machine to swipe, because again, the challenge is the villages, you don't have those POS machines where you can swipe your credit card. So what's the use of this credit card is a question to ask. So this will be linked with UPI, and the QR codes will actually work with the credit card in the background. So if this happens, each of your customer will be able to get a revolving credit facilities. And like this, so many, I talked about a 5-year loan or a 7-year loan. These kinds of things are possible, and the regulation, I guess, gives you a lot of leeway into experimenting with these kinds of products. So I see a great future for microfinance sector in the next 5 years.
Thanks, Prakash, for outlining what's there in store and how technology will enable different data points to. I think now we will try and wrap up the session a bit. We are getting some requests from the organizers. Say, in the next stage of evolution, as we see, there are several things that have happened in the past. And we have also seen MFIs resetting themselves, reinventing themselves from time to time, from non-profits to for-profit entities. In for-profit entities with a more reasonable code of conduct, more reasonable pricing approach to customers. Then we saw a voluntary adoption of some codes and banks coming in with their partnership models duly approved by RBI. First stage was not approved, Prakash, you know that in the early days. And now you got managed portfolios running to around 40-45%, in some cases even more, and rest of it on own book. So the next stage of evolution, with the regulatory space that is available, with the possibilities that technology offers today, and also the kind of data that is now possibly, meaning that's available for us to mine and then take decisions. Where do you see MFIs in the next stage of evolution? So about a minute to each of you, and what you see and what you will wish it to be. It could be either. Yes, Adaf, start.
Yeah, I think the opportunities are opening a lot. I think if you look at regulation, if the regulation creates more room for innovation, I think there are a lot of opportunity. I was attending the opening session of this conference, and I was hearing there are around 30 million SMEs and around 200 million QR code that has been generated. So that's 20 crore QR code. We saw that PM Swanidhi scheme. There was a lot of street vendor loans which were given. So I think the micro businesses which are now getting a little bit formalized in a sense with this, I think, Udmi Mitra number and authentication of their bank account and authentication of their business creates a lot of opportunity. So I think microfinance will definitely, and globally we have seen, it moves into individual and then moves into a little bit of a business lending, which is a small businesses, 3 to 5 lakh kind of a loan. I think time has come where I think these credit needs should be met through microfinance, because I think for almost more than a decade we have been talking about that missing middle in MSME and SME, that there is nobody to lend between 5 lakh to 10 lakh. Though 10 lakh and above, there are banks with collateral, they will lend, but there is nobody. So I think maybe not up to the 10 lakh, but at least up to 5 lakh, microfinance entity can definitely step in, provided there is room created by RBI for us to lend, apart from the definition of microfinance today, that 25% room become real room for us to lend. So then definitely the ecosystem and the infrastructure that has been created by government and players like ecosystem players like SIDBI, like Udmi Mitra, leveraging on that and using the information that is available today with the use of technology, definitely that lending can be done. That's what I foresee.
Yeah. Prasida.
So in terms of, I think the one thing that we haven't talked about is like, from the products, how the products are being designed now, maybe like, in the next few years with all of this technology and with like a lot of information available, we should move to segment-based products, which is, I think, like, you either go to the most vulnerable segment and see what can you do, or you can go to a specific, like a segment like weavers and what kind of loans, and the product design, then everything should be designed accordingly. I think that's one innovation that all of us probably should work at. And the second thing is like, I asked you a question of why not to men. I think you should give loans to men. So that it is very clear, like, what is the loan that is going to like an activity by a man or a woman, or like, because otherwise now everything is buried under like, we are empowering women because we are giving loans to women. So, and we are giving loans to women because, like you said, women are more easy. They will come, they'll stay in the home, they'll come to you, they will, and whatever you say, they will listen. So, if you truly want it to be like, empowering the women, like, you should really make a segmentation between what are these loans being used for? Are we really giving loans to women? And are they able to use these loans in a way that is like, increasing their own confidence, their own ability to take on like, more, participate more in this process. That's the second thing. And lastly, like, as I learned from Vijay, ultimately it all goes down to whatever we do, we have started with like, with the borrower, the ultimate borrower, that woman member. So are we making it better for her or not should be our primary objective. And I've been attending center meetings for the last 20 years, and these are the three questions. Will I get a bigger loan? Will it be at a lower interest? Will I get it on time?
So if we are able to address these questions, I think in whatever steps that we take, that itself is, we have fulfilled our objective that way.
Yeah, Gigi.
Yeah, going forward, I feel technology is going to make the difference, and there will be more and more better technology would be coming in handy for the MFIs, and based on that, the lending would definitely move from the group loaning to the individual loaning. At least a good segment of people, especially those who have covered a few cycles of loans, they would definitely move into individual loaning. But and technology will help in even the collection aspect also. But the physical mode will still continue. Physical, and it will be a physical and digital mode, because we can't do away with the physical mode in a microfinance sector, because your presence in the field, that is what it makes a difference from a banking institution or from a microfinance institution. So even if it becomes more technology oriented, and even the payment as well as the receipt becomes online and technology based, still the physical touch would have to be there. So it will be a digital mode which will be continuing, and definitely the quantum of loan has to move up. It can't remain in the same level of what it is today, and it has to be for a productive enterprise activities. And of course, household is going to be the main key factor for deciding that. So it's not the individual person, maybe the entire household would be the one which will be assessed for the purpose of giving the loan.
Thanks, Gigi. Prakash, your last minute.
Yeah, so see, SIDBI has always had a vision for this sector, right? 2000 SFMC was started. Mr. Brij Mohan sir is sitting here. He has been the pioneer, and we believed, so there was a SHG bank linkage program, nothing to, put anything down, but there was a thought that we can make the banks lend to these people, and SHG is the medium through which we'll be able to make them to lend. That was one thought. The other thought was that no, the banks cannot lend to these institutions. We have to create a separate set of institutions who will lend to this segment. This was SIDBI's belief, and that's how we started SFMC under the leadership of Mr. Brij Mohan. And our vision, he articulates that our vision was that can we create 50 Punjab national banks who will be lending to the microfinance sector. And that 20-year down the line, this vision has been achieved with so many small finance bank and Bandhan being specialized bank to lend to microfinance sector. So that's the kind of vision we have for the, so microfinance always, still we believe that it's a separate segment. Banks will take a lot of time to reach to directly lend to this segment. The pioneering work in the microfinance will continue to be done by the microfinance sector. And you people are doing a wonderful job. Somebody in the inaugural session said that if 2047 India has to become a developed country, these people who are at the bottom of the pyramid has to be lifted up. And the government has having its own program. They are doing so many things, but ultimately the microfinance sector has to play a very, very important role in achieving that dream of India being a developed country. I'll see that this SHG and JLG kind of thing which is happening will gradually blur, because ultimately we don't have that data, but my sense is that there's a huge overlap. The same set of women who are a part of SHG and same set of women. We call it SHG bank linkage and JLG, but it's the same people. So some convergence will have to happen, because a lot of investment is happening in the capacity building through NRLM, SRLM. We are looking into that area of how to bring about that convergence. That's our next project. And so SIDBI, I should not be speaking big things, but SIDBI has been driving the processes and the vision behind this sector. PM Swanidhi is one scheme which has been very, very successful. And the entire backbone, the technology backbone, the process backbone was SIDBI's provided. In fact, when the award was given, one of our CGM was there to receive the award. We'll continue to work to achieve, these visions that we have, and I'm sure that this, whatever is the expectations, that can be done only by the microfinance sector, you people who are sitting here and nobody else.
Thank you, Prakash. I think, let me wind up this session. There is such a lot that the panelists have had to say. At the end of the day, I think three questions that Prasida is being asked by her constituent. I'll add a fourth one. Will I continue to get the loan? Will it become bigger? Will it become a more timely intervention in my life? And can you reduce the rate of interest? And the paths to this, to finding answer to these questions could be many: individual lending, group lending, for-profit, non-profit. But then what it looks like, not just because of the regulation alone, is that people find more value for their time. They would rather be treated as individuals, their financial history being kept as private as possible from others. This moving towards individualized loan, which means the investments in product development, in technology, and in rejigging our processes. And accompanying all this, the kind of HR skill set that should be there. All these seem to be very much required in greater quantities as we step next. And yeah, the small and big divide is going to be there. The under 19, under 15 tournaments will have to be held at different playing fields. But then we get great umpires from all segments, like Prasida, like pleading the cause and then ensuring that even the bigger ones play their role. But one inescapable development that we see over the last about 20 years, as institutions become big, transform, become better, they exit the microfinance space, they become banks, small finance banks, or they get merged or acquired. So as we see the next stage of evolution, they all have a grand design on what should be the terminal stage as an MFI. So leading to that, you exit well if you do very well as an MFI, which is where what Prakash had said earlier. So thank you all for your patient hearing. Thank you panelists for excellent inputs, and wish us all the best in the next stage.
Thank you very much to the esteemed panel for this great learning session. And moderator, sir, as you had requested in the beginning, the audience is definitely more in number than the panelists on stage. So, so the curtains shall open now for the plenary session 3. But before that, I kindly request the panelists to please come forward for a picture and receive souvenirs on our behalf from Inclusive Finance India Summit. Thank you so much to the audience for being here. We'll be shortly beginning this plenary 3 on mainstreaming banking for women. Thank you.
socially deprived sections of society. Today, Fusion has a strong, diversified network for more than 1,031 branches spread across 19 states.
This is one of the best MFI in existence today.
After getting listed successfully in 2022, Fusion Microfinance is now all set to take the next big leap to fulfill its objectives of providing economic opportunities to many more rural women entrepreneurs in the country.
Fusion is unique as an organization due to its people and resilience as a team. We are guided by our core values, which have helped us to navigate the challenges and grow over the years. Today, I believe we are at a vantage position because of our network, our investment in human capital, technology, data. Interplay of all this will make sure that we stay ahead of the curve and create long-term value for all our stakeholders.
At Fusion, we have been consistently working on environmental, social and governance ESG principles, intervening them with our core business operations to bring tangible change. As we embark on the next phase of our exciting growth journey, our passion to become better, faster and efficient is more than ever before.
मैं तो लोगों के कपड़े बनाती हूँ, फ्यूजन ने मेरी जिंदगी बना दी। फ्यूजन ऐसे ही आगे बढ़ता रहे और हमें भी आगे बढ़ाता रहे।
Microfinance's growth story has been unprecedented in its magnitude in India, and a developed and inclusive financial system is propelling the economy. However, even today, problems and hardships can tip a large chunk of the unbanked population. The challenges today call for innovative financial services that unlock the most value for the underserved. Amid this, Sindhuja Microcredit Private Limited has come to the forefront to tackle and ameliorate the situation faced by poor people. Sindhuja is a name that shines in the cluster of financial services providers. It is a new generation microfinance company headquartered in Noida and has its outreach across the dispersed geography of India. Since its inception in 2018, it has ushered in the process of development through digital financial inclusion to the last mile. Sindhuja is paving the way for social enterprises and supporting poor households in seizing the opportunities to climb out of poverty.
We shall be expanding our product offerings to cater to both the bottom of the pyramid and the missing middle customer segments, with great products that range from Rs 15,000 to Rs 15 lakhs. With these offerings, we endeavor to become the one-stop solution for the great needs of our target segments.
Sindhuja is unleashing the productive capacities of people who are dependent on self-employment, providing durable buffers against any setbacks by building a sustainable and secure future. Sindhuja has inspired hope in the lives of people across different strata of life everywhere, maintaining transparency and a high-level work process, and has developed strategies designed to increase access to finance. Using technology-driven solutions, it has made quantum improvements to its business.
Sindhuja reaches out to people of low-income households and help them build the base of their social and economic capital. We empower people with our customer-friendly approach and technology-driven solutions while keeping employees at the core of our operations.
As Sindhuja enters its next phase of growth, the empowering dimension of finance is going to become a tangible reality.
Founded in 2010, Fusion Microfinance is India's second largest NBFC MFI, touching the lives of over 3.2 million families in rural and semi-urban areas. The company was established with a vision to create opportunities at the bottom of the pyramid by providing financial services to women entrepreneurs from economically and socially deprived sections of society. Today, Fusion has a strong, diversified network for more than 1,031 branches spread across 19 states.
This is one of the best MFI in existence today.
After getting listed successfully in 2022, Fusion Microfinance is now all set to take the next big leap to fulfill its objectives of providing economic opportunities to many more rural women entrepreneurs in the country.
Fusion is unique as an organization due to its people and resilience as a team. We are guided by our core values, which have helped us to navigate the challenges and grow over the years. Today, I believe we are at a vantage position because of our network, our investment in human capital, technology, data. Interplay of all this will make sure that we stay ahead of the curve and create long-term value for all our stakeholders.
At Fusion, we have been consistently working on environmental, social and governance ESG principles, intervening them with our core business operations to bring tangible change. As we embark on the next phase of our exciting growth journey, our passion to become better, faster and efficient is more than ever before.
मैं तो लोगों के कपड़े बनाती हूँ, फ्यूजन ने मेरी जिंदगी बना दी। फ्यूजन ऐसे ही आगे बढ़ता रहे और हमें भी आगे बढ़ाता रहे।
is to get women to use their accounts. Whilst many of these women are actively using their PMJDY accounts, they're doing so only to access direct benefit transfers and not to deepen their financial engagement through savings, payments, building credit histories, or accessing financial products like micro-insurance, pension, or micro-loans. The session, hosted in partnership with Women's World Banking, aims at putting women's financial inclusion as a mainstream and central pursuit in banks, facilitating sharing of models and strategies to broaden and deepen outreach to women with financial services. The moderator of this session is Ms. Pallavi Madhok, Head Advisory Services, India Women's World Banking. Let's give her a warm round of applause as I invite her to the stage. And our speakers are Jagannatha Shetty, GM Financial Inclusion, Union Bank of India; Jayashree Vyas, Managing Director, Seva Bank; Joshua Raja, Regional Business Manager, Micro Banking, Ujjivan Small Finance Bank; Ashish Mehrotra, Managing Director and CEO of Northern Arc. Pleasure to hand you over to the session. Moderator, Ms. Pallavi Madhok, over to you, ma'am. May we have the main exit doors closed, please? The session has been called to order. Thank you.
Thank you, everyone, and thank you for being part of this plenary session, Mainstreaming Banking for Women. At the outset, let me set the context. The financial services industry has been really proud to make banking services, basic banking services, available to over 500 million Indians today. Findex 2021 confirms that 78% of Indian adults, both men and women, now have access to a bank account. And this is no mean feat. Just 10 years ago, I think the number was 35%. We, however, collectively agree that the next logical step for all of us is to make the usage of these banking services come true. Let me share some numbers with you. 78% do have bank accounts, but 27% have inactive bank accounts. Only 35% of Indians made or received digital payments. Only 13% save at a financial institution. Only 13% of Indians borrow from a financial institution. And unfortunately, only 8% of Indians are financially resilient. To be able to nudge these numbers ahead and achieve the potential of financial inclusion that we all collectively aspire for, we need to slice this data. At Women's World Banking, we believe that looking at the same data through a gender lens will reveal disparities, but also opportunities, and if addressed, will help close the gaps. So let me share these numbers again with a gender lens. 41% of men made or received digital payments. For women, the metric is only 28%. Where 23% men have inactive bank accounts, for women, this metric is 32%. 15% of men borrow from a financial institution. For women, the metric is 10%. 10% of men are financially resilient. For women, this number is half at 5%. By focusing on addressing the gender gap, we believe that we can address the overall gap quicker. But we're not just looking at addressing financial metrics, are we? We're looking at making women the true beneficiaries of financial services. In addition, when we serve women customers, and this is something that Jayashree, Ben and I were just speaking about 5 minutes ago, we don't really only serve her. The outcomes of providing financial services to her is felt by her family, her community, and the overall economy. Because when you give her access to a bank account, she gets to send money safe, in a confidential manner and in a reliable manner. You give her access to a savings account, she can prioritize investments for her children's education, family health, and emergencies. You give her access to credit, she can invest in growing her income. You give her access to an insurance product, you give her tools to help her manage her risks better. Most importantly, you help her control financial resources, help her make decisions in her home and decisions in her life, or in other words, you empower her. And today, I'm really proud and really honored to be sitting with some bankers here who also believe that making women visible and attractive in general to for the larger banking community will solve the problem, because they'll help develop solutions for her. So I'm happy to introduce my panel here. And what I'm looking from my panel is basically to throw the spotlight on the good work that they are doing in the space of designing products and solutions for women as business as usual, as part of their mainstream bank. So my first question is actually to all the members of the panel, and firstly, thank you for being here. What I'd really like to know is, what is the size of women in your portfolios? How important is this customer segment? And are you running any women-centered initiatives? And if you are running these initiatives, does it make business sense? And I'm happy to have this question move around. And would you like to take it up first, sir?
Good evening, everybody. As you all know, Union Bank of India is 104-year young bank. After amalgamation of Corporation Bank and Andhra Bank into Union Bank of India, it is the fourth largest public sector bank, having more than 8,700 branches, more than 11,000 ATMs, more than 17,000 business correspondents, and of course customers, more than 161 million customer base, with around 18.7 lakh crore business. Of course, as far as our women portfolio is concerned, of course among the employees, around more than 76,000 among employees, more than 30% are women. Among the customer base, of course, as I said, out of 161 million, of course, more than around 50% are women. And business correspondents, out of 17,000 business correspondents as of now, we are having more than 20% women as a business correspondent. Of course, as far as woman-centric approach is concerned, of course, as I know, as an employee, when my grievance angle is a bit lesser when my counter is handled by the woman employee. On customer angle, of course, as a banker, we are handling public money. So the end use usually, you would like to have an end use of the funds will land, that is better, that is for observation, and repayment culture is also good. That is why we have got several products for the, of course, all products are there, but we have got specialized product for women as such. So for example, in Prime Minister Jan Dhan Yojana, usually we give around overdraft facility without any documentation or security, up to 2,000, we say 6 month well operated account. But here, women, we have got a special scheme for around 5,000 rupees for SHG members. It's a overdraft facility for a 6 month old account without any documentation or security is concerned. And of course, we are having the Union Nari Shakti Yojana scheme for women customers up to 1 crore, 10 lakh to 1 crore without any security for the thing, and Government of India scheme of Stand of India, wherein for greenfield it is up to 1 crore it is there. Apart from the Mudra schemes, what we are having is up to 10 lakh Mudra loan schemes, out of which that Kishore, Shishu is a fully digitized product, where it is an end-to-end digitized product for all customers, including women is concerned. But of course, and under the in respect of business correspondence as such is concerned, see, as already Pallavi said, 78% are literate. But if you see the financial literacy is one thing which is entirely different from literacy percentage. The financial literacy is only 27% men and 24% is women, if I am correct. That is where we thought that although I am having 17,000 business correspondent as such, and we are spending around 230 crores annually for the business correspondence only, our bank as a whole, and having 27 product. But when I analyze this, although I am having 27 products, only 2 products are happening, that is deposit and withdrawal. That is where we felt that we need to have some capacity building. Yeah. It is only, there is a knowledge gap. That is where we need to have financial literacy. Although we have good number of people, usually still our low income group people feel that banking is not a cup of their tea. If you see our products, it's very competitive, security is not required, customer friendly, but they are not aware. Here, financial literacy need to be improved upon. That is where we thought we had a tie-up. Then we launched Union Jan Dhan Sankalp Yojana.
Yeah. So I'll come to that, sir. And I'm going to park that for a next question.
Yeah.
But what I understand from you is that you're already serving a large percentage of women today as a part of your mainstream bank.
Yeah.
And that's probably running into millions. Yeah. I wanted to move the same question back to you, Jayashree ma'am. How important are women in your portfolio?
Oh, in our portfolio, we have 100% women. Yeah. So basically, it's a Mahila Seva Bank. Its name is Mahila Seva Bank, and it was started by women workers in the informal sector who were self-employed, and with 10 rupees, but then they, of course, now share numbers are also increasing and share amount is also increasing. The main thing is that, it's for earlier and now also, majority of our loans are unsecured. That is something which, because they didn't have security, but now we are improving in this. The first loan which we had given was of 500 rupees to vegetable vendors. Daily they were, taking it and giving it, and they were giving interest also every day. And I'm just saying this, but there are so many others, who are daily, they were doing daily work, and we were also giving them daily amounts also. But over a period of time, we saw that, they also was growing fast, and I will not go in much of this, but at present, there are 30% women who have become entrepreneurs, and our loan amount is, we are giving up to 10 lakhs. And it's also not always, it was term loans, but now it is cash credit loan also to entrepreneurs, and now they have secured also. So this is what something which we've been working in between. Housing loans are also given, repairing loans are also given, different types of loans were also given. I'll talk about other products later, right? Sure. So that is one thing, and the second thing which we are seeing is that they are growing themselves, and now second generation also. So in second generation, we are seeing that, first thing what they want is that they want to give education to their daughters, even if their mothers were not doing this. So education loans also we are giving, and sometimes if they have some kind of necessary which is not a productive asset, productive loan, but we would give them productive loan, but they will unproductive loan, but they would definitely give it back. Right. So this is what we have done so far.
And Joshua, your journey from a MFI to a small finance bank, can you share a little bit about how you've taken women along with you in this journey?
Okay, I'm representing Ujjivan Small Finance Bank. So the year 2005, we started our operation, microfinance business. So from 2005 to 2013 or 14, almost 9 years, we continue to give loans to only women customers. So that time 100% women customers with microfinance loans. That time we reached around 40 lakhs customers. So then later we started MSE loan and housing loans. So MSE and housing we started with men customers. And even today, 92% of our customers are in women. And portfolio, if you take, 70% of our portfolio lies with women customers only. And in the year 2017, we converted ourselves into bank. So after becoming a bank, see, our purpose, our mission was like providing full range of financial services to unserved and underserved customers. So moving to the banking, when we started our banking operations, we didn't change our mission. So we started providing even the deposit services to the same customers.
Right.
So we opened bank accounts, savings accounts to all our customers, and we started providing even the insurance facility to the same customers. So we didn't change our mission after becoming a bank.
Yeah,
So that is what still continues.
That's very commendable. And Ashish, I'm going to throw the same question so that everyone knows, everyone here on the panel, and would you like to take that one quickly?
Sure. I think our genesis goes back essentially to create the seamless supply of credit to the microfinance segment. That's where the beginning of a journey about a decade and a half back. If I look back today where we stand, we would have done over 1.1 trillion INR of financing. We would have impacted over 70 million lives, and about 65%, give or take, about 47 million women being impacted through what we've done across the piece. The other way to look at this and to tell you what we do, the MFI market's about 3 lakh crores. The banks and the SFB have about 51-52% of the market. 37-38% is between NBFC MFI. So that's, if you look at September number, that's about 1,10,000 crores. If you cut that number, about 12% of that passes through Northern Arc pipes. That means our deep commitment to the sector and to ensure what we do in terms of deployment of credit, more importantly, creation of new products, whether it's 2X and so on and so forth, to ensure we're able to serve the need of this segment. In fact, our commitment goes that beginning this year, we did a slum sale acquisition of an MFI to address the missing middle, where MFI operates and NBFC comes in to operate. We found a large missing middle. And that's exactly what we are now putting our own capital, deploying and building it out. So that's where we stand.
Thank you. And what I'm hearing as a common theme, though we have a very diverse set of players here, an NBFC, a small finance bank, cooperative bank, and a large public sector bank. But what I'm hearing as a common theme, and before I move on to the next piece, is that women are very much the center of your banking strategies. They seem to make business sense, which is frankly music to my ears. And yet we still seem to be discussing this topic about wanting to mainstream banking for women. So what I'm wondering, and I'm assuming the audience is also wondering, is where is the gap? Because if we all collectively believe that, women are great customers for banks, then why has banking for women, why is it not yet mainstream? And I'm going to have some directed questions to some of you, and I love this session to be interactive. There are mics over here, so if you have questions that you want as a follow-on, please feel free to come to the mic, though I will keep aside 5 minutes at the end. So actually my first question to you is going to be, Jayashree ma'am, to you. Is, to service a woman customer as a banker, do you need different products, or do you need a different approach, or do you need different processes, or do we have to do anything differently?
Well, so far as products are concerned, they also need the same. Only thing is that the amount which is in other banks, the amount is very less. In terms of processes, which is that, as you know, that, majority of our women are working in either in home, or they are working manually in other places. So our objective is that, how can we help them to go to their houses and help them in this. And the third thing, which is that, Ilaben had always said that, it is relationship. We should have this as a relationship and trust, which we have always been keeping. And, so we have to go more and more to our women, and they also are coming. It's not that they're not coming. So basically, it's kind of a relationship. It's like very closely working together. That's basically the thing. And processes, lots of other processes where, somehow or other, I don't know whether somebody RBI is here or not, but regulations sometimes were so strict, say particularly with that you can't go to the home. Now it is done, but so initially that, we will have to do it and then, give it in the next day or something like this. We also had to do it. So sometimes processes, the biggest problem was that all these women were working in informal sector, they were doing all informally things. And as RBI, it was the regulation. So the challenge was that, how can we do two together? Now, of course, it is not that problem, but it was really a problem. But anyway, so there were lots of kind of things which we had to do and help our women. Sometimes little informal.
But does your approach to serve women does that have to be different? Because you have a bank account as a bank account or a loan as a loan. So how do you...
No, that we are very clear, very clear that, and it was also very good, maybe I will give you some advice to you also, is that what we have seen is that all women have basic instinct to save. They were saving maybe in their homes, but if they are going to the bank, they would also put it in their banks. And what we have seen is that, and they are also, even, as you said, even in family and all other things, if they are always saving more than what they can save. And I think in any bank, saving is the best thing. So if you can help them in a little bit, then they are, and at present our loans are less than our savings. No, I'm not talking about CRR and all those things, but even otherwise also we have higher amount of this. So this is one thing which we are very happy about, that, women, and now I'll talk about all the products also about savings and other things.
Sure. So yours is a very savings-led...
Saving, yes, but credit also we have been giving, but regularly they are sending it back, giving it back, so that, our cash flow is always there. So that's basically, it's, yeah.
Sure. Ashish, to you, if you need to mainstream, so I know, and there have been a lot of sessions over the past 2 days speaking about the need to increase access to credit to women. And I believe the funnel narrows significantly, like, in the MFI, beneficiaries are maybe 90% are women, then it comes down to 20% when you go to the micro sector, and further down to 5%. So how do you go about mainstreaming credit for women at scale?
I think if you look at two things, you look at the data today, about 50% of the adult population still doesn't have access to credit. I think that number is about 160 million. So there is while we've done tremendous work over the years in the MFI sector, but I think there is a lot needs to be done. I think there are few things which is now we're seeing a significant change as the MFI sectors begins to evolve from beyond JLG. And clearly the Indian stack, as we call it, between Trishul, Aadhaar, Jandhan, that's a phenomenal way to drive efficiency and the distribution, including collections. So I think some of those will be the big propel to ensure the access to credit becomes far more seamless. And I think the biggest piece which get undermined is this 2006 RBI approved the BC model. I think BC is not only creation access to credit, but also creating employment and entrepreneurship among the women. I think that's some of those are big pieces. If we bring it out and scale that will ensure the flow of credit and mainstreaming of credit should happen in a far more seamless manner than what it is today.
Sure. And that's a good segue for me to you, Shetty sir, because one of the biggest challenges that we've faced, and I also believe a lot of public sector bankers also face when trying to reach women at the grassroots level. So how important is it to make your last mile channel? He spoke about the BC channel. How important is it to make that channel more welcoming for women and more gender sensitive? And do share any initiatives that you are undertaking as a bank.
Although public sector bank has got good number of branches all over India, but still we are not able to reach the last mile. That is why I think that BC model comes into picture. In Union Bank of India, we are having around 17,000 odd BC outlets, and we are scaling up to 20,000 by 31st March. That is our strategy. Why? Because this is the model where customer will be able to transact the banking at their convenience, at their place. For example, I am staying in a village. The BC is available village only, local person, and at their own time. Of course, banking we might be having 10 to 5, but here it is not like that. At their own time, evening, morning, whatever time they can transact. And we are not only we are pushing the deposit and the account, even account opening. They need not come to bank with the biometric device in the BC outlet. With the finger, they can go biometric and open the Jan Dhan account. And they get the RuPay card, all the services what the banks are providing, all the services. As I said, around 27 services are in there in Union Bank of India, including deposit, withdrawal, all those things. Even NPS also is in BC model, Adult Pension Yojana, PMJUY, PMSB, what you name. And a lot more products are coming to BC model. But one thing is that all of these things are available that is being used a bit little, only except deposit and withdrawal. Of course, per day our transaction is around more than 250 crores BC outlet alone per day transactions. Per day amount of transaction 250 crores. That is the volume of the business happening at the BC outlet. But still other things are not happening. That is where we thought we need to have financial literacy. This is the area where especially women are concerned. See, still in rural area there is some difficulty for having the access to the credit or banking services concerned. So we are focusing here, and we thought of having the capacity building aspect into picture. That is why we tied up with the Women's World Banking for Union Jan Dhan Sankalp Yojana, wherein we are building their, we are literating them how to do all those things, how to cross-sell, so that their income level also will go up, and they will be able to serve our customer more in the nook and corner of the country, where even difficult area also where we cannot set up bank branches. This BC model can work. Except if that only mobile network is available, then we are setting up the business correspondent outlets. So that is why we have tied up this one initiative. Of course, it is working fine. Now almost all our zones or regions, it is working, and we are telling them to camps how to do all these banking related activities. So I think it is going to help a lot in the future also. Apart from that, we have got literacy angle, financial literacy center promoted by NABARD. We are having around 77 financial literacy center all over India. Apart from, in addition to that, 97 Center for Financial Literacy promoted by RBI. Totally 174 financial literacy centers are there all over India. The main focus is that they have to conduct minimum of 10 camp in their location, and they have to tell them the banking facility. Although they are working for Union Bank, but they are impartial. Because it's supervised by NABARD and RBI, they are teaching all the customers, especially women customers, about the banking facilities available. What are the things? Because main thing is here is that nowadays, if you go to anywhere, if your CIBIL is good, you will get better this one. Banking is become a CIBIL, just become horoscope of good old days. A CIBIL is a horoscope for any customer, and customer will not be knowing why banks are denying their credit facility. Although its amount is small, why they are telling that they are refusing it? They don't know. It is sometimes small mistake only it might happen. This is where our financial literacy centers comes into picture. They will be teaching them. What happens, they might have taken 10,000 rupees personal loan. It might have been settled for 9,500 rupees. For 500 rupees, they might have settled that, but their CIBIL score gets spoiled. They may not be knowing that because of 500 rupees settlement, their CIBIL score is getting spoiled. Or by delay of 1 or 2 days repayment of the loan taken, their CIBIL score is getting low. If you see housing loan, if your housing CIBIL rate is 750 and above, you will get attracted rate of interest from all the banks. If it is below 700, the people hesitate to touch the customer. That is the scenario. It become a horoscope. They may not be knowing. It is not the intention. We may not be knowing. Here we are utilizing this financial literacy center to teach them what is actually banking, what has to be done, what are the basic requirements of having things. For example, if you take my Shishu Mudra, what I was telling, up to 50,000, it's an end-to-end digital mode. When they apply online, it will automatically, they need not visit the brand, they need not do anything. Automatically it will create to their account. But this also checks the civil score or everything into...
No, so I have a
Can I
follow-up
come in?
question, but please, Ashish,
I
go
think
ahead.
let me add, we genuinely understand and appreciate this challenge on bureau score and, underwriting the unserved and the underserved. What we did, sir, we looked at about 25 million time series of loan record performance. And then looked at both the leading and the lagging data, and we built our own scorecards, which we've now launched last week. It's called NeoScore. It enables you to underwrite the borrower, which is irrespective male or female, irrespective of gender. And what it does, it tells you the probability of default, it gives you the credit score, it discounts for some such nuances around single bounce and so on and so forth. And it also tells you how to price that loan, the risk-based pricing, which is fairly important now that the MFI interest rates has been deregulated by the Reserve Bank of India. And then it tells you what's the quantum the person is eligible for. So I urge you, I'll ask my team to come and present the new score to you. But that's a fabulous way to underwrite and evolve the MFI customer or the underserved customer, irrespective, whichever the geography is, because we looked at a large amount of data. And looking at the outcomes, we've had 15 years in this sector, deeply invested to moving over 1 trillion INR, impacting about 60-70 million lives. We looked at the time series of the data records and build our own scorecards. That's essentially our commitment to the sector, not only in arranging and lending from the balance sheet and bringing the global multilaterals, the DFIs, the other financial institutions to participate to what I spoke in terms of volume or 12% of that credit flows through Northern Arc Pipe, but also our success is a function of all the MFI clients whom we work with, or they work with us, and to ensure their success, we kind of launched the scorecards to ensure they're able to underwrite. And given that, the scorecard is built looking at the data over the last 10 years, and last 10 years has been fairly eventful. If one looks at it, you had at least 2, if not 3, 1 in 100-year crisis, whether it's pandemic, whether it's demonetization, whether it's NBFC, and so on and so forth. So we've seen that segment being greatly tested and deprived of credit. I think the scorecard will help. We're happy to come and offer to you.
So linked to that, Ashish, and because I want to continue with that stream of thought. Do banks need to do anything different? Do they need to change any of the existing?
Use NeoScore.
Your part. So you're saying that there are a lot of such platforms and alternative data, etc.
I'm not too sure if there are other institutions have this amount of rich data and the in-depth expertise, but clearly Northern Arc does have, and we're happy to provide and enable, because our success is function of success of our clients.
Right.
That's the way I look at it.
Right, sure. Mr. Shetty, I'm going to come back to you and then move to Joshua, because there's one piece that I was very interested, your data that I looked in Union Bank, and I understand more than 20% of your BCs are women. And I know by any standard that's above industry average. So one, of course, is, how's your experience been having agents as women, and how are you looking to increase this any further? Is this an important initiative for the bank?
Yeah, actually, as I said, I have got more than 17,000 BC outlet. Having said that, compliance angle also is most important. We are handling public money as a public sector bank. I need to ensure that whatever the RBI says, it is complied at the business correspondent outlet.
Yeah.
If the business correspondent woman, that compliance is very good. That is my observation, because they will be following whatever we are saying, whatever we are telling. So compliance part is well taken. Other part is that since I am having the BC output, I want business as well. Business output also is very good. That is why we are focusing. Of course, we are not supposed to do any partiality to anybody, but we are focusing mainly on women business correspondent. That is why we are encouraging our corporate BCs. We are hiring corporate BCs, through them only we are taking a business correspondent. We are encouraging them. Whenever we are allocating new locations, we tell them that kindly see that wherever possible you take BC Sakis. NRM trained people, they are having IVF certificate, they know that. And try to see that if you are able to do that, kindly hire women BCs. That they are also doing. That is why we are increasing. That two parts are taken care of. One is compliance part, second one is business part. If the woman, that is where we are doing. So we are, of course, this is one area where Union General Sankalpa, as I said, we are building capacity building. We are undertaking so that they will be able to how to talk to the customer, how to cross sell the product, how to improve their income. I think it's, in coming years it's going to help us. That is our perception.
Thank you. That's music, I think, to a lot of people's ears. Joshua, Ashish spoke a little bit about, enabling banks through newer digital methods, including a new score. Mr. Shetty spoke about digital lending and increasing financial literacy. Now, I know Ujjivan, and so what all of us are seeing is an increased trend in digitizing banking operations, banking processes, and obviously interacting with the customers. So how do we ensure that women are not left behind? Because we do know that there is a gender gap when it comes to digital access, digital financial capabilities, etc. And I know that Ujjivan has been doing a lot of work in this space. So can you share how digital will ensure banks can mainstream banking and what you're doing to ensure women are coming along with you?
Okay, as I told you, 92% of our customers are women customers. Yeah. So these customers, we started with cashless disbursement. So before we used to, all the transactions by cash only, disbursement or repayment collections. So we started with cashless disbursement. So that time, we were microfinance company, so we opened bank accounts with other banks and we disbursed loans to that accounts. And first we teach the customer how to use the ATM card. So through our digital journey started from there. So then once we become bank, we open bank accounts to all our existing customers. And we have placed DigiBuddies in our branches. So they used to teach our customer how to make digital payments and how to use ATM card, as I told you, and mobile banking, phone banking, all these customers, but it will take some time. So if you start our microfinance journey 15, 20 years before, paper-based processing time, we used to teach the customer how to put signature. So that 50% of the customers they can write their name, or 50% of the customers, they don't put their signature. So we, for example, Joshua Raja is the customer name. We found the way to teach the customer how to put the signature. I cannot tell the customer to write full name, Joshua Raja. So we started with JR. So in that way, we used to teach the customers. So now our journey to digital way, now 26% of our customers are making their repayments through UPI-based apps. Okay. So in that level, we grown. So it's not about BC model repayments. It's purely customer or their family members making their repayments through PhonePe or Google Pay to Ujjivan accounts.
And the common myth is that women take longer time. They may not be digitally capable. Is that a problem you faced? Is there something else?
It will take some time. So we cannot teach the customer immediately. We have to go to the customer's place, teach them. We have to show demo. First time, second time, third time. Fourth time, automatically they will do. And they will teach other customers to make their repayments. So in that way, our cashless repayment grown to this level.
Yeah, Ashish, please add.
Can I just add a perspective? And it's a perspective if I look back post-independence. I think one of the reasons we took a lot of time is that the time we took to adopting the local languages. Right? So when we did the Smile acquisition early this year and we said we will build a business under Pragati, we said the entire business has to be vernacular. It has to be local language. So if I'm working in Tamil Nadu, it has to be in Tamil. If working in Andhra, it has to be in Telugu. If I'm working with Chhattisgarh, it has to be in the local language. I think that's the single biggest limiting factor, is the way languages, I think it will become a very different conversation if you want to begin to intellectualize saying how the literacy rate would have been very different if you would have just empowered a local language instead of, falling over for a language we are using right now.
Yeah. And actually Ujjivan does.
I have one, okay. So we are working and we are developing one mobile application, because normal mobile banking application cannot be used by these microfinance customers because it's in English and you have to type everything. That is difficult for our customers. So we are working with one company on creating app. So it's voice-based, voice vernacular and visible. So if you see current generation, same our customer segment, everything it's in YouTube. Okay, even how to make dal sambar, people can open the YouTube and they can speak and all the related videos will come. So by seeing this, we are developing the tab. So if you want to, the current tab, they can check their loan outstanding and how many EMIs they have to make the payments. And these are all the features we have it right now. But in future, we are adding up even for the loan facility. If they want to apply loan, they can apply through that app itself.
Correct.
So
Correct.
we are in that way.
Correct. And I'm going to talk a little bit, I'm going to ask you more because I know you do much more work and it's important that people, get these little strategies that you use. I know you use IVR-based calling very effectively. I know there's a lot of work that Ujjivan has done on SMS-based. Do you want to just quickly cover that also and how all of them are like all women customers who are using this?
Correct. So in IVR also, first we set it about connectivity, we improved our connectivity because initial days only 35 customers, mobile numbers are right numbers and our customers are using, otherwise the family members or someone is using. So that we have, clean up our data. So now our connectivity, the contactability is around 70% and 35 customers are reachable. And we introduced drama-based IVR. So how to use mobile application, how to use phone banking, how to use missed call banking. It's all coming through.
Drama based?
Yes.
Okay.
Okay, it will take some time, maybe 120 seconds or 180 seconds,
Yeah.
but they have to, if they listen properly, they can start using that effectively.
Okay, lovely.
So this we started recently.
Right. Jayashree ma'am, you were nodding your head in a lot of what Ashish and Joshua were speaking about. And I know this is a subject very close to your heart. It's not just about enrolling her, right? You have to help her understand the products that she's using so that she uses them better. It's about building her capabilities so that the product benefits her for her lifetime. So tell me a little bit more about the work that you've done in this space.
Yeah, see, what happened that we were already, have had all kinds of products like, of course, saving, credit, insurance, and pension. All these products were there. But what we were seeing was that, they were not using it. That was basically, they were using only credit more. And saving, of course, they were using, but it was kind of, today they will deposit and maybe tomorrow they might have to, withdraw. So this was something which was happening and we were very upset about this, that, how can we are giving all these products and why they are using only one or two products. So then what we decided that, let us understand their financial behavior. And we always wanted that, it should be a life cycle needs. They should have all types of products and they should use all types of products. That's what basically we were wondering, and we were wondering they are not doing it. So when we did this kind of, understanding their financial behavior, the first thing we saw was they were always saying that, aaj kamaya, aaj khaya. So money has come, but they will not use it for, they'll not think about it. That was basically, so no planning. That was, we saw it 90% of them were of this. The second thing was because they didn't have planning, they needed lots of money because, there is some kind of emergency or maybe some other consumption things. So what they were doing, they were again going, of course, we would not give second loan, unsecured loan. So they would go to money lenders and then, they will again go back into the debt. The third thing which we saw was that, even if we were talking about life cycle needs, that they were not using it. So, they were using only credit sometimes and some savings, but insurance, they were not doing much of that. And pension was the last thing because they were, the person who is not even thinking about tomorrow, how would they think about, 60 years? When we are saying 60 years, they will always say, oh, maybe, we don't know whether we will be live or not, we might. So those kinds of things. So we wanted to change their entire, and mindset that why they have been doing this in spite of, they have been working very hard. And so that was the reason why, as you were also saying, it was very early that we started financial literacy. So the first thing was planning that, how can, and they would not understand much of this. So we were using small films for this, and we were also giving some kind of films where it's kind of the same woman, two women, one woman is doing the same work and the same salaries and all those things, but one was wise and the other was not wiser, and how this wiser person has changed their life. So those kinds of films we were making. The second thing which was very important was saving. And it was more kind of what are our concepts. So planning is also a concept, but the second concept is power of compounding. And I would say this is the thing which helped them, because the moment they understood that, okay, we can have interest and interest and interest, and we similarly, we were doing all those kinds of films for this. The third, insurance. My God, insurance was the most difficult, because what happened was that we had, first of all, we had gone to insurance company and they said these women are not insurable. But the bank mein bhi hua tha ki bank, they are not banking, they are never, it was always there. So in spite of that, we did it, and because of our maybe relations with LIC, we did it for the first time, 50,000 women and 1,000 rupees insurance. That was the only thing. One year went off, and then everybody came back to us and said, give us our money back, we didn't die. So that was the kind of thing, and then we started making them understand how the whole concept, and now, of course, all types of insurances. It's not that one insurance, all types of insurance also they are doing.
Yeah.
And pension also was very difficult, but pension the only thing is that we linked it with, because we could not do it because RBI said you can't do it for 20 years. So we had to do it with others, and we went to UTI, and fortunately UTI with the mutual fund, and mutual fund was difficult. It was also very difficult because they were only understanding that they can get interest, and now here it is NAV.
A new concept.
A very completely new concept. So in that case also, we of course did them trainings and all those things, but that was okay. They started it. But what happened was that when they saw that the return of NAV is very high, and they were looking at all the certificates, and then they saw that yes, they were starting with 50 rupees, and when they saw that their amount is increasing and increasing, they started increasing their income, their amount also. So it was a long, we took some time for this, it took some time, but I would say that even if they are not educated, we have always seen that these women are smarter. Sometimes they are smarter than us. So, they immediately understand this, and this is how they were starting.
Thank you for that. Ashish, you wanted to say something on insurance?
No, I just want to agree, women are smarter.
Thanks for that. So I'm going to throw the floor open for questions, and please make full use of the panel here. Is there any questions from the audience? You can come up to the mic, ma'am. I think there's a mic there. Yeah.
So hi, hello. Yeah, hi. So to the respected panel, I would just like to bring this issue in the limelight, that though we are talking about microfinance, we are talking about women-centric loan digitalization, but how far we have come. We are still lending our women entrepreneurs or our women in the rural and the bottom of the pyramid. We're still lending them at 22 to 26%. And whole microfinance industry is driven by women loans only, right? And how we are going to address it going forward. So we are going for digital lending. Of course, digital lending and digital transformation is going to reduce the work and the cost which goes on the field, but how we are going to use it to reduce the interest rates which we are charging our women, we are supposed to support them, provide them support to build their empire, not bring extra cost, extra burden on them. That is my point. And I just give it to you across how you're going to manage it going forward. Hi, this is Sohal Bhardwaj from Sabke, and we are working on digital transformation. We are ensuring that women are supported on field, and we are going forward with certain projects where we assure that women, these customers, are our prime focus and their needs are addressed. Thank you.
Yeah, thank you for that. So I'm going to rephrase her question a little bit. I think it's about how do we make affordable credit available to women at scale. And would you like to take this question first, Mr. Shetty? Yeah.
Of course, this area is wide open in a sense that we have got different players, microfinance institution, bank, private lenders. If you want, somebody wants to have a cheaper rate of interest, is actually, I can say it is a public sector bank, whichever bank you want to. But having said that, all the three players, good number of players are there in this field. But why still people are taking at 26%, whereas what Madam said, when it is available at hardly around 7-8% at public sector bank? Main issue is that the financial literacy is the main issue, that is according to me, because people are not aware. They think that going to bank branch something is difficult, or opening the bank something is rocket science. That is why I think Government of India has realized that this BC model is coming to picture, where they can open the branch without going to bank also. If you are having Aadhaar card enabled, the linked mobile number, biometric open kar sakte hain. Then, as I said, that overdraft facility, 6 months they are operating satisfactorily without asking, without giving anything. They are eligible for overdraft facility. And Shishu Mudra, it's a one beautiful product, up to 50,000, whatever the financial, whatever the microfinance are lending. As you said, sometimes it's as I know that it's depending on the microfinances, so 26% or so, or much more than that. But it is a product where you need not visit the bank branch. Digitally you can do that, end-to-end digital, 50,000 at affordable rate of 8 to 9%, but still things are not happening. Although the products are available, all the public sector bank products are available, it's not happening just because of one thing. I should say that is financial literacy. Because they are not aware of the things, what is the rate of interest, and it can happen. For example, in Union Bank of India, if you have U-Mobile, if you want a personal loan, if you are a customer of Union Bank of India, you may not visit a bank. You can just apply online within 5 minutes. I assure you, if you are CPL score, everything is pakka, everything is checked and it will create it to your account. That is the power of technology. But this also available for Shishu Mudra, up to 50,000 where microfinance institution lending. But still they are existing. Why? Because financial literacy is a thing. Of course, every player has their own part of share, but unless and until if you improve that, whatever may be our literacy percentage, unless a customer is aware of these available things, what are the plus and minus of it, then our 26% or 36%, whatever, definitely it will continue. But having said that, if you see, I joined a bank as a RDO 34 years back. If I compare that period to this year, it has improved a lot. I should say a lot. When I joined a bank, banks are not, for your kind information, nobody is giving housing loan for your kind information. Nobody was giving housing loan for house construction from public sector bank also. Now you see, you will get a lot of SMS, phone call, whether you would like to have a housing loan at this % of rate of interest. It has improved. I do agree that, but we need to improve upon that. That happens. Individual option whether to go here or not there. And of course, this is a topic is woman-centric. When we educate the women in this regard, they will be spread all other people also. They will help that this is a product is available. It's a competitive rate of interest. Would you like to have? Of course, individual might choose their bank or product depending on their CPL score also. If the CPL score is very good and rate of interest is very good in all the banks, it is not I am telling a particular bank, but customers are not aware that. So my thinking is that this financial literacy where we are lagging behind, at 27% of women and 27% for 24% women and 27% men. If it improves, definitely I think those things will be automatically take care. If I'm aware that this product is available at cheaper rate, definitely I will not go for a higher cost. Of course, everybody is pricing their product based on their risk perception and the business model they are operating in. That is always there. And then customers have the choice whether to go to this institution or that institution, it will come into picture. But till then, I think it will continue.
Sure, thank you, sir. I think ma'am wants to add something. Jayashree ma'am, please go.
Yeah, no, as per the, terms of this interest, first thing is that for housing, so actually it is for affordable housing, our interest rate is 9%. And the other thing is that, if it is for maintenance of their houses or something, or repairing their houses, it would be at 12%. And for, of course, if it is unsecured loan, then it would be 18%. But I want to say something else. See, because it's a cooperative bank and it's a bank of our women, our board members are also women members who are our members. So they are also entrepreneurs, I would say. And first time when RBI changed that, it will be deregulation of interests. And we had to ask, we were asking to all women members who were the board members that, what percentage we should keep in. And they were saying, because they were entrepreneurs, that they knew exactly what they should do. The first thing they said was that don't put it much higher, so that these women would, maybe they wanted less, but they will have higher, then they might lend it to others. This kind of, and that is happening, you know that, right? The second thing they say that, we should also see that if it is very less, then it will be difficult for us, and we will have to. So for all products, they were saying that for this product it should be this much. So this was something, we were also so much interested in this key, how these people are doing, but because they know in the market and in everywhere that, what type of interest we should give and take. So this was something, which I would do.
Sharing. Would you like to add anything? No. Okay. Happy to take one more question, if there is. Okay, lovely. So I think for me, what we have shared today are some very practical strategies, changes that we can make at the channel end, investing in BC Sakhis or investing in capacity building of the last mile channel that Mr. Shetty spoke about, products, processes and approaches, different approaches, and how you need to invest in women.
Ma'am, I have a question.
Sorry, I can't see where. Oh, so sorry. Okay, so you want, go ahead.
So hi everyone, I am Debalina from MSwast, and we build healthcare services, healthcare and insurtech services at an affordable rate. So my question is to Jayashree ma'am, where she pointed out rightly that, women were not very keen on insurance. So ma'am, my question to you is that what changed in their behavior, or what need-based solution or strategies, you have devised to make them understand that insurance is not an expense, but it is a necessity?
Yes, the first thing was, when we were talking about financial literacy, in financial literacy, all the concepts which were of insurance, we actually made them understand exactly. And as you say, we are also making lots of films and other things, many tools, and then we tried to make them understand that, this is why it is important. But we are also saying that, you are a group, and maybe this is not beneficial for you today, but it will be for others. So that kind of concept also we were given. And the third thing was that whenever somebody has died or something, we would have some kind of group of people and conference kind of thing, and we will tell them, give that check to them, so that so everybody will feel that, oh, they have got this kind of, so some kind of marketing and some kind of concepts.
Thank you, ma'am. That was very useful. Yeah, so I've been told to summarize.
But can I say one thing? Please. Because told this to all these 3 persons, but you didn't ask me about digital things.
I didn't.
So our women are also, so we have also technology and our women are also doing it. And
course.
I won't say it's 40% of women are now using it.
Yeah.
So
I don't know, 100%. So I'd love to summarize this session. And for me, at least, I can share, 2 key takeaways. The first key takeaway was an aha moment when I first thought about it, is that you don't, as a banker, you don't need different products to serve women better. Maybe you need a different approach. Maybe you need processes. And some of the approaches and processes we spoke about today was, looking at products like savings and promoting it in a different manner. We spoke about gender intentional channels that banks are investing in, BC Sakhis that banks are looking to invest in, making digital financial products relevant for women, and of course, looking at technology to make credit more accessible for women at scale. But the second takeaway was, and this is a very important takeaway, that you also need to invest in building the financial capabilities of women alongside these products and processes. This takes a little longer, but it's worth it. Once women understand the benefits of using a product, they use not only their products, but she'll go around and tell 5 more of her friends the benefits of the product. And this is something that Seva has learned over years. I know that most of the bankers that we speak to intend to be gender inclusive. They intend to do all that we've said here, but sometimes the practical part of banking gets in the way, and I'm hoping today that we shared some concrete strategies that will help a lot of banks target women, reach women, and serve women better. There's an oft-quoted proverb: if you want to go fast, go alone. If you want to go far, go together. For women's financial inclusion, we suggest that if you want to go faster and further, go with women. That's it. Thank you.
Thank you so much indeed for a wonderful conclusion to a very productive session. Thank you very much, our moderator, Pallavi Madhok, Head Advisory Services India, Women's World Banking. Thank you very much, our esteemed panelists, for being here with us today. Well, this session closes, and as a token of our appreciation, we'd like to give you mementos on the way. You'll get them, receive them on your way down. Thank you very much. We'll just take a couple of minutes to clear the top table whilst the group photograph is being taken, and we'll move straight to the next session. Thank you. Let's give them a warm round of applause, ladies and gentlemen. We'll move into the next session, and whilst the top table is being cleared, I'll just talk about the next session: Digital Financial Inclusion, Lessons from Indian and Global Breakthroughs. This is plenary session 4 on the last day of this conference. Digital financial services seem to offer an important opportunity to both deepen and broaden financial inclusion by using technology to reduce costs, increase efficiency, and better tailor products and services to meet real needs. This session, ladies and gentlemen, will examine the role of technology and digital transformation in realizing the vision for digital financial account ownership, account usage, gender gap, and mobile phone ownership in India. The session will focus on what is currently happening and some learning from global breakthroughs in inclusion for all. Can the digital transformation of financial institutions really reduce their costs and make them more inclusive? Given the limited smartphone ownership and not all of them being used for financial service in India, what role can fintech play in deepening and broadening financial inclusion? These are some of the indicative questions the panel will discuss. Is our top table clear? It's done. So, ladies and gentlemen, let's give a warm round of applause as I invite our moderator of the session onto the stage, Mr. Graham Wright, founder and group managing director of MSC. Let's give him a round of applause, please. Our speakers are Hilary Miller-Wise, Deputy Director, Digital Financial Services, Gates Foundation; Ian Browham, Vice President, Digital Transformation, ASEAN; Aranjoy Dhar, Senior Director, Microfinance, BRAC; Rupali Kathuria, Manager, Social Impact, South Asia Center for Inclusive Growth, MasterCard. Our moderator is Mr. Anil Kumar Gupta from MSC. I beg your pardon, sir. Our apologies. Let's give him a warm round of applause. Mr. Anil Kumar Gupta. The session duration, ladies and gentlemen, is for 1 hour, and we're really coming to the close of the second day. So we'd like to have this session interactive, with lots of enthusiasm and enjoyment as we come to the close of this conference. Over to you, sir.
Hi everyone, good afternoon. I see a lot of empty chairs and I think that clearly tells that we are about to close in some time. Nevertheless, this is a plenary session and I have a pleasure of having such a very interesting panel. And one thing which we like to do differently in this panel is that in last 2 days we have spoken a lot about what's really happening in India, and probably we are trying to learn from that. In this session, we have experts from the different part of the world, and we will try to learn and better understand that what is that we can learn from them. There are so many good experiments, so many good learning that we have in different parts of the world. Probably this is the time for us to take a step back and see, can we learn, can we improve on what we are already doing. So before I start, I would like to invite all my panelists to speak for a minute or two to tell who they are and the role that their organization is playing or aspire to play in the space of digital financial inclusion. So can I start with Hilary?
Thank you. So I'll be very quick. I was already introduced. Hilary Miller-Wise, Deputy Director at the Bill and Melinda Gates Foundation. Our role is really to incentivize innovation, to support players who are really driving financial inclusion, and particularly closing the gender gap in financial inclusion. So we're behind them and supporting them in a variety of ways.
Hello everyone, my name is Ian Braum. I am leading our digital transformation advisory programs at Axion. For those of you who aren't familiar with Axion, we're an international non-profit which is focused on driving financial inclusion through 3 core strategies. We invest in institutions that have the capacity to drive financial inclusion at the MSME level. We provide advisory services to institutions to digitize their operations and allow them to provide digitally enabled products and services to the customers they serve, and we influence through the research and the insights which are driven through our independent think tank, the Center for Financial Inclusion. Thank you.
Hi, this is Aranjoy Dhar. I'm the Senior Director for BRAC Microfinance. So BRAC Microfinance is part of BRAC, and a lot of you already know BRAC, but just a small intro. So BRAC is the largest NGO in the world and coming from the Southern Hemisphere. And we do a lot of things in addition to the microfinance. That includes health, that includes education. We run about 10,000 schools. We do have the largest legal help system for our people. And also we run climate change and a lot of other programs. So basically, through all these things, BRAC believes in an integrated development program where finance becomes an integral part of it. But then when we do not look at the other things like education, legal help, and also the health programs and education of our children of our beneficiaries, then the whole development actually do not have a meaningful outcome. So that's why we look at the whole program in a total picture and then try to get things done for our beneficiaries. Thank you.
Hi, I'm Rupali Kathuria, and I'm from MasterCard Center for Inclusive Growth. At Center for Inclusive Growth, basically, we work towards creating sustainable growth and financial inclusion across the world for the underserved sections of the society. So specifically in India, we are working towards 3 areas which are driving revenue growth for micro and small entrepreneurs, accelerating profitability of the farmers, and supporting women entrepreneurs and helping them build financial resilience. So we have various initiatives under all 3 pillars, and we have, working with a lot of partners. Axion is one of them, where we, work with various partners to support these 3 pillars.
Yeah, so thank you all for introducing yourself and about your organization. I think the hypothesis here is that digital financial inclusion can deepen and broaden the financial inclusion. This is the topic that we are going to talk about. So before we talk about that, I just want to put out a framework, in the sense like when you look at functional framework of technology, like what is that it should be doing. So I look at 4 parts. First part is all about savings and investment, and this necessarily means that you should have account. So a lot of work which has happened across the world. So for example, in India, we have Aadhaar, which is the foundational ID, which allows you to open the account and then people can put in money into that account. In Bangladesh, we have national ID, and this national ID has been repurposed so that you can do your KYC for opening the account. The second part of the functional stack is what we typically call is spend or payment. There's a plethora of innovations happening across the world around payments. Of course, there are a lot of work that we still need to do around the use cases of those payment services. And of course, in India, UPI is a classic example. In Brazil, we have another very interesting example by way of Pix. The third part of this functional thing is lend or the credit. This is where I think a lot of bankers or a lot of financial services provider would like to go. Some work which has happened, some island of success, but still I would say there is a long way to go. And we have to see that how do we reduce the cost and still reach the scale. So that's the third part of it. Fourth part is how I will put it more like a protect. So wherein we are talking about insurance or the pension type of schemes, wherein we can we sachetize them, can we use the technology to advance that. So these are the 4 actually large bucket in terms of financial inclusion. And I know that Arinzo would still go beyond that, and when he talks about the integrated development. So what we see globally is that there is a very promising trend, which yesterday morning while Sania was talking about, she said that number of account ownership has really increased from 51% to 76%. And of course, a lot of these things have happened because there are technology development, and this is the reason why we see enormous growth in terms of account, and to certain extent, usage of that account. What we also see is that 36% of the adults, they receive payment into account, and if you look at this 36% as a total number, 83% of them, they are able to make digital payments. Similarly, if I'm coming back to India, there is a tremendous success that we have seen thanks to Prime Minister Jan Dhan Yojana or PMJDY. As we speak, we have around 480 million account. They have something like $23 billion of balance with the average balance of $48. So it's tremendous. It's a tremendous progress, I would say. But still, barriers exist. There are plenty of barriers that we see, and despite so many accounts that we have in India, still 20% of people in India are unbanked. In Bangladesh, it is around 47%, and in Indonesia, it is around 48%, as per the last Findex reports. Of course, things are moving on year-to-year basis.
If we just go down a little bit lower, we realize that account ownership rates, they remain lower for low and moderate income people, women and young adults. And our research, a lot of research that we do in the market, in multiple markets, we realize that there are evidences that say women lack the skill and confidence when using their accounts, and they face challenges when accessing the nearest financial institution. There is a little bit of paradox here. What we also see in some of our research in India, that you have the access point near to people, say something like a business correspondent, but people don't trust them, people don't use them. So they continue to go to bank branches, though they are little far and they are not very convenient for them. So with that, actually, I come to my first question for Hilary. Like you have seen some of our reports, and our reports suggest that 30% of women in India, they are proxy users. So it means that like there is someone else who is using those type of account, and we have to depend on male members to operate the account. What would you do to address the gaps in financial inclusion? And I would like you to draw experience and learning based on your other work, which foundation has been doing, or you yourself are personally involved in.
Great, thank you. So I'll reference some of the research that the Gates Foundation has supported in Africa, mainly in 3 countries for this data, in Kenya, Cote d'Ivoire, and in the DRC. And there are a few things that we found, and one thing that we often say is women is not a segment. When we're talking about half the population, that is not a segment. And so I hesitate a little bit from speaking generally about what women want, because even within the market, you're going to find a lot of variability on things like their comfort level with digital financial services, or what they want from a Kiko agent, etc. So, but let me speak about these 3 cases and some of the findings that we had. The first one was around transparency of costs. Even in a place like Kenya, where digital financial services and mobile money is quite sophisticated, there were customers who still didn't understand, women customers who still didn't understand what the fees were, and they felt that either there were hidden costs, in their words, or that they were losing money. And they weren't losing money, it was just the fee that was being taken out. So even in a market like that, we have more work to do. The second is, I think many of us would agree that that having more women agents can be beneficial, and there is some good data that does show that women do prefer to work with a female agent. The research that we did in Cote d'Ivoire showed that women preferred, there was a 7.5-point gap between men and women and the gender of the agent that they preferred. And what was interesting, even more interesting, is that women actually transacted higher volumes, higher values with women agents. And even beyond that, many of the women customers would seek out women agents, so they would travel a further distance to find a women agent when they had larger amounts to transact, just because they felt more comfortable and they felt they could trust it. At the same time, when we talk about transparency, there were some interesting findings around notifications. Women wanted notifications, they preferred the notifications, and if there was a delay in the notification, that obviously would make them trust the system less. In Kenya, what was interesting is that women wanted more control over the notifications that they got, because they were worried about their husbands seeing that information. And there's actually an interesting, this was not something that Gates Foundation was involved in, but there's a fintech in South Africa that had developed technology to enable, you could enter a short code, and that would signal to the fintech that someone was maybe asking you for your balance information, and you didn't want to share it with them. And unfortunately, in a market like South Africa, there's a lot of crime, and you would have people who would know that you had money on your account and want you to transfer it. But women started using it so so that they could have more control over the communication in the household around the money that they had in the wallet. So these types of operational issues are really critical. I do want to point out, though, and there was a point that was raised in an earlier session around the burden that sometimes we're placing on the agents. So these is what I would call assisted transactions, which is what I think you're referring to. That research that we did, and I just actually want to quote this agent. The agent felt like it was putting too much burden on the agent to actually help the women customers. And what he said, it was a man, and what he said is, it's not my job to do more than I've been trained to do. I was shown how to do transactions, how to welcome clients, and how to avoid risks and mistakes. I do advise clients, but I earn very little, and it exhausts me and brings me nothing. And so on the other side, I do think we have to think about what is the burden that we are creating on those agent networks, right, who own these agents themselves. And is there a way that we can solve for some of these issues that have knock-on effects, right? So still continue to support women, but do it in such a way that it doesn't create negative externalities elsewhere in the supply chain. The last thing I would just want to point out, and this is something that in India you no longer really have as much of an issue, but is the point around IDs. Outside of India, I think broadly the numbers are that women, something like 44% of women don't have an ID, where something like 28% of men. And we are doing a lot of work to support access to and the development of ID systems and payment systems, much like Aadhaar and UPI in other markets, but we have a long way to go. And what we're seeing in those studies is that in many cases women will register under someone else's name in order to do the transaction because it's easier to get the documentation from a husband or a brother, etc. And so they're solving for the issues that they have, but of course ultimately we're not getting visibility into their transactions. So I do see a lot of promise and a lot of potential, but I think we have to think about women as broader, more segmented categories to look at things like how do they interact with the Kiko agents and what do they want from the whole experience end to end. Thanks.
Thanks, Hilary. In fact, you pointed to a very interesting data, that is like how many women have IDs or how many women don't have IDs, because this becomes the first point to enter into the formal financial system. If you don't have this basic thing, then anything that you want to do on the digital side, I think it's very, very difficult to really do it. So yeah, thanks for bringing this up. So let me move to Ian. So like that we have something like say 700 to 800 million smartphones in India, and we believe that not all of them are unique. Like if you look at this tele-density in India, they would like to say there are more than 1 billion SIM. But for example, in my phone, I have used 2 SIMs. So if there are more people like me, it automatically means only 500 million people are included. So I apply as some kind of a guesstimate on that, and I see that probably 40% of Indians are unique users in terms of smartphone. And since like if most of the fintech, those who want to work with this with any customer segment, they prefer to have a device, and that device happens to be a smartphone. So considering all these challenges or all these things that we see, say, Indian market, what do you see that role that fintechs can play in deepening and broadening financial inclusion? Because this is something which is, I think, probably bothering most of the people, that how do you really go beyond that?
Yep, absolutely. I think it's a great question. And I think that the role that fintech is going to play is a collaborative one. I don't think that the lack of digitization at the merchant level necessarily means that it's not possible to serve those merchants with inclusive finance, which is digitally enabled. What I think it does mean is that the role that those fintechs are going to play is more of an enabler to the types of institutions who already have a physical touch with those merchants, rather than as a standalone proposition where they're serving those micro merchants directly and owning that customer relationship. And we see examples of this from different markets. You can take supply chain finance, for example, and we see supply chain finance models in India, we see supply chain finance models in Africa, and the approach that some of them are taking is slightly different in the sense that they'll go into a market and rather than aim to digitize the MSMEs directly, particularly in instances where there's a lack of smartphone penetration, they'll focus on trying to digitize those organizations that have that physical touch. So one example would be identifying an FMCG distributor and looking to digitize the sales and inventory information that they get when they're visiting merchant locations and they're taking inventory stock orders. What this means is that they're then able to get access to digitized inventory of those micro merchants without necessarily asking them to change their behavior in any kind of significant or relatively significant way. The effect of that is that to replace, thank you, they can achieve an awful lot from an ecosystem of players through that collaboration, and it can be incredibly impactful. The challenge with that model is it requires you to bring together a lot of different players and to make them all work from the same hymn sheet. I mean, even in these supply chain finance examples, you have an FMCG distributor. In some cases, you'll have an FMCG. You have a financial institution that's extending the credit, and you've got a fintech which is stitching everybody together with technology, and they've all got to come together. They've got to agree operations, they've got to agree commercials, and goodness knows what else, and that is very, very difficult, and it's something that we've seen is very difficult. And in fact, within Axion, a big focus of ours at the moment is to really understand what are those inclusive models of where you're bringing together a number of ecosystem players to collaborate. What do they need to look like, and what are the elements that need to be within them in order to make them successful?
Thanks, Ian. I think if I were to say that, probably two things which you said very clearly. One is that what we classically call phygital model, which is a combination of physical and digital. And second is all about adjacencies. So how do you exploit the adjacencies to make sure that digital works actually in those areas. So quickly moving to Arinjo. So Arinjo, probably you heard him that he comes from the BRAC NGO, and I think they take a very different approach to the inclusion. This is more about integrated development. So I think we would like to hear more, Arinjo, from you, that what do you mean by integrated development and how does it fit in within the overall inclusive finance agenda?
Thank you. So this is a very interesting topic because BRAC from the beginning believed in a theory, that the theory of change is basically, if we want to make a change, we have to look at the overall situation of a person. So as we know, poverty is very complex and has it's multifaceted. So one solution does not solve the problem. So just to give an example, so when we hear about climate change, the southern part of Bangladesh, if you ever go there, that's the real story of climate change. If you go there, thousands of acres of land are barren. People have no livelihood because they used to do fishing and agriculture, so it's all gone now. Cyclones are hitting like every month. Before it used to be like once in a year. So basically they practically have nothing, right? So now if I go and do microfinance there, it doesn't mean anything for them, right? Having money has no sense for them unless I create livelihood for them. So in that area, we did a pilot last year. So what we did was the land has become so saline because of the, the water is coming in repeatedly from the sea. So you cannot do the paddy or any rice cultivation like before. So we brought a particular seed of a crop, which is a mustard, which is actually saline tolerant, and it can actually grow there. So we organized a group of women there, and the first time farmer, we gave them the mustard seed, we gave them the expertise, we taught them how to do that, and people actually laughed at them because they're the women, they've never done farming before. For the first time they're doing farming, and people did not believe that the mustard can actually grow there. But actually 4 months, 5 months later when we went there, it's a striking kind of scene that thousands of acres of land are barren and 3 bighas of land where we did the cultivation is green. right? So that's the hope they have now. So they have a product to sell now. They have the mustard which is growing up. People are coming to buy from them. Now if we go and do microfinance, it will work. Similarly, we have done fish farming there. So we found out fish which can grow there. And we have done the water treatment plant. We have done the water purification and so on. And then with the pilot project, we have proven to them that this can work. And then we are doing microfinance, right? So take the example of the farmers. So when we do, 30% of our portfolio is actually farmers in Bangladesh in BRAC Microfinance. So you have like 8.5 million clients. Out of the 30% are farmers. So basically what we have done is like, we look into not only like financing them, but we also look into like where do we get the seed from, the quality of the seed, the quality of the fertilizer, and also linking them with the market and ensure that they have a fair price. We also have started a insurance policy, crop insurance in Bangladesh. We are now piloting with 10,000 farmers. We're going to scale it up to 100,000 farmers this year, and in the next 3 years we have a plan to scale it up to 1 million farmer. Excuse me. So basically the insurance works like this. So during the harvesting time, if the crop is damaged because of the excessive rainfall or excessive heat waves, or there's a less yield. So let's say the farmer got 1 acre of land, he got like 100 kilos of potato in the last 10 years, but this year he got 90 kilo. So that insurance policy will pay the shortfall of the 10 kilo, right? Or if there's excessive rainfall, if the crop is damaged, we'll pay for it. So that way, we are not only microfinancing the farmer, but also we are helping him or her with the quality of seed, quality of the fertilizer, and the money. And during the harvesting time, the crop is protected by insurance. And towards the end, when the crop is coming out, like he's getting the harvest, we are actually linking him with the market. So we are looking at the entire value chain to give him an end-to-end solution, right? So currently, the third example is like, currently we are working with, you must have heard of Sundarbans, the largest mangrove, right? So Sundarbans, we have like almost like 1.5 million fishermen, who are all kind of extracting the most expensive, resources from the nature, like the honey, the fishes, various expensive sea fishes. But then if you look at the price they get, it's nothing, right? So for example, the middleman makes the money and they get literally nothing. For the best quality honey, they get like literally $3, 1 kilo. And we pay for the same kind of honey, we pay $25 at least. So there's a massive gap of 8 times. So we are now working with them to see like, what proposition we can build to kind of give them a microfinance, also to do the fair price. So for that reason, like BRAC has a retail sales outlet, which is called Arong. And that's exactly what we do to do the market linkage of the artisans and any kind of other products to bring to the Arong shop, sell it directly, give them a fair price. And we are also opening 6 stores in India this year for Arong. So basically these are the 3 examples like I'm giving whereby we look at things from an integrated development point of view. Just the money does not solve the problem, but we need to look at the entire value chain, entire solution, and help them and to connect them with the market. Not necessarily we have to solve all the problems. There are people who are solving the problems, and we can connect them with, we can just connect the dots and solve a lot of these problems.
Thanks, Arunja. I think this is a very interesting twist to the finance. What I would prefer to say, it's more like a sustainable finance. In the sense, if your clients are healthy, your organization will also be healthy eventually. And it requires a lot of backward and forward linkages, whether it's a supply of input or probably connecting them with the market, I think. And I think probably this is one of the conversations that we have been having in India. And if you see the National Financial Inclusion Strategy document which has come out from Central Bank in India, last couple of years back, it talks about livelihood now. So it wasn't there actually earlier as part of the financial inclusion agenda. Okay, thanks for that. Moving to Rupali. So Rupali, you have seen like last 2, 3, 4 years, we have been like flourishing, and then there was a COVID and a lot of things actually happened. A lot of things were pushed back, and it has serious impact on particularly on small enterprises. So you do a lot of like, your organization has been supporting a lot of work around the small enterprises. So we are still recovering from the shocks of COVID. So we would like to know more from you that what do we need to do to recover from the COVID, more so in the context of small enterprises. And if you want to layer it with women-owned enterprises, that would be fantastic.
I think the first and the foremost solution which everybody has been speaking about, and it's written very popularly now, is digitization or digital transformation of the small businesses that can actually help them recover and also build resilience to overcome any of future shocks. So yeah, at Center for Inclusive Growth, we work, very closely with the small business our partners and entrepreneurs, help them digitize. And I think we all know that digitization basically can help small business entrepreneurs, cover three things and actually enable small business entrepreneurs do three things through digitization. First being that, they can actually connect to wider markets, they can reach out to newer customers, and also, it opens up new channels for them to sell online. The second being, it improves the access to capital, and as my fellow panelists just spoke about that, access to capital, we all know that it's one of the major challenges that the small businesses have been struggling with for many, many years now. Third being, it improves the business efficiency because small businesses can actually, focus more on the core of the business rather than, things like accounting and bookkeeping, for which now they can use a lot of digital tools which are available in the market now. I think all of these things are very well known now, but something which I would really like to share over here is, and I think SMEs also recognize today that digitization is imperative and very pivotal to their growth. However, I think what we are realizing in the market is, and through our on-ground work, is that while they digitize, but there is, they've not been able to sustain, the ecosystem is not helping them sustain to be digitized and actually reap the benefits of digitization. So few things which are really important in terms of, helping them, continue using digital tools. One being that, there has to be some tailored training and tools should be available for small businesses, because given our country is so diverse, and I'm talking about India over here, that our country is so diverse, every business has a unique need, and the tools which are available in the market today are very generic. So there is a need to build customized tools for these small businesses. Also keeping in mind, as you mentioned, that focusing a little bit on the gender angle over here, women are using digital tools in a very different manner in comparison to men. So there is a need that, there is a requirement for women especially, that, if in case, I have to give you an example of one of our, initiatives where we work with women entrepreneurs. They require a little bit more hand-holding as compared to men. While they're more experimentative, they're more open to using new different tools, but they need a little bit more of hand-holding and support as compared to men. Similarly, the cultures are different. If you move from one city to another, there is a major change in the cultures. The nature of business is different. So there is definitely a need to, create tools which actually meet their unique needs. The second bit is, as I said, that they require more of hand-holding, so that training is required. So there is a need that, companies and organizations like ours should come together so that we can help these SMEs get trained to use these digital tools. And I think the last bit is that the entire ecosystem needs to come together to support the cause of digitization. Otherwise, what we are seeing today is that people who digitized in 2020 have stopped using the digital tools. So just to ensure that they keep using these digital tools and get the benefit out of it, everybody needs to come together so that we are able to help them sustain in this digital economy.
Thanks, Rupali. Any example for that, like how can ecosystem partners, they can come together to sustain this digital journey we started, say, in 2020?
Sure. So, see what, let me give you an example of what we are doing. So, and I think like we're working with Axion, we're working with BRAC, we're working with Access Development Services, we're also working with a lot of, state governments across the country. So, I think everybody needs to come together to see that how we can benefit the beneficiary, the small businesses, and especially, businesses who are actually micro and small, because the small and medium have at least reached a level that they can, train themselves, but the micro ones are really like, if you see a Kirana store owner would require a certain amount of either, the kind of digital tools the Kirana owner would require, or a women entrepreneur who's running a Kirana or would require, is very different. So I think we need to understand that what is the need, and then bring in the partners who are, expert in that area, so that all of us can brainstorm together and then take the solution to these beneficiaries. Otherwise, I think they would be left behind. That is what at least we've been observing on ground.
Thanks, Rupali. I think these are very insightful comments. In fact, what we also see that if you see that how accounts are getting usage and what's really happening is that generally the most common usage is all about receiving the payment or making the payment. So that is where I think most of the accounts are getting used. Probably the next use case is all about that using it for saving and credit. Of course, credit is very, very important in the lives of people where there is a high income volatility in their lives. If you really look at that, how people are using their accounts and how many are really able to use it on their own, I think data is not really encouraging. So I'll not go into much of the data because this is something that we have discussed since yesterday. Only things one which stand out is that only 11% of adults in India and 2% of adults in India made a digital in-store merchant payments in 2021. So this is of course, I'm hoping that this number has gone up tremendously in last 1 or 2 years, but probably there is a really long way to go. And of course, there is a huge digital push, and there is I would say there are a lot of organizations which are working in this space. For example, in India, there are a couple of organizations, for Google Pay, they are trying to make sure that people are able to use this for different type of payments. But this still continues to be one single large use case. In terms of credit, if we see, there is a huge gap actually. It's not only about India, that globally we see that like people estimate that digital credit will rise to something like 890 billion in next couple of years. But if you look at the gap is in trillions of dollars. So gap is something like $4.9 trillion. This is what they are quoting, the numbers are quoting. They are island of success in the sense like there are places where good things are happening. For example, in Tanzania and Kenya, half of the people they are able to borrow using digital channels. And of course, it's not that everything is responsible, everything is productive. So I think Hillary is, I know that she is smiling that there are so many challenges all around that. Only thing is that how do we use those type of things to get into small enterprises? But at the same time, I see very interesting experiment happening in Indian market, which is what we are calling it credit democratization using account aggregator and open credit enablement network. So basically, people are trying to use the financial data which are lying for a particular person at different places, collect it and try to create something out of it and then offer them credit. So there is one experiment which is live actually in India. It's little early to say that how far it will reach, whether it can become a kind of a aha moment like what we have UPI in India, but I think time is going to tell. Because it's not easy that, it's not as easy as payment. In case of payment, money moves from account to account. You have money, then only you can move. But in case of lending, money moves from the lender to the borrower account, and that you need to recover. So I think there is a bit of challenge. If people are not very comfortable lending, they are not going to lend. So Rupali, probably I'll come back again to you because you spoke about digital tools and all other things. Probably you want to talk more about that. What is the digital transformation that financial service providers they need to do? Because you talked about the ecosystem. So ecosystem includes like for for the purpose of lending, the biggest ecosystem player is your financial services provider. Can they really go onto the journey of digital transformation and really help this segment?
Yeah, absolutely. And I think, as you rightly said, that this is something which is already happening as we speak. And, you know, we are seeing, especially, you know, the smaller FSPs, they are more agile and ready to experiment and ready to move online. And I think the biggest advantage if FSPs move online is that, you know, they can see the digitized small businesses who are online. And also, this will help, you know, addressing the major challenge which SMEs face today, which is of access to capital. Once the MSCs are, the SMEs are digitized, and they are also, you know, they build their digital track record, digital footprint, then the digitized FSPs can also, you know, see them online, and they can track this data and use this data as an alternate to collateral. That which actually today a lot of these MSCs do not have at this point in time, and especially women in the country who do not have you know, any property in their name, so they can't declare any collateral. So I think if they have like a digital footprint, then FSPs can easily, you know, or the banks can easily lend to these MSCs. And I think as simple as that, you know, in our partnership with Axion, we are working with Annapurna Finance, just to give you an example, and we have built like a emergency loan solution with them, which is like SMS emergency loan solution. So, and that can be availed through a feature phone. So it doesn't have to be on a smartphone, or the, you know, the SME doesn't have to go to the bank or an FSP, but actually, you know, through a feature phone, connect with the FSPs and get the loan granted. So it's very important that, you know, while we are building tech solutions, it's important that these tech solutions have to be very simple, which can be actually adopted by smaller FSPs and also smaller MSAs. I think that's something which is the scope which is open at this point in time in the country.
Thanks, Rupali. I think you are showing a ray of hope even for the feature phone users, which is becoming more and more important, particularly from the inclusion perspective. So thanks for that. Coming to Ian, you have been working with multiple MFIs in India and outside, and probably a lot of your focus is all about digitally transforming them. So what are the lessons that you want to share with the audience, and what is that we can learn from them?
Yeah, I think that's a really big question. I mean, as Rupali mentioned, we've been working together to digitally transform 9 different institutions across the globe over the past 4 years, and there's an enormous amount of learnings which are coming out of that. I mean, I think if I had to pick 2 of the most important ones, or 2 of the biggest ones, I think the first would probably be prepare to fail, and that's very different from aim to fail. It's make sure that you are, you know, prepared for things to go wrong, because digital transformation is incredibly complex, it's very expensive, and the likelihood is that at some point along the road, something is going to go wrong. And I would say that success is more determined by your ability to pivot and learn from failures than it is your ability to get everything right first time round. So that preparation is really important. And we don't just mean, you know, prepare your operations. We mean prepare your forecasting, prepare your budgeting, make sure you've got the provisions within your operating model to, if something does go wrong, you can accommodate that, you can learn from that, you can implement changes based on what you've learned, but most importantly, provision for failure when you're managing internal stakeholders. I think this one is really, really important. You have to set that expectation internally, particularly to your board and your management team, that it isn't going to be a smooth ride, that there are things that are going to go wrong, but those things are going to be the learnings that eventually allow you to succeed. So that would be my first one, is prepare for failure. The second one, I think, would be that digital transformation isn't just about technology. So I think in our experiences over the past 4 years, we've seen that it's much more impactful from the perspective of driving usage among MSMEs to be changing the internal infrastructure of the institution rather than focusing solely on changing the customer experience. And what I mean by that is that the majority of institutions who are at the beginning of their transformation journey are not set up in a way that is conducive to being able to launch digital products and services. The way that the business is the organizational design, the structure, the way that the commercials work, the way that different levels of management are incentivized, they're just not set up to be able to launch something like a digital loan. And the moment that you drop a digital loan into an institution, there's an enormous amount of change which is required in order to allow them to operate that. So with that respect, I would say that when you're putting together your digital transformation journey, make sure that you take time to look at the different areas internally that those digital products and services are going to impact, and make sure that you invest the money and the resources to adapting your organization to being able to operate them. So, huge question. I could probably go on for a long time, but I think my top two, my very top two, if I was going to have people focus on just two things, would be those for sure.
How easy or difficult it is to convince the management that probably this can fail? And what's the percentage of failure actually, if I were to?
I would say that maybe I won't go for the percentage of failure, but I would say that the percentage of organizations undertaking digital transformation that reach a point where they're looking out and they're saying, look, I don't know if this is going to work or not, we're at a make or break point, is probably close to 100%. I think if you've seen a successful digital transformation and at some point they haven't had a moment of crisis, no matter how private it may have been, I think that would be a very, very high. In terms of convincing the management team, I think it varies. I think if you start from the beginning, and you're very clear about the investment required and what that investment provisions for and when you can expect to see returns, it's obviously a long-term return on investment when you're talking about digital transformation, I think you'll have an easier ride. I don't think it will be easy in all circumstances. Obviously, it depends on the composition of different board members and management teams, but it'll be easier. If you don't start with that narrative and then you bring it on at a later date, I think you've got a much more uphill battle. So I think, difficult to say how easy it is, but if we're talking about comparatively, starting from the beginning will certainly give you a leg up than not, and overselling the benefits and overselling the timelines of which you might be able to realize those.
I think the trick lies in the probably showing the reality that what possibly can happen, and probably how much time will it take, and what's the cost, and probably that I think that's easier thing to say than actually doing it while you are sitting with your management. Okay, thanks for that. So moving to you, Arinja, in fact, the BRAC has been at the forefront of digital digitizing their transition, and I think there are important lessons from your Bangladesh operations. So would you like to share some of those lessons with the audience here?
Sure. So when we started our digital transformation journey, we looked at three principles. The first one was how it is going to help us internally to kind of reduce our cost, make us more operationally efficient, because we have close to 3,000 branches. We disburse about $30 million a day, and we also collect the same amount of money every day. So for us, the transaction cost is huge, massive, right? So even if we can improve by 10%, that is a lot of savings. So that is number one. Number two was how it's going to help our customers in terms of customer experience, right? How it's going to make their life better, faster, less time consuming. And the third question we asked ourselves is how it's going to help our customers to have a livelihood through digital journeys. What you can do to make it happen, right? So coming back to the first one, so we looked into our branch network and we said that fine, who is ready for what? Because we have different segmentation of clients. So we have the SME, micro SME segment. We have, similar to bank, we have a retail segment where we have 100% women, about 7.5 million. So when we looked into their digital readiness, because even if I come up with a solution, if they're not ready for it, it's not going to work, right? So digital readiness comes to us first. So digital readiness wise, we have seen that about 20% of our clients from that segment was actually digitally ready in terms of smartphone ownership and also internet penetration. Because in Southeast Asia, it's not only the smartphone, but also the internet connectivity. Also, we have a massive gender gap there. So basically, so we designed the app for them who are digitally ready and those who has a smartphone. People who do not have a smartphone, 80% of that segment, we designed a USSD solution for them. And also people who do not have a smartphone but feature phone, they can also use other wallets. So like India, we have Paytm. In Bangladesh, we have bKash, which is also part of the BRAC family. So we have 60 million users in that platform, in that wallet. So we looked into their platform as well to see like how many of our customers are sitting there, so that we build the connectivity between bKash and us. So today, like one client can come to bKash and pay back us through the bKash platform as well. Similarly, there are other platforms. So we are actually like building that, coming back to Rupali's point, that building that ecosystem, partnership with other platforms, other banks. So people who are banks, so we looked into the other group of people who are micro SME, and most of them have bank accounts because they are SMEs and they deal with banks. So we actually started disbursing loan to them through banks and also collect the money from the bank on a monthly basis, right? So that's how we are kind of digitizing the payments for those segments. So digital readiness is a key thing. I think looking into the customer segmentation and see who is ready for what and designing a solution for that. So you're designing, at least 7, 8, 10 different solutions, like a you can call it like a supermarket, right? So you can go and choose what you want based on your readiness. So that is number one. And that is working very well. So we're not pushing people that, you don't have a smartphone, you must have a smartphone, right? So smartphone doesn't work. You need to give them solution what they're really going to use. And I think the most important thing is what we have seen is like, when it connects to the livelihood, that is the third principle that I talked about. When people start making money using a digital solution, they automatically start using a digital solution and they automatically go and buy a smartphone. So that's the critical enabler, right? So livelihood that's why it's so important, because we have converted a couple of our branches as an experiment, to see if we connect them with a livelihood and then encourage them to have a e-wallet, then what happens? And 100% women instantly transformed, and they started using, because they were receiving money. So when they receive money, you even do not need to teach them how to use a smartphone, how to use a wallet. They learn it very fast, right? So that's why livelihood is so important. So we are now building a digital kind of ecosystem whereby you can call it like a social Amazon type of e-commerce, which will be mainly for the women in the villages who have something to offer, but they do not sell it to somebody who can give them a fair price. And if we have something like that, that will be remarkable. Then actually we'll give them the power in the hand of these women, right? So this is an example of a digital intervention which can help them money. And when you connect your digital wallet to that platform, you don't need to tell people to use that platform or use that wallet. They'll definitely use it, right? And the second thing is we have seen like, what makes our clients' life easier, faster, better. So that way, like, if you look at before, one client used to come to our branch to deposit money, traveling from a remote village for 1 hour, going back in another 1 hour, so spending at least 2-3 hours, right? So now when we have started disbursing to the wallet directly or to the bank account, it saves them 3 hours, right? When not only the timing, but like people who are coming from that community or that particular segment, for them the traveling expense also matters, right? So they're sometimes spending like 200 rupees back and forth just to deposit 100 rupees, right? And that did not make any sense. So when you let them use the digital platform and connect with the different wallets and through bank accounts and let them pay through that and through agent banking as well. So we open like multiple platforms for them, multiple entry points, so they can choose wherever they want to go. And then the cost is minimized, they automatically start using. So these are the lessons we have learned, that it has to be cheap, affordable, and not only cheap, affordable, accessible, and also connected with the livelihood.
Thanks, Aranjan. You spoke about multiple segments, multiple solutions. I think it reminds me of what Hilary said in the beginning, that women is not one segment. So I think that you are using it in your practice. One quick question is that, like, you have a decent smartphone owner population in Bangladesh, and many of them, they are your client. Do they still use a digital journey on the smartphone, or probably many of them, they're still not comfortable in smartphones?
See, I mean, the smartphone ownership in Bangladesh is about 41%, but there is a gender gap of 29%, right? And we serve, most of our clients are women, 90%. So that way we have, I think, 16-17% of our clients that actually they have a smartphone ownership. But then when you look into the smartphone ownership percentage versus the digital users, is pretty much the same. So people who have smartphone in our segmentation, I think all of them are using smartphone for transacting with us.
Oh, this is very interesting. probably this is something that we are yet to see actually in India. So our best estimate is that probably 50% of the smartphone users in India, they are using it for digital payments. So very, very interesting actually. Probably we'll have to know that what's the secret sauce behind that. Okay, so going to Hilary. So like, I think it's a little loaded and difficult question. In the sense, there is a data point actually. I was reading something today and I realized that in India, lenders are spending $7 billion annually on collection of money, right? And that's the reason we are seeing few startups which are known as collect tech startup. So there are two names which have come up. One is known as Pocto, second is Cred Genesis. So something of these type of startups, they have come in. And all the large banks, particularly private sector bank, HDFC, Axis and ICICI, they are running after them to help them collect. So there is something which is like just a data point before you respond to my question. My question is that like all the organizations are going through digital transformation, but two parts to it, whether it is helping them reduce the cost, and second is, can it make them more inclusive?
Yeah, so again, I'll bring some examples from Africa, which is what I know best. Thank you. So many of you would have heard of Equity Bank, very successful tier 1 commercial bank across Africa, started as a cooperative bank. They started their journey of digitization in 2010. And they did it by, I think you've probably heard the expression, how do you eat an elephant? One bite at a time, right? They didn't try and do everything all at once. It was probably a good 7-8 years that they invested in digitization. But the results were extraordinary. So they cut their operational expenses in half. At the same time, their pre-tax profits increased 80%, with not a huge jump in the customer base. So their customer base stayed, was growing year over year, but at the same pace that it had been. What was also interesting is that the yield was reduced by about 8 points, which suggested that they were passing on, and we know this from looking at the interest rates, they were passing on some of that operational savings, cost savings, to the customers. So you could say that maybe Equity Bank is an aberration, but even if it is, there's a lot that we can learn there, because it's an exemplar of the fact that digitization for them resulted not only in cost savings and increase in profitability, but also lower costs for the customers. So one of the things that we do is try and look at some of the principles. We recognize you can't cut and paste that into other markets because there's so many factors that go into that. But what are some of the principles that we can use to support others to do the same thing? A counterexample that I'll give, and I can't use the name because I'm going to talk about a bad experience, is a bank in Uganda that was actually didn't digitize, was very delayed, while everyone around them and their competitors were digitizing. And what happened for them is that they had very high operational ratios, expense ratios, of about 30%. And even though their funding expense ratio was low, it was 5%, they had to make very expensive loans, right, to cover these costs. And what happened at the same time is because all the competitors had digitized and there were fintechs coming into the market, those lenders were just skimming the best customers off the top. And so this bank was left with the highest risk customers. So that is a scenario that we don't want. And I know the data is very mixed on the impact of digitizing in terms of lowering costs for the customer. But again, I would turn to an equity bank to say, what can we learn from them and how can we replicate that in other markets?
Thanks, Hilary. In fact, maybe this is what you're suggesting, that this can reduce the cost in certain cases, if not in all. And probably if it is reducing the cost, some of them they would like to pass it on to the customer, if not fully, part of it. So they are more profitable, but at the same time, little more inclusive. Thanks for that. Actually, before I start summarizing, I think I'll open it for the audience to have any question. I see some faces which probably are ready with few questions. Please go ahead, actually, if you have any question to the panelists. I think fatigue is kicking in. So, one more chance in case you have any question. Okay, so I assume that there is no question. So probably let me start summarizing it and closing this panel. So I think we discussed a lot about what's really happening across the globe. There were many examples, many things that we discussed and learned. Few key things probably that we should look at it, that whenever we are looking at this entire, I would say entire unserved or underserved segment, I think we shouldn't be talking about that this is one single monolithic segment. There are multiple segments in that. Second is that it's not that even if you look at the segments, you have to look at is that what is that we are talking about, whether we are talking about farmers, because farmers may have a different need. If there are small enterprises, they will have different need, and if there are gig workers, they will also have a different need. So we'll have to basically cater to those needs. Third is what we are also seeing, that we see that some of the smaller players, particularly from the supplier side, they may be more nimble, more agile as compared to the larger player. So just quoting one data from Central Bank in India. So in 2020, they disbursed something like $666 billion, and of which only 2% was digital. So, and this also speaks that large banks or large institutions, they are heavily biased towards a larger loan, and they find it really difficult to be as nimble or as active that, which smaller organizations, also some of fintechs are possible. Fourth is, I think when we talk about fintechs, it's very important that what is the role that they can play. I think they can play the role at the intersection of what financial services provider can provide and what people really want. So it could be bridging that gap, or enabling that this money can move on the digital rails. At the same time, they would also like to leverage the adjacencies or the existing rails or existing distribution rails to make sure that they are able to serve the people. Otherwise, I think it's going to be a very costly proposition. That is what we learned. Another very interesting thing which is coming from the experiments with our BRAC Bank is that we have to look at that finance is one part of it. You have to look at, can we look at it more integrated approach, wherein we make our clients resilient, which is the theme of this summit. And if they are resilient, indirectly it means that financial institutions, those who are lending to them, those who are working with them, they will become resilient. So with that, I will close this session, and thank you very much to all my panelists for sharing such an interesting insight from all the work that you have been doing. It is always amazing to hear what's really happening around the world. Though we can always talk about what's happening in India, but this is, I think we have to take it with a pinch of salt, that a lot of interesting things are happening around the globe. We need to learn, we need to be better over a period of time. With this note, I conclude the session. Thank you very much.
Thank you very much indeed, Mr. Anil Kumar Gupta, for wonderfully conducting and concluding the session. And thank you very much, our panelists on the top table, and for wonderfully, interacting with all of us and marking the session to a close. Well, with that, ladies and gentlemen, we close this session, and we would like to ask the moderator and the panelists as they step off the stage. We have a small token of our appreciation for all of you. We'd like to give them to you before you leave. A short group photograph, please. Thank you very much. Let's give them a warm round of applause, ladies and gentlemen. And now I have the privilege in inviting Ms. Radhika Agashri, the Executive Director of Access Development Services, to kindly propose a vote of thanks, please.
Well, good evening, ladies and gentlemen. With that, we come to an end of the 19th Inclusive Finance India Summit. At Axis, we were particularly overwhelmed with the response and participation from all quarters. This year, sponsors for supporting the summit, technical partnerships, companies wanting to put up stalls at the Knowledge Fair, and of course the delegates from diverse set of organizations for participation, of course. At the end of the 2 days, it's my turn to, of course, thank a host of stakeholders and people who have helped bring the summit together this year. I deeply appreciate the support of the principal partners, Bill and Melinda Gates Foundation and MasterCard, both partners for almost 10 years now. Thanks to also Pavan and Prabir from the Gates Foundation for engaging with us on session ideas and suggestions. And MetLife Foundation, which is back as principal partner after a gap of a few years. Co-sponsors, SIDBI and NABARD, both Apex DFIs, have been long-standing supporters of Inclusive Finance India initiative, along with HSBC and IDFC First Bank. Co-sponsors, Credit Access Grameen, BRAC, and SBI. I would like to place on record our appreciation to HSBC for supporting us for almost a decade and a half on the Inclusive Finance India Awards initiative. Thanks to Knowledge Partners, Rabo Foundation and UNCDF, and our special track partner WWB, along with 11 technical partners who helped us work on various session themes. 11 associate sponsors, quite a few of which have come on board for the first time this year, but a lot of them have been partners for a long time as well. I would like to thank our inaugural panel, our inaugural chief guest, Shri S. Raman, CMD SIDB, and all other inaugural guests for helping us kickstart the summit and with high-level context-setting addresses. We are grateful to the speakers from across India and outside who spoke in 23 sessions over the 2 days of the summit, and for sharing their views and perspectives on various themes and sub-themes. Special thanks to the moderators of all the panels for working hard to prepare with their fellow speakers on background and questions and helping us with instilling some rich insights from all the panelists. I should mention the work done by our comms partners, Small Town Bandits, Aage Se Right, PR agency Matt Chatter, and online streaming partner Dreamcast for supporting and backstopping the Summit Secretariat. We hope that the Summit has been a useful platform for learning, sharing, and networking. We will send some post-summit feedback form, and I hope some of you will take the time to fill that up and send back to us. We thank you all for attending the Summit. Your participation year after year encourages us to continue to put together the required energies in organizing a large event. Thanks to Kaveri, our MC, for her wonderful facilitation. Thanks to the new MIC team, our event managers, for their hard work for helping organize such a big event, and also to the Hotel Ashok team and management. I would like to appreciate hard work and efforts of the Summit Secretariat team, Shubhradeep, Jafreen, and all of us, all of the team that were pulled out from their regular work to help us in the last 2 days. Thank you very much. You have been the most wonderful team. Supported, of course, by the finance and admin team led by Subir Ghosh. And a special word of appreciation to our oldest hand, Lalita Sridharan, who has anchored all 19 Access Summits organized till date. Thank you so much, Mr. Srinivasan, for your mentorship and technical guidance. We can turn to you anytime for help. And of course, thank you, Vipin, for your continued encouragement and your faith in the team. Thank you all, and we look forward to seeing you again soon. Thank you.
Thank you, Radhika. As usual, a wonderful summit that's come to its closure. And I must tell you, ladies and gentlemen, she's one of the most wonderful people to work with, and she really believes in making teamwork makes dreams work. Thank you once again, and I'm sure your vote of thanks has been seconded. Well, with that, ladies and gentlemen, we come to the end of this conference. I think some group photographs will be taken, but before you leave, do carry your personal belongings with you, because we don't know what's going to happen to this hall once we leave it. Thank you very much once again, ladies and gentlemen, and namaskar.